So I think if you were to look at the common equity of this type of enterprise, you should think of the common equity as a call option on the underlying Bitcoin stack, right? And I think so it's kind of like a Bitcoin call option that is perpetual in its duration. And if we were to think a step further about how one would value such a call option, or how one would think through abstractly what the features of this call option is, well, a call gives you convexity, right, towards the upside. And you actually pay a cost. You might have heard of the term like theta, which is the time decay. But in reality, theta is not exactly time decay. It's actually the cost for gaining convex exposure to the underlying asset. So theta is actually the cost of gamma, vana, and volga. So those are three sets of higher order Greeks. So they're like second order derivatives of the first derivatives. And these are all convex exposures to volatility, to price, and to the volatility and price like cross, the cross derivative of those, that would be vana, right? So basically, theta is paid for you to gain exposure to those three higher order Greeks. And in the case of this common equity, your theta is your perpetual preferred stock dividends. That's what's being paid, right? So like the common equity is constantly bleeding in order to pay that theta off to maintain that convex exposure. And so I think that's really the right way to value this. If we were to go from like Graham and Dodd style, like securities analysis, from the the core classics of investment valuation, yeah, like you could probably use a framework like SEEB, common equity Bitcoin exposure, right? You take the Bitcoin stack, you subtract out the notional value of your prefs and your debt and all of the credit instruments, everything that's not common equity, and then you say like, oh wait, this would be the common equities Bitcoin exposure, right? Now, I think that's a fair way to do it. If we were to tie it back to options, that would be kind of like the intrinsic value of that option, right? That would be like if the option was in the money, and you're saying like, okay, this is how much is in the money, and everything above it, your quote unquote premium, that would be your extrinsic value of that option. So I think that would be like the framework that I would use. And frankly, for this digital credit report, it kind of lays the foundation for starting to think along those lines. And I will have a part 2 and probably part 3 that kind of elaborates on these like quantitative valuation methods.
So in Bitcoin bull markets, we've seen, for example, Strategy's MNAV expanded, I think, to like 3.5x. So within that framework, is that just reflecting the amount of volatility, the forward expectations on upside convexity, or was that like really a bubble that was overvaluing Strategy?
Yeah, I mean, I think both those things can certainly be true. The way I think I would interpret it in hindsight is probably it was more bubbly than it was the other things that you mentioned. But like both of those things can absolutely be true. Just because in a bull market and in these events where price is ripping to the upside, obviously the price of convexity goes higher, right? And obviously the implied volatility of these of all underlying instruments within this stack, right? If we're claiming that the common equity is a call option on the underlying Bitcoin, then there is necessarily an implied volatility attached to that asset base. And the common equity's premium to its net asset value reflects that implied volatility. So the market has a view on the implied volatility and the convexity that the common equity can give you, and it can place a pretty high bid under that, right? And I think I would say like speaking along this line is like this will not be within my decision making anyway, but like for a treasury company to take advantage of these situations. Like when their management team views that the securities that they have are, let's say, priced above fair value, then they absolutely should issue into the market, and that would be an accretive transaction.
And you know, wouldn't that reflect kind of the supply and demand for amplified returns on Bitcoin, that these vehicles will grow their balance sheets when there's a lot of demand? Do you think that the balance sheets will shrink in bear markets, or is it really just about paying the dividends, as we saw most recently? Strategy sold a fairly small percentage of their stack just to prove out kind of their business model. Is that do you think that's going to continue, or is that kind of a one-off just to prove that they can?
Yeah, I think in the future, like this is absolutely something that we could see more of, just because if you're looking at it from the perspective of I want to maximize the value generated to the common shareholder, right? Then the name of the game is to sell stuff that is overvalued or relatively overvalued, and then buy stuff that is undervalued or relatively undervalued. That's it. Like if you can consistently do that, everything else will kind of like work itself out, and then value will accrue to the common stock. Okay, like that's it. Now, obviously, all of this is somewhat contingent. All of this is contingent on Bitcoin like actually outperforming, right? Like it's all contingent on that. Everything's downstream from that. But assuming that is the long-term case, then yeah, everything else from then on really is just about selling stuff when it is relatively overvalued and buying it when it is relatively undervalued. So from the perspective of Bitcoin versus the common stock versus all the other preferred stocks versus the cash reserve, amongst that set of assets, amongst that like Rolodex of assets, there's always going to be something that's relatively overvalued, and then there's always going to be something else that's relatively undervalued. As long as you can make the trades properly, then the value will eventually accrue towards the common equity.
And you know, to that point, I think that as strategy kind of discovered this menu of options over time, because they didn't start with all the options on the table, even though obviously in theory they were there. They were kind of going through the idea maze, and now that I think that they have made clear that they can buy or sell any of these different assets or equity instruments, it seems to have caused like a perception that they are not holding to promises that they would have made in the past, right? Of say not selling your Bitcoin, but obviously it seems rational for them to say that all options are on the table, and that's kind of how maybe you keep the short sellers away. It's how you keep demand for the preferreds coming in. That you have that full optionality. Is that the same way you see it, or do you think that commitments to, for example, not sell Bitcoin are valuable?
Yeah, I mean, I would say I would actually take the opposite stance of what you said last. Like, I think commitments to not sell Bitcoin is actually not valuable. It has negative value because it is a short option, right? Like, you are now short an option, and now, like, if you had this option, now you've like by your own actions decided, okay, I no longer have this option. Like, you're kind of cutting off some of your own limbs, right? Cutting off your own resources. So that's how I see it. Like, I think ultimately it just comes down to what is in the best interest of the common stock, right? Like, that is what every company exists to do, is to accrue value to the common shareholder. And yeah, like that's the bottom line. So it doesn't matter about anything else really. I mean, obviously we'd like to see more companies buying more Bitcoin, and we'd like to see we'd probably rather not see more companies selling Bitcoin. But at the end of the day, like, the companies like they're beholden to their shareholders and beholden to value creation, not beholden to, some random idea saying like, oh, we cannot sell ever. Like that's just not good and not how you do business.
And if we look outside of kind of the Bitcoin Treasury space and we look at other companies, it's pretty common for them to be buying and selling assets depending on what the valuations are of those assets, whether they're doing stock buybacks or issuing more stock, and doing M&A and spin-offs, et cetera. So this is kind of the new phase of active capital management that we're entering into. Do you think that another possibility for, let's call it, ideological flexibility would be on the question of using derivatives? We have not so far seen Saylor or Strategy implement derivative strategies like we might have seen with MetaPlanet, for example. Do you think that's going to enter into their menu, or is that would that create too much noise for them?
Yeah, I mean, I think right now the company has a lot of like an identity crisis of sorts. Like maybe it's not that way to management. Like maybe they have an idea of what they want to do. But I think in public perception, there is that identity crisis. Um, I think anything can really be on the table. To the point about derivatives, right? Like, obviously, Saylor has made it clear, like, he probably wouldn't want to put more structures on top of it that, potentially generate like income on the Bitcoin via derivative strategies or staking or whatnot, right? And that's very reasonable. He doesn't want to make the investment case more complicated. But that being said, like here's one easy example for where derivatives could be a value add, right? Imagine if they have, so obviously they have a bunch of prefs, right? But imagine if they set aside some Bitcoin, they hedged that Bitcoin that was set aside for the prefs. I think that would probably like instill more confidence in the backing behind the prefs. Like if they set aside, so right now there's about $10 billion notional of stretch, right? And so they're like, okay, we know there's $10 billion notional for stretch. We're going to set aside $10 billion of Bitcoin and we're going to hedge that with puts, right? So they pay money for these puts. And if that Bitcoin that is set aside for stretch, again, it's not like encumbered necessarily, but it is set aside like at least nominally. Like the company does say like this much Bitcoin has been set aside and we're going to put a hedge on it to make sure that its USD value doesn't fall below a certain point. Like would that be positive or negative for the digital credit? I think it would be fairly positive. It probably would be viewed like something akin to a cash reserve. Functionally, it's kind of like a cash reserve if you're saying that it's not going to go below this point. So the flip side of that is if you buy a protective put on some Bitcoin, that is logically equivalent to just buying a call option at that same strike, right? It's the same return profile. So if you've justified, okay, well, we're going to set aside this money for this Bitcoin and protect it with puts, now you've obviously also justified like we'll set aside this cash reserve, but then we'll use call options to have Bitcoin upside exposure. And so now you can clearly see like simple derivative strategies certainly can make total sense, right? What I probably would not see happening is something where they're like, okay, we're gonna do a sophisticated options market making kind of deal and then use our Bitcoin as marginable collateral to open these trades. Like I don't think we're gonna see that. But again, I think anything could be on the table.
Yeah, that makes sense. You mentioned on kind of the protective put side, they already have these cash reserves for future dividends. That is credit positive for the preferreds, but it's also introducing cash drag for the common. How do you think about that trade-off in terms of maybe their cost of capital on the preferreds versus the drag?
Yeah, so I would say mathematically, and I've written about this like on Twitter and whatnot, but mathematically, they are not going to maintain a n-year constant amount of dividend coverage. It's impossible because, like, just think about this. If you're going to keep issuing more digital credit, and let's say you issue at, let's just keep numbers simple, at a 10% cost of capital, right? So every year you issue this share, and the share is worth $100. Every year you got to pay $10, right? If you wanted to maintain 3 years coverage on that, like, like now you have, that's 30% of your value is 10% times 3 years. Now that's 30%. So every $100 you raised selling this thing, you have to set aside $30, which is kind of like a, it's not exactly this, but it's kind of like a loan origination fee of 30%. So this is like, like there's an extent where this is like, okay, this is unacceptable. I will say, to the point of the discourse around the USD Reserve, the true origin of like where this all came from was the S&P credit rating. They did the S&P credit rating like October of 2025, and in the credit rating, the agency specifically said, hey, it would be nice if you guys had a cash reserve. That's where the origin of all of this comes from. Okay, it wasn't like an idea that they just like thought up of. It was something that was specifically prescribed, and then they decided to act on that prescription, and now they have that reserve. And so the point of this reserve was always to just get your foot into the credit rating agency's door so that you can get a good rating on your prefs, and then this way you can sell more prefs, hopefully at a lower cost of capital. That was always the plan. It could have been, now it might have, like, because of a lot of market fears and whatnot, things could have shifted towards like, hey, we need to make sure this cash reserve is always up and at all times. But I'm just saying, like, just trying to sound the bell here is just like, it's not going to happen in the long run. Like, if you are of the position that more and more digital credit will be issued, then you cannot simultaneously be of the position that this N years of dividend coverage will be maintained, where N is a constant number. Like, N has to start going down over time as more credit get issued, right? So I think that would be how I view that. I think a lot of fear is in the market right now, and the company unfortunately has to also respond to that. So that's kind of how I see like what's going on with that.
And do you think the cash reserve should be set aside for situations where companies simply don't have access to capital markets, and so it's their last resort, or to use it more strategically, like Strategy did earlier this year with paying off part of their convertible debt?
Yeah, like so this one I kind of want to take it away from just Strategy, right? Because there's companies in general that like have Bitcoin, and they can also have some cash. If a company just had Bitcoin and cash, the cash should obviously be deployed, however it is that would be most value accretive at that moment, right? And given the facts and the long-term time horizon as well, right? So incorporating all of those facts, what is the best course of action right now? So, in general, that's how you should always like use cash, period. And then also, if a company had an operating business that was throwing off a lot of cash flow, and they also had liabilities that they needed to pay because they were financing their Bitcoin purchases, well, now they don't really need that cash, right? They don't need that cash to keep it to pay coupons or dividends or whatever, because they have cash flow from their operating business that they can use to pay that. So that question and the results of that question kind of change when the parameters change. With Strategy, like, unfortunately, they don't have that operating business that is able to throw off that much cash flow to pay all those dividends. So to the credit markets, It's like having that USD reserve is an insurance policy of some form. And because of that, like that's why they're stuck in this kind of situation. If they were to take that cash and deploy it, the deployment logic still is the same with any operating company. It's just whatever is most value accretive at that moment, given all the facts.
Yeah, that makes sense. And then there's also kind of the sequence of returns problem, right? Where even if we're long-term bullish on Bitcoin, outperforming the preferreds, in the meantime, we could have a very long sideways bear market and cause kind of issues. How do you think about the sequence of returns issue for Bitcoin Treasury companies? Is the 4-year cycle over? Is kind of the other big underlying question there. But
Yeah,
yeah,
yeah. I mean, sequence of returns is ultimately the main variable and question mark whenever you're dealing with any kind of leverage, right? Or amplification. I know there's, people make that distinction, but, for our purposes, I'll just say leverage, right? So anytime you're dealing with leverage, you have the sequence of returns. When it's margin leverage, your sequence of returns is just super time sensitive, right? It's like within a day or two. And if you're doing these kinds of like perpetual preferred equity given leverage, then you now have more time to be correct about something, and you've given yourself more time. But over this time, right, like given a poor sequence of returns, you will see the common equity get absolutely crushed. And this just comes back to what I was saying earlier. Like the common equity should accurately be thought of as a call option, and that call option throws off decay of some form. Like some kind of cost needs to be paid for access to that convexity. And so if you got access to that convexity for, let's say, 3 years, and 3 years no big event happened that allowed you to profit from that convexity, well, then you would have been paying a lot. You would have been bleeding a lot, right? So of course your call option would be severely degraded in value, and that would be a common equity that got crushed by a poor sequence of returns. In terms of the second part of your question, the 4-year cycle, like for me, it's like I mean, I think we cannot deny that the 4-year cycle came on time, at least for the top. Like as far as like this time, it was concerned. Like it came exactly on time. Going forward, I do think like it's eventually going to fade because I don't see any like economic reason for why it needs to continue. But I cannot deny that empirically it has held up so far. If I were to guess, I would have to guess like, hey, most of the market's probably thinking that October of this year will be around where the bottom is. I don't think the bottom is going to be as extreme as in prior bottoms, right? Just like the top this time wasn't as extreme as prior tops. So that's kind of my view. It's like kind of, we'll more or less follow in lockstep this time around. And yeah, but things will be fine in the long run because I think the fundamental properties of Bitcoin really haven't changed at all. And if anything, the surrounding like political, institutional, and other kinds of backing behind it have only gotten stronger. So I think the long-term future is very, very sound. It's really these like, intermittently you have these kinds of issues. So that's my view on the 4-year. Yeah.
So on the point of cycles, there's kind of the diminishing returns thesis that every Bitcoin cycle has underperformed the previous one. And then we saw gold have a massive generational run over the past few years. And it's obviously much bigger than Bitcoin's market cap. I think it's 20 times bigger than Bitcoin's market cap. So in my mind, at least, it kind of invalidates this rule of thumb of saying, hey, the bigger the asset is, the harder it is for it to move. On the other hand, gold has been driven by central banks buying, and we don't really have that on Bitcoin's horizon just yet. We'll see how the strategic Bitcoin reserve develops. But um, what what do you think have been kind of the catalysts for this bear market? Is it just the OG selling, or are there other macro factors that we should be looking at?
Yeah, I think it really does not have to be more complicated than OG selling. If you look at other macro factors, I think the last time we talked, we were talking about AI. Like AI can draw attention away from Bitcoin. Like, and I said, look, even Polymarket can draw attention away from Bitcoin, and all of these things kind of pool together insofar as factors that can influence how a cycle plays out. Um, we have three very big IPOs, like the biggest of all time this year, right? That's going to pull a lot of capital out of assets. Whether we like it or not, like Bitcoin is still roped in broadly, largely, as a speculative asset, right? And so that is going to, new and hot and like really fashionable IPOs is by definition going to compete with that same theme for Bitcoin. So I think that's just what's been going on. But it doesn't really have to be more complex than yeah OGs have sold, and them selling doesn't really have to be more complex than hey look they've done the 4 year cycle like 3 times now, and they're just like playing in lockstep with how things have happened as they've seen it. So I don't think we need to ascribe more complex theories to that than just things are just following the prior lockstep.
And so this will come off as 2020 hindsight, but you'll hear people say strategy. These other Bitcoin treasury companies, they were buying a lot at the top when they could raise a lot of capital, and they were immediately putting it into Bitcoin. They should have raised the capital and then DCA'd in, or waited to time the market. Do you think that there's some truth to that they should be market timers, or should they be pretty agnostic as to when they're buying?
I mean, so I think there could be some truth to it, but the I think that it I think the real mistake people make is that they're kind of taking on the perspective of what they should do as natural persons and then extrapolating it to how a corporation should be. Like if you were a natural person, and let's say you were just borrowing money or whatever, like you might want to like DCA it, right? And that would probably like smooth out your returns. With a company, it's not real. I don't think it's that big of a deal with a company because at the end of the day, like they like the less moving parts, the better. And you want to keep things simple. Like if your policy is to buy Bitcoin or if your policy is to increase your cash reserve, then whatever money you have coming in would just go towards whatever standing policy you have. And then you can kind of leave a lot of like variables out of it. And I'd also propose that the flip side of this is, people are basically just talking a lot of trash during a bear market. And so, of course, every week, you bought in the prior week and this week is a little lower. It looks like you had a terrible entry price. But on the flip side is if this was a bull market and every week it was lower than, the current week, now it looks like he's buying below spot, right? So it's like if you just look at the perception and like did not really think too much about it, you'll always get the wrong and more biased view, and that'll always be your conclusion. But if you just think about it a little bit more, it's not really that bad. If you get the money, just use the money towards whatever policy makes the most sense for the company right now. The bigger question is like, is the money being deployed correctly between cash and then should we even be issuing prefs at this time or should we even be issuing common at this time? Like that's really the bigger question. I think like I would probably have liked to see the discourse more focused around that.
It seemed like the prefs STRC when it hit $100, they were issuing more. It seems like there, as a practical matter, wasn't really a ceiling on how much they were willing to issue, and then they started trading at a discount. And I've seen rumors that it was because people were leveraging up on top of the prefs to capture some spread with margin loans on their stock portfolio or something like that, and then they get liquidated and are forced sellers. Do you think that the trading band and the communication about the $100 par value that needs to evolve, or that there's some kind of game theoretic changes that need to be made to the instruments themselves?
Uh, yeah. This is a great question, and it's a very, very deep topic. I don't know if I'll be able to fully cover it like here. So, I think the bottom line up front is, they were ultimately contending with something called the impossible trinity, right? And this is a topic that is very, very, it predates Bitcoin by like decades, right? It basically states that within any economic block, you can only have two of the following three things, right? You can only have either you can peg a, I know it's not like a true peg, but I'm just going to use that word because that's what the textbooks use. But you can have a pegged or a fixed exchange rate. So in STRC's case, this would be the promise that it would trade at around $100. And again, I know it's not a promise, but this is like the implied. Okay, so so you have the fixed $100 price. You can have free capital flows, which means people can freely buy or sell, exit the system, which is always going to be true because it is a security that trades on the NASDAQ, right? You cannot impose capital controls there. And then, of course, you have the third thing, which is sovereign monetary policy, which in this case is just the ability to control the dividend rate. So that's the impossible trinity. Of those three things, you have to pick two. You cannot have all three. You've already said you're going to keep it at $100, so you've picked the fixed exchange rate. And you've already listed it on the NASDAQ, so you've picked the free capital flows. This means you no longer control the dividend. Now, if that's the case, then you're completely up to the whims of the market. And yeah, so if the market's going to push the price down, you will now have to raise the dividend. And there's no choice. And the only choice you have would be to compromise on the first thing, which is the $100 stated amount, like having it trade there always. So what has ended up happening? Well, I think the market, quite frankly, has pushed it down. And like you remember, I think back in, back when Stretch had first started, it was trading at around 92-ish, and they suddenly raised it like 100 basis points. Remember that? Like they raised 100 basis points to like force it back towards 100. And now we have Stretch at like, at the time they made this decision, it was like below 87, right? So below 87, they only raised it 50 basis points, right? So you can kind of see how there's already starting to become a compromise on the dividend side of things. Or the statement that was issued, might have been 2 weeks ago or 3 weeks ago, but basically it was the one where they had that new policies, like new everything, right? And part of that statement said, we will no longer raise the dividend on Stretch just because it is trading below 100. So when I looked at that, I'm like, well, this is clearly the company saying that, like, hey, look, we're not going to guarantee that this $100 fixed rate is going to hold. So this is them reclaiming control over the dividend, right? So in the impossible trinity, this is them saying, okay, I'm not going to do number one anymore. I still have to do number two, which is because it's listed on the NASDAQ. And then I am going to reclaim control over number three, which is the dividend. And that's perfectly okay. That's perfectly okay. They have every right to do that. It's their pref. It's within the rights of like the prospectives for the security. So it's fine. But I think in many ways it was needed. Like this was going to happen sooner or later. Now, the other thing is like, should we materially change the security? And I think this is probably even more interesting than everything we had just discussed because, like personally, I do think that there is room to make some changes. First of all, this is a floating rate instrument, or rather, it's a variable dividend instrument. If you look at the market for floating rate notes, for example, they tend to have about like 2-year maturity. So in 2 years, something has to be paid back. The principal has to be paid back. And then the way the coupon is adjusted is every day you snapshot the SOFR, and then you put a fixed spread over it. Okay? So the spread itself is fixed to the value of the principal, the face value of the note. And then SOFR, of course, is what floats. SOFR is the only thing that floats. Okay? So to all of these other instruments that are floating rate, SOFR is really what makes them floating rate instruments. It's by virtue of the fact that SOFR floats. That fixed spread isn't floating. Okay? If you look at digital credit, it's completely different. Digital credit, it floats by virtue of the fact that the price, we are trying to keep the price stable. The price is not at $100, then we change the dividend. That's why it floats. Right? So that's potentially a problem, because like it makes this thing a little too different from the others. So that's potentially a problem. Another thing is, and this part, it almost pains me to say this, because I do view perpetual duration as a good thing. But I think to a credit investor, right, the fact that something has to be repaid at some point is an anchor point on objective value. Like if I know for a fact, like 2 years down the line, I am going to be paid the principal, and like this is their obligation to do so, then I have that objective anchor point. If all I have is this promise that this dividend will be paid, but then the dividend can also be suspended if something happens. Like now you can see where, to me as a credit investor, I would either have to attach a huge spread onto it, like a huge credit spread, or I would really not treat it as credit at all and treat it as something that should trade with more volatility. And if everyone else in the market kind of thinks that, you will have the volatility that we just had, right? So I think like this is a natural outcome of the economic incentives, and if we want to change this outcome, we have to change those incentives. So one thing I would like to see them at least consider is perhaps put some kind of investor put into these instruments. Okay, like if the stated amount is at $100, they could put the put at like 85, and then every 5 years, every 5 years, like let's say, the investors are allowed to put the security back to the company, force the company to buy at 85. What that's going to do is, first of all, it now creates the objective anchor point. So it kind of mimics what the floating rate note does, right? But also, it keeps the perpetual duration. It's just no longer like a Macaulay duration anymore, right? It's more of a, it's duration by virtue of the fact that, this thing doesn't expire. But then again, if it gets putted, then it's done. So that's kind of the new game theory. And if we then look at this new game theory, as we approach that 5-year put date, what's going to happen is the price, if it's below 85, will go towards 85. And once it goes towards 85, you also have the perception that, hey, if I don't put it to the company, then I earn the dividend. And so maybe it goes to premium to 85. And if it goes to a premium to 85, they wouldn't put it anymore. They would just sell it if they wanted to get their money. You see? So I think something like that could create more stable dynamics to digital credit. But that being said, like, is it even possible to amend stretch to that extent at this time? Like, I don't know. But I'm just saying for other like companies that might be looking to issue these credit instruments, these are things to consider, right?
First on your point about the put, couldn't the investors overlay the derivative on top of the instrument? I think that now there are options chains on the perpetuals. Do you think that's a reasonable approach, or it really has to be the issuer to put in this protection?
I think the issuer would have to do it because The options market right now, I mean, it definitely got a lot more liquid after the sell-off, but it's just not enough to accommodate the size, right? Stretch is a $10 billion notional value asset. There is not that much options trading on it, so I mean, it would be nice, yeah, it's true. Someone else could buy the put, but when you're talking like a really large scale money manager managing a bunch of money. Like this is not an option for them, right? And ultimately, those are the pools of capital that we were looking for in the first place. So I think creating that accommodation of the investor put would it would probably fit that bill a lot better. It'll make them feel a lot more comfortable, right? Because then it feels just like one of those floating rate notes that they would otherwise buy. So yeah, those would be like my two addendums, right? Like, forget the variable rate that's based on the price. Just like make it SOFR plus spread. You make it SOFR plus 700 bips. That's more attractive than any floating rate note. Okay, like SOFR plus 700 bips, and then we can go from there. And by the way, if it's really SOFR plus 500 plus 700 bips, like you will eventually get it to trade above 100, because these things, it's not going to stay like that forever. Like once the market like wakes up to it and they're like, yo, this is actually a good instrument and the risk isn't really that bad, it will like break the peg, but it'll go to the upside now, right? And so of course implied within this is also just remove your 101 investor call. Right, remove that $101 strike price to call everything back at 101. Allow it to trade above par if needed. I think like SATA did something like that. They were like, yeah, we can suggest that. But what they were doing was more so like saying, hey, like this would deter the shorts from putting on short positions at 100, which of course, right, that's a reasonable deterrence. I just think long term, it's probably better to not target a stable price and better to just act more like traditional floating rate notes.
Yeah, and so that's a really interesting proposal with the SOFR plus. I think that makes a ton of sense. The protective put just it sounds expensive for the common stock to underwrite that.
I think it's like this. Like, I think ultimately, with something like that, the company will not issue as much digital credit as they did right now, right? Like imagine if they knew 5 years later, like we might be on the hook for 85 cents on the dollar, right? Then they'll be more careful about it. But and so what that would lead to is A, they buy less Bitcoin in the meantime. But B, like they probably have higher quality buyers. And this is the part where I think no one's really talking about. Is that like right now, I believe most of the buyers, first off, we know most of the buyers is retail. Okay, like Strategy has their own deck. It says like for Stretch, about 80% retail ownership. But here's the other thing, okay? And this is the part that like people don't really think about that much. The 20% that's not retail, at least 6% of the 100%, about like 600, about like $600 million of Stretch was owned by these DeFi protocols. Now that's probably I'm gonna assume, right, that's gonna come across as institutional. So, but like, that's institution ownership, but what's really behind it is just retail. It's like no institutions really use DeFi, okay? So like, what you really have is probably about 90% is all retail ownership, and they're all trying to do these like leverage looping kind of things, right? And so that's the quality of the investor that you have under this current model, right? Because they think like, oh, you actually are going to make sure the price goes back to par, and you're just going to keep raising the dividend. So as long as I can like maintain this margin position, I can keep pocketing a spread. Those are the incentives at play. Whereas if you had other buyers who see that there's the investor put, they will come in and they're not going to be the type that does those kinds of those games where they leverage loop something. And now the behavior of your investors is necessarily going to be different, right? So when you have a first wick down or something, everyone isn't getting margin called. They're just looking at their investor put and they're like, yo, like we're gonna be okay. Like worst case, we hold to when this put expires and then we just exercise it. And that becomes the new dominance mentality for that market, right? For the market on that instrument. So I think there's something there. Like there's something to consider about that. You won't sell as much, but your buyers will be probably quality buyers that's not trying to play these kinds of games that'll ultimately just make everyone look bad, right? Because look, if you promised that this, I know they didn't promise it, but if you're marketing it as like, hey, this will more or less stay at this trading range, then it doesn't for an extended period of time, that looks terrible. That looks awful, right? So these kinds of faux pas just won't happen as much because the investor base will be different, and I think the credit looks more like traditional credit and less like something too new and too like out there. And I think there are benefits to doing it that way. But to your point, it is going to be expensive, right? And it's expensive on the one sense because, you know, we cannot issue as much. But it's expensive on a different sense because, look, if we have to accommodate like huge lump sums of exercise, then, you know, we'll have to be much more disciplined with how we manage cash. But again, I will say, right, assuming the asset coverage is there, the exercises should never happen. Does that make sense? Like assuming the asset coverage is actually there, it will always go above 85. Once it goes above 85 or whatever the strike is, right, it'll always go above there, and then it'll peak a little bit over that because there's a dividend yield in the future if you don't exercise. Because it peaks a little over that, they will never exercise because they'll just sell on the spot market. The other thing is, if they end up having to, if investors exercise anyway, and the shares are trading above spot, you can ATM to just like raise the money and just give the money back. You know, like you could do that. So I think I know the put is kind of, it could be more controversial, but I think if you think it through, it's like there's actually some optionality there, and the upside to it and what you gain from it could make it worth considering. So that's kind of my idea.
Yeah. Okay, just to pressure test it a little bit more, because I think it's a really interesting idea. If in 5 years you see this kind of flash crash, right, where there's stress in the market, not for any underlying credit reasons, not due to a lack of coverage, but purely because there's more sellers than buyers. Does that kind of force the company's hand when really they should have been able to ride through it?
Yeah, it does. In that case, it definitely does. Like but if that happens, right? Like there's literally no problem in just selling the Bitcoin and then like meeting those exercise needs. Like there's literally no problem with that. They can also preemptively, like if it goes below the strike, like let's say we are 3 months out, right? 3 months later is gonna come the exercise date. And then it falls way below. It falls to like 75, or how it fell like this time, right? At this time, the company is like, all right, so 3 months later, we're going to have to pay back 85 cents on the dollar. Right now, it's at 75. Let's just scoop up as much as we can at 75. Right? Like this becomes a, at that point, you're accretive. You're 100% accretive because you're buying something below the point where like you know you're going to be obligated to pay that money. So that would be an action to do, and this would be exactly what the cash reserve would be for, right? Like for stuff like this. Frankly, the cash reserve isn't for paying dividends because they sell Bitcoin or common to pay the dividends anyway, and the cash doesn't get depleted. So it's like this is the type of thing where you can deploy cash in like larger quantities.
Yeah, that makes a lot of sense. It's a really interesting idea. The other question I would have along those lines is, you know, the effective yield increases as the price of the preferred goes down, and doesn't that just naturally attract more investors or even just short-term traders who kind of see that it's mispriced, and so the issuer doesn't need to do anything, or do they have again promises made to keep it close to 100, and so they have to do something?
Yeah, so I think it's valid to assert that as the effective yield goes up, it draws in more buyers. But then I also think like that mental model only works within like your plus or minus 1.5 standard deviation type of event, right? Like once you go outside towards the tails, you have no idea what's going to happen. So this is something that we have to be very careful and precise about, because like ultimately the way normal credit assigns the value is because there is that repayment date. That's what anchors the value. If you just have an instrument that throws off dividends, but then it never has to like pay the principal, you have a situation where everybody in the market now knows that the next time I can get out and get my principal back is completely up to the whims of all these other people that are playing around in this market, like I am. Like which one do you think gives more confidence? Like the first one, where like, hey, I'm definitely gonna have to be repaid at some point, like 2 years from now, or like 6 months from now, or some specific date from now. Or the second thing, which is like, oh yeah, I can do this right now, and it would be a high yield play, but when I have to exit, I am completely subject to whenever that future spot price is, and I have no idea what it's going to be, right? So that is clearly, yes, that could attract traders. That could attract people who are like long-term, short-term, right? Who are more short-term than long-term. But now think about it. Like if your entire premise was we were trying to sell to the credit markets, but now you're saying, hey, now we just want to attract traders who would leverage up and who would like try to go in for the high yield. Are you really targeting credit anymore? Or are you targeting people that are more short-term traders, right? Not that it's wrong to like sell instruments to short-term traders, but if the stated goal was to like sell to traditional credit investors, and then in fact you are not doing it because of the way you've structured the instrument, then I think something is wrong there, right? Like maybe it's not legally wrong, maybe it's not like even wrong for the company to do that, but something is wrong in terms of like how you're presenting it, and then like what's actually going on, and there's a disconnect about that.
Like a product market fit issue, really. So this raises an interesting question, which is that rather than positioning the preferreds as better than a money market fund, for example, or kind of like a savings account where you do have kind of par, create, redeem, right? You don't have to worry about the principal. Positioning it as more akin to buying a piece of real estate, home, let's say, to rent it out, and that you'll earn the income stream of rent, which will be stable, but your ability to sell it at par is not guaranteed, right? So really the decision-making process should be about, do you want this stream of income, and how confident are you about the future dividend rate, rather than trying to worry about, can you get in and out of the principal at par? Does that make sense?
So are you asking me like the
The
investors should?
marketing, the product market fit is of a longer duration than what kind of has been floating out there of, oh, this is like cash.
Yeah, yeah. I mean, I think if you're talking about it and like you're marketing your security as the issuer, yeah, you shouldn't use the kind of like cash thing. I think that's not the best like legally sound way to characterize it. Um, but then also like it is hard to do marketing and it is hard to like grab people's attention. And so I understand like there are incentives at play that just because of how attention starved everything is, right? It's just like you have to try to grab people's attention and then you have to make outstanding statements in order to do so. This is just, I think, how things are in the social media age, right? So, uh, it's one of those things where we could wish it were different, but I don't think things would change that much. Um, but that being said, like the larger point is absolutely correct. Like I think something like Strife, for instance, right? The most senior pref that just like it's basically a perpetuity. Um, with of course a risk, with a credit spread that needs to be attached to it. Um, but like that's a very good security, like all things considered. If you are truly a retiree, then you've like did your math and you're like, all right, from today until when I retire till the day I die, like I'm only gonna need this much money per year. This is how much strife I'm gonna need to, fill that part of my investment portfolio. Perfect. Like then you don't have to worry about the price. So like if you're truly a retiree, like yeah, there is a point to be made. Like why bother if the price like collapses below your entry price? Because as long as you're still getting paid the dividend, you know, that's what you bought it for, right? Sure, like what's the problem? But again, like I think the pain that is felt in the market, like at least over the last month, is just frankly because those were not the buyers. The buyers were people that were leveraged long. They were probably trying to earn some like carry spread, and they're probably trying to like be the first ones out as soon as anything went wrong, and then a lot of them just got caught flat-footed, and that is how we saw the cascade that we saw. So I think that's really how it is, and part of it is also like the super conservative investor that's just buying this for retirement. They're probably not looking at something like this that isn't rated, right? Like that's you just have to think that like there's just all these other variables at play, and strategy is in a very hard position to have to balance all of this, right? It's a difficult thing to need to balance everything and make as much people as possible happy. So I think that just also needs to be something that's considered, right? Like it's hard. It's genuinely hard. Not that it's an excuse for anything, but it's just difficult.
And on that point, as people kind of get more educated and see the track record for these over multiple years, is that how you change kind of the investor base for these instruments from short-term to more long-term income, or do you stick by your thesis that there needs to be product changes?
Yeah, I mean, I want to clarify. Like, I'm not saying there necessarily needs to be. I think what I'm suggesting would be very helpful.
Yeah.
Like very helpful in the certainly in the next like 2 years. Uh, Long term, I don't think like these instruments are dead unless the Bitcoin thesis that we all have is wrong. Okay,
Right.
like that's where this is all downstream from. So as long as like I think the ultimately what happens is once the bear market ends and the bull market returns, like all of this stuff will be bailed out at the end of the day by the rising Bitcoin price. Okay, that's just what I think would ultimately happen here. Like we can suggest all of these things, like Saylor can, and his team can put out these like new frameworks and whatnot, but this is all to just try to, outlast the bear market.
And on that point, do you think there will be instability introduced in the bull market by people selling the preferreds to buy the common because now they think that's going to outperform, and then vice versa in the bear market, them, at the beginning kind of just dumping their common stock to pick up the preferreds, and we'll constantly see this back and forth rotation? Is that destabilizing?
I think it'll happen. I don't think it'll be destabilizing. And the main thing is during the bull market, you'll just have so much more demand anyway. So, and remember the flexible load here, right? To use a Bitcoin term, right? The flexible load here is really just the ATMs. Like if a lot of people want to buy this thing, but then also a lot of people want to sell it, then the ATMs just won't run as hard. But if a lot of people just want to buy it and the demand is like gushing and overwhelming, then the ATM will run and run however high it needs to run, right? So that is how I think it is. Like the flexible load here is the ATM. And so I don't view that as a destabilizing factor.
Yeah, that makes a lot of sense. Allard, I've really enjoyed our conversation today. Is there anything that we missed? I want to encourage people to go check out your research report and to dig into it. But before we sign off, are there any major points that we didn't address?
No, I think we've covered a lot. We probably need like another hour or so to talk through like all the stuff happening on the protocol side. Like it's also
Yeah.
lots of stuff going on. But yeah, on the corporate side and digital credit, I think this has been comprehensive.
Awesome. Well, thanks for coming on the show, and thank you to our listeners for joining us for another episode of the Bitcoin for Corporations show. As we travel through this bear market, I think now's a great time to be learning more and absorbing kind of what's going on. So we hope you'll join us on the next episode, and don't forget to like, subscribe, leave a review, and share it with your friends and family.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Today, I am going to explain why investing in Bitcoin treasury companies can make mathematical sense even when the company is trading at a premium to the Bitcoin that they are holding. Now, this is very controversial to say because obviously, Bitcoin treasury stocks are down. Many people use price as their thesis for long-term investing, which is foolish in my humble opinion. Because every single time that somebody sees a premium, their brain immediately turns into a smoke detector with a dying battery. Why would you pay $1.39 for $1 of Bitcoin? You see this question asked many, many times. Why would you pay the premium just buy Bitcoin? Everybody constantly freaks out about this. Great question, Warren Buffett. Let me tell you why. The mistake that people in the Bitcoin community continually make, they treat a Bitcoin treasury company like it's a sealed Tupperware container filled with Bitcoin. You look inside of the container, you count the coins, then you compare that number to the market capitalization of the company, and then you declare anything above the net asset value to be financial necromancy. But common equity, the shares that you are holding, it's not a static pile of Bitcoin, so you are making a category error. It is a residual claim on the Bitcoin after the senior claims have been accounted for. That residual claim can change over time, it can grow, it can shrink, it can become dramatically more valuable as Bitcoin appreciates, and this is very easily measurable. You gotta understand, kids, you're not paying a premium for static Bitcoin. You are paying a premium for future growth of your residual Bitcoin claim, and Bitcoin going up can make that claim increase. And that distinction is literally pretty much the entire presentation, but I'm going to be giving real examples of why I love MSTR, why I love ASST, why I love the value proposition, because I can do basic math. I'm going to start with the most brutally conservative scenario imaginable. I'm talking no Bitcoin purchases, no preferred stock issuance, or capital markets wizardry, none of that stuff. I'm saying management spends the next 2 years sitting on their hands and Bitcoin just goes up over time. We will look at what happens to these balance sheets and what happens to Bitcoin, and then we will compare the two. And I will calculate exactly when the initial premium gets earned back, because premium isn't a moral category, kids. It is a mathematical variable into a much broader calculation that you have to make for yourself as you really think about your own risk tolerance and time horizon as an investor. Today, I am going to drag the lazy premium objection behind the spreadsheet barn and convert it into a tax loss carry forward, kids. You guys are going to love the video. If you could do me a favor, hit the like button, subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to the masses. Now look, if you're listening to the chicken gizzard Bitcoin wizard, I'm going to go ahead and go out on a limb and assume that you are bullish on Bitcoin or MSTR if you want to go a little bit more out on the risk curve. I would assume that you're either bullish on one or the other. What if you could get half of the upside of either Bitcoin or MSTR with your principal protected? That seems like a fascinating suggestion. That is exactly what my friends at Sovana are building. Every single dollar of your investment is secured by a title-insured recorded lien on U.S. real estate. You split the upside with the property owner whose home equity backs your own investment. If you've been waiting for a way to buy Bitcoin or MSTR that allows you to sleep at night, this could be it. And honestly, what better time to lock in a 5-year position when Bitcoin and MSTR are sitting in a bear market? If you are an accredited investor, use this QR code on the screen and get in line at sovana.io/capital. And you guys know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption that we are seeing. But don't lose sight of the fact that Bitcoin in 100% self-custody is the real revolution, and the Bitcoin way is more important than ever in terms of properly self-custodying your Bitcoin because of the recent cold card fiasco that we have seen unwind over the last couple days. My friends at the Bitcoin Way will really train you to properly self-custody your own Bitcoin. They will turn you into a sovereign Bitcoiner with the best possible security. Go to thebitcoinway.com/Adam to schedule a 100% free introductory call. The Bitcoin Way is your ultimate Bitcoin support team. Don't delay, your freedom depends on it. Also, if you guys are interested in getting the Swiss Vault for your Bitcoin, the Bitbox O2 Nova Bitcoin Only Edition is my cold storage wallet of choice. It is the Swiss Vault for your Bitcoin. There's a bug bounty program. So this company, they literally put out a bug bounty program where they reward people for finding bugs in their software, and it has been tremendously safe. No major security issues ever for the Bitbox O2 Nova, and these guys have been around for more than a decade. This is the sleekest, best Bitcoin cold storage wallet I've ever used. I literally plug it into my iPhone, transfer my Bitcoin over, and I can sleep at night very easily. Use code ADAMBTC for 5% off the Swiss Vault for your Bitcoin. Link is in the description below. So we're going to talk about why the math can work, folks. It's very simple. Let's look at the return identity of a stock price return if you are buying a stock instead of Bitcoin. Very simple. It's a multiplication problem. You take your Bitcoin return, then you take the common equity Bitcoin exposure return, the growth in that multiple, or the decrease in the multiple if Bitcoin goes down. This is amplified Bitcoin. Obviously, these things can go down more than Bitcoin when Bitcoin goes down. But then on top of that, you could also multiply it by a change in the MNAV. So those are the 3 different variables that make up a stock price return of a Bitcoin treasury company. This is mathematically undeniable. Now, obviously, your entry matters, of course, your time horizon matters. These are all things that you need to judge for yourself as you make an entry into any one of these stocks. That's why this isn't financial advice. This is financial entertainment, because I'm comfortable with the volatility of these things for 10 plus years, and I acknowledge probably not everybody is. But regardless, it's very simple. When they are levering the Bitcoin, when they are amplifying it by issuing preferred stock, those are senior claims sitting senior to the common stock on the balance sheet. Those are fixed in dollars. Those are not compounding, and the Bitcoin is compounding. So basically, when the Bitcoin compounds, your common equity Bitcoin exposure, that residual claim increases, because remember, the senior claims above you, those are staying fixed. The Bitcoin goes up, you inherit the spread, you get the difference. Now, that is how these companies can outperform Bitcoin with zero MNAV expansion ever. Because Bitcoin going up, you get that return, but Bitcoin going up also increases your residual claim because the senior claims are staying fixed. Therefore, Bitcoin going up is one engine working, and then also that one engine turning also turns this gear as well, the amplification. That is how your exposure is amplified. So the MNAV change, that can be a huge bonus if you bought at a cheaper MNAV. It can also suck if you buy at a higher MNAV and you don't have a long time horizon to wait for the other two things to compound for you. So that is why your entry matters. So what we're going to be talking about today is obviously you are paying a premium. Sometimes you're getting a discount, depends on where you enter, obviously. But right now, if you look at MSTR or ASST, now you are paying a premium to get access to this machine that can increase your residual claim. It's not just Bitcoin. That's why it's the category error. Now think about it this way. If you're paying, let's say, a 39% premium to the value of the Bitcoin, you got to think, okay, but if my residual claim goes up when Bitcoin goes up, how long do I have to wait before the premium that I paid is paid back to me? That doesn't require terminal MNAV expansion at all. And that's where this gets really interesting. So I went ahead and loaded up the Strive balance sheet as example number one. I posted this to X yesterday just as one example, but I decided to do some pretty bearish inputs, in my humble opinion. Crunch the math yourself before you buy any of these things. Remember, this is not financial advice. This is financial entertainment. If you're not bullish on Bitcoin, you're going to hate buying amplified Bitcoin. But this is just a hypothetical scenario, okay? Hypothetical, super hypothetical. I don't know that this is going to happen. I personally think it will. But Bitcoin, let's say it goes from $62,900 to $200,000 over 24 months. That means Bitcoin hits 200K in July or August of 2028. Now, I'm assuming that Strive doesn't buy another Bitcoin for 2 straight years. That's correct. They don't issue any more common stock or any more preferred stock. They literally sit on their hands and pretty much do nothing and just pay the dividends. And they pay those dividends by issuing common shares into the market. So you are being diluted. So the preferred balance is staying flat and the MNAV doesn't move at all. So we're going to answer the question, does paying that premium make sense? Well, let's look at it. So my point is, this really isolates the capital structure effect of the amplification, okay? I am correcting for all of those other variables like MNAV, expanding, share issuance. This is just what happens with the embedded amplification on top of the Bitcoin move. Even doing nothing outperforms Bitcoin. And this is what it looks like. So today you are paying a 1.39x MNAV premium to the common stock residual for Strive. Now, if you pay that premium and Bitcoin only goes up, there is that embedded amplification. Your residual claim increases. Your common equity Bitcoin exposure grows by 45.8% only by Bitcoin going up and to the right. Now, the common stock would be diluted by 9.4% to fund those dividends, but the common stock shareholders of MSTR and ASST, they understand that they will happily take this 9.4% dilution trade-off to get this level of amplification. So just in this one scenario with them buying 0 Bitcoin, no MNAV expansion at all, your premium is paid off literally within 15 months, literally month 14.3. So about 14 months and 10 days, that is your premium paid off from your residual claim increasing. And that is why you have to have a long time horizon when you are investing in an amplified Bitcoin treasury company, because you gotta give enough time for Bitcoin going up for the residual to expand, and then your premium is paid for. Now, obviously, we saw the MNAV expand to 1.8 2 months ago when Bitcoin went to 80K. So I'm not saying that the MNAV will stay at 1. Hardly. I'm not saying that at all. I'm just saying that the math works out if Bitcoin goes up. It's literally that simple. If you are bullish on Bitcoin, this math works here, and you got to be willing to wait for a little bit. Now, remember, this is corrected for those other variables. I am not saying that you will only beat Bitcoin after 14 months. I'm not saying that at all, because I think maybe they buy more Bitcoin, maybe they add more amplification, maybe the MNAV goes to a 2. I'm just saying this is how the common stock can outperform BTC with literally just Bitcoin going up. So it's very interesting. And this is the mechanism. It's very interesting. Right now, if you look at Strive's balance sheet, they have 20,000 Bitcoin, but obviously they are amplifying the common stock. If you actually just look at the amount of outstanding that is in SATA, their preferred stock, it's over like $780 million. Now, obviously, so what I like to do is to put that in Bitcoin terms, because you guys know that obviously you can take that cash and buy coin if you want to. That's what they do. I just like to put it into Bitcoin terms to make it very easy and digestible for people. We know it's in fiat, but remember, that's 20,000 coin on the balance sheet. So I like to separate it into senior claim coin and common equity coin. There's 20,000 Bitcoin on the balance sheet today, but if you actually look at the common equity Bitcoin after adjusting for the senior claim Bitcoin, there's actually only 10,699. But that's a good thing because they are adding the amplification, adding the senior claims while Bitcoin is so cheap right now. That's why I love this entry. So basically, you're going to see your common equity Bitcoin rise from 10,699 right here, and it is going to go up. As Bitcoin goes up and to the right, that means that this Bitcoin is essentially released to the common residual over time. And then you see the senior claim Bitcoin go down and to the right. This is the claim compression. This is common equity Bitcoin exposure 101. So your residual rises 45.8% after the dilution that everybody cries about. So let's talk about the terminal result over this one scenario. And it's pretty interesting because if you hold Bitcoin, if you buy Bitcoin today, it goes to 200K. That means you have a 3.18x return. That's all fine and dandy. Awesome return. That's fantastic. That's this white line here rounded up to 3.2x. That is the Bitcoin return. This orange line represents the modeled ASST scenario where you get a 4.6x greatly outperforming Bitcoin. Remember, with no MNAV expansion or buying more Bitcoin. So a sizable outperformance over the next 24 months if Bitcoin goes up by just sitting on the stock doing nothing because the amplification is already there. The trebuchet is loaded. And a lot of people like to talk about the premium risk. Oh no, but what if the premium collapses? Okay, calculate your MNAV break even because I just did. You want to know what's interesting? Even if the terminal MNAV, if somehow the MNAV of ASST goes to 1.0 after a move to 200K Bitcoin, yeah, I don't think that anybody actually thinks that'll happen. But even if it did, check this out. This yellow line right here, it still outperforms Bitcoin. So there you go. Obviously, if the MNAV went to a 0.9x after Bitcoin goes to 200K, then, you would underperform Bitcoin. And remember, that is if they buy no Bitcoin until then. That's up for you to decide how realistic that actually is. So in this scenario right here, Bitcoin goes to 250K over 24 months. So I added 50K to the Bitcoin price. That means that the premium paid back time horizon, okay? The time that you have to wait for when the premium over the Bitcoin NAV, it gets paid back in your residual growth, literally only 9 months at Bitcoin being $133.4 thousand. This is a 52.8% growth in your residual, and this is over a 6x while Bitcoin is only a 4x. So this is considerable outperformance over Bitcoin. And in this scenario, I still have the issuance machine remaining off. And even if the terminal MNAV is 1.0 after a move to $250,000 Bitcoin, it still outperforms Bitcoin on the way up. These are the numbers, folks. Remember, them buying no more Bitcoin, staying at 20,000. We still love the returns here, kids. And this is where it starts to get real fun if you are a Bitcoin bull and you want to hold it for more than 2 years, think maybe 5 years or 10 years. This is where my mind goes because I think Bitcoin is going to $1 million, not only 300K like this scenario right here. But let's say Bitcoin does go to 300K over 24 months. I don't think that's crazy. That's less than a 5x from today. I think that's totally doable, no question. And if you actually crunch the numbers about how much SATA they have issued since the IPO, their annualized pace is around $67 million per month. That's been the pace post IPO for them. So it's been a very successful, not even full year for SATA. It IPO'd in November. But in this scenario here, I'm assuming that let's say they turn that issuance machine back on, they issue less than their year one pace. So we're assuming that they slow down, only issue $50 million a month. They take that capital, buy more Bitcoin. Then the modeled terminal MNAV at the end of this projection, it rises to 1.5x. That scenario is almost a 10x return on your investment, while Bitcoin is only a 4.8x. That is more than double the performance of Bitcoin. And get this, even if the MNAV collapsed to 1, after Bitcoin goes to 300K, you still outperform Bitcoin 6.5x versus 4.8x. And your payback in terms of the premium that you paid today, it's paid back in terms of your residual expanding, it's paid back after less than 5 months. 4.6 months, Bitcoin at 108K. And the way I view it is like, okay, I want to hold this for a long time. After 4 months, wow, I'm home free. Now you can start to see the gears in your head turning. Wow, if Bitcoin goes up and to the right, amplified Bitcoin really does its job, doesn't it? And maybe you're more bearish on Bitcoin. You don't think Bitcoin's going to go to 300K in 2 years, but you think maybe 400K in 4 years is a more realistic scenario. Well, let's run it. Let's keep that same $50 million month issuance pace as the last scenario. Remember, that's less than their year one issuance pace. And let's say Bitcoin goes to 400K and the terminal MNAV goes to a 2x because let's say the MNAV expands because there's Bitcoin bull run mania. Obviously, it's not going to happen linearly like this. Bitcoin's going to be volatile. It's going to be a roller coaster. I'm not saying it's going to happen linearly like this, of course, but this is the math projecting forward what it would look like if it was a smooth ride. ASST would be a 19.1x in this scenario. And even if the terminal MNAV collapsed to 1.0, you would still outperform Bitcoin considerably, a 9.6x versus Bitcoin being a 6.4. Your premium paid back would be right after month 6 here. This would be a $213 stock when it's, just over $11 today. That's why I love the entry today. And let's just do a 5-year scenario. Let's say that you think it's going to be over $500,000, 5 years from now. This would be August of 2031. And let's say they still don't quite reach their year one digital credit issuance pace. Let's say they issue $65 million a month for 5 years. Do I think this will happen? I don't know. I don't really care. I like the returns just off of what they have now. But regardless, this would help them keep their performance amplified as Bitcoin goes up. If the MNAV went to a 2, this would be a 26.6x return. Now, if the MNAV went to a 1, the terminal MNAV, that is a 13.3x versus Bitcoin's 7.9x. So basically, the premium that you're paying today is paid back after 5 months of Bitcoin going up in this scenario. And the stock is diluted about 20.3%, but you get a 133.1% common equity Bitcoin exposure growth, lots of amplification. That is how you at least get that 13.3x return at that 1x MNAV scenario, but the multiple expansion on top of that, obviously, if there's a volatile upswing in the multiple, it's going to get crazy. And then, of course, let's say there's a huge bear market over the next 5 years too. Obviously, if you buy the top here and then the multiple compresses, but you're not willing to wait for those other 2 engines to bail you out over time, you're kind of screwed. So that is why time horizon really matters with these things. So that is all of those scenarios kind of lined up here when your premium that you'd be paying today is mathematically earned back. MSTR has a smaller premium today. ASST does have that 39.2% premium. And this is the return comparison across all of those scenarios. White is direct Bitcoin. Yellow is the terminal 1x MNAV return. And then orange would be the modeled MNAV return. I was changing that variable depending on the scenario here. But I do notice one thing. In all of those scenarios, ASST outperforms Bitcoin. This white dashed line is the premium payback threshold. These lines here are those different scenarios. And, obviously, depending on how long you wait, what Bitcoin does, depending on the scenario that unfolds, you would have to wait a certain length of time before the premium that you paid is earned back. But very clearly, all of those scenarios outperform Bitcoin. So we're going to load up the company terminal, and I want to tell you guys something here. Let's look at the cheapest CEBE MNAV right here. So if we sort all the Bitcoin Treasury companies by the cheapest premium, and technically, obviously, if this is a discount to the Bitcoin NAV, then you're not waiting a certain period of time for your premium to be paid back because you're not paying a premium. That is why I love MetaPlanet right now, folks. You guys know that I'm super bullish on them. I'm holding MetaPlanet for a decade minimum. I'm giga bullish on that company. But I just went ahead and loaded MetaPlanet right here, and their current common equity Bitcoin exposure MNAV is literally a 7% discount to the common equity Bitcoin exposure NAV. So even ignoring the senior claims on the balance sheet, just ignoring that, and you're only looking at the Bitcoin, the NAV that's backing each basic share, it's $1.68, but the stock is trading at a 156. So you're getting $1.68 of Bitcoin backing each share, but the stock is only 156. That is a solid 7% discount. Now, obviously, they're not as amplified as Strive is or as MSTR is. There's like a continuum basically of all of these different treasury companies, how the market's valuing them, how they're pricing the risk. Strive doesn't have any debt, so they can't really default because no debt is coming due, so that's pretty cool. Bitcoin would have to go to zero for them to be in trouble, pretty much. So you see the market assigning Strive a higher multiple because they have that better risk profile than the companies that have outstanding debt. That's what I think is happening. And even looking at Anthony Pompliano's ProCap, it's trading at $1.70, but this is very interesting. The common equity Bitcoin exposure MNAV is a 0.59x, so you're getting Bitcoin exposure at a 41% discount, which is crazy. And on top of that, they are somewhat amplified because of this 24.6% claim ratio. About 1,330 Bitcoin is senior claim Bitcoin. Look at that, $2.89 of Bitcoin backing each share, but the stock is at $1.70. So if the market starts to price this as at least the value of their assets, and then on top of that, valuing the Sylvia operating business, I kind of like ProCap as an entry here too. None of this is financial advice. Nothing is financial advice. I'm just talking about how I view things here. But anyway, this seems super cheap in my humble opinion. And honestly, I think all of these companies, MSTR, Strive, ProCap, MetaPlanet, all of them super cheap because Bitcoin is going up forever, Laura, and all of them have some leverage on their balance sheet. So if they can survive the leverage, whether it's convertible debt or preferred stock, as long as they can meet their obligations and survive the terms of their leverage, I can't be anything but bullish given the math that I just went over in this video. So that is why I love Bitcoin treasury companies. I hope that you guys found this educational and entertaining. Keep fighting the good fight. Some people pretend to not understand this because they are bad actors or they are literally just little clown people. My name is Adam Livingston. I am the Bitcoin Wizard. Please like the video, subscribe to the channel if you like the content. Have a terrific day. Do not party too hard. Class dismissed. This video is sponsored by Sovana, and if you are interested in gaining Bitcoin upside while keeping your principal protected, Sovana may have built the most aggressively bullish product available for people who still enjoy sleeping at night. Yes, you as an investor can receive 50% or more of Bitcoin's appreciation with uncapped upside, while the structure is backed by the Bitcoin position itself and a lien on U.S. investment real estate. Basically, Sovana is putting Bitcoin in body armor. You still get the moon math while your principal has a rental property standing behind it with a baseball bat. If you are interested, scan the QR code or use the link below. Sovana will help you every single step of the way. They will answer your questions and explain exactly how the structure works. Requesting information carries zero obligation or commitment. Go to sovana.io/capital to buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it. Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Today, we are going to be discussing why I am buying Bitcoin like an absolute madman right now, like a guy who just received credible intelligence that Dollar General is closing down and the final pallet of Busch Light has been marked down 40%. I'm not going to be delicately nibbling on Bitcoin, kids. Clarity can arrive whenever it feels like showing up. I am buying Bitcoin hand over fist right now. The mission is very simple, kids. Right now, Bitcoin extremely cheap, just over $63,000. We're dealing with this cold card hack fiasco. Half the world thinks that Michael Saylor is on the brink of a forced liquidation. Everybody is losing their minds, and if history tells you anything, now is the buy signal. But today we're going to be talking about the Federal Reserve rate cuts, the perception of increased liquidity, and what that does to Bitcoin's price over the next year or so. I am extremely bullish. bullish. Because if you did not know this, Bitcoin itself, it's a monetary bloodhound that lives behind a Waffle House dumpster, and it's an animal that can just smell fresh incoming liquidity before the Federal Reserve even finishes the meeting agenda, okay? The official policy of the Fed, it always arrives later. The expectations move first, and Bitcoin always trades the expectation, which is very interesting, and this is actually backed by actual analysis and research. So everything in this presentation is going to build from that one idea, using the Fed history, Bitcoin price data that I assembled, forward rate expectations, and formal research on how violently Bitcoin responds to perceived changes in the monetary policy of the future. This is no male astrology, kids. There are no rainbow charts here made by some guy microdosing in a Miami Airbnb. Today, I'm going to be explaining monetary policy to normal people and how Bitcoin reacts to perception of what is going to happen. This is a fascinating subject matter, kids. Please hit the like button, subscribe to the channel if you have not. And by the end of this, you will understand why summer 2027 could become a major Bitcoin acceleration window, and why waiting for a televised rate cut from the Fed could leave you standing outside of the move with a savings account and a deeply stupid expression on your face. And look, kids, if you're listening to the Bitcoin wizard Chicken Gizzard, I'm going to go out on a limb and think that you think that Bitcoin is going to moon over the next 5 years. So this is what's very interesting. My friends at Solana can give you half of the upside with your principal protected. That's what my friends at Solana are building, every single dollar of your investment being secured by a title-insured recorded lien on U.S. real estate. And you split the upside with the property owner whose home equity backs your own investment. If you've been waiting for a way to buy Bitcoin that allows you to sleep at night, this could be it, and what better way to do it when Bitcoin is this cheap from the all-time high. If you are an accredited investor, use the QR code right here on the screen, or you can get in line at Solana.io/capital. And you guys know how excited I get about Bitcoin in self-custody, but the reality is you need help right now because self-custody is under attack. Right now, more than ever, you must partner with the Bitcoin way to take 100% self-custody the safe way. You need a partner in your self-custody journey to make sure you're doing it safely. My friends at the Bitcoin way will train you to be your own bank the safe way. You can scan this QR code here right now or go to thebitcoinway.com/Adam to schedule a 100% free introductory call. Do not wait. Your freedom depends on it right now. So this is the central idea of today's video. A lot of people don't know this, but Bitcoin prices the future path of dollar liquidity rather than merely staring at today's policy rate. Now, that distinction is something that a lot of people really don't understand because people haven't done their research. The Federal Reserve controls a short-term interest rate target. Now, you know that target, it leaks into mortgages and business loans and credit cards, treasury yields, currencies, and the discount rates that investors apply to every single asset that's on Earth. We know that higher rates, it makes money more expensive, and then cash becomes more attractive, and then borrowing costs rise. So when that happens, every single investment that you can make, it faces a taller hurdle. Lower rates generally reverse those pressures. That's why everybody on Earth is begging for rate cuts right now. But we know that financial markets are forward-looking, okay? Markets anticipate things. Every single trading day becomes an argument about where rates will be in 2 months, in 6 months, in 12 months, or 2 years from now. And that is why the 2-year Treasury yield, the Fed funds futures, real yields, and the expected policy path matter so much, because they reveal where investors believe the policy is headed. And Bitcoin is in this very unique position because it trades globally around the clock without a quarterly earnings call. So what remains with Bitcoin is almost pure monetary optionality. We have a scarce bearer asset that stands across the ring from a currency system that is continually expanding its own supply and then repeatedly adjusts the price of money. So naturally, Bitcoin is very extremely sensitive to changes in the expected availability of future liquidity. So let's look at what happened in 2023. On February 1st, the Federal Reserve raised its target rate range to 4.5 to 4.7 0.75%. Cuts were nowhere in sight. A gentle monetary spa day had begun. You see, policy was still tightening between February 1st and July 26th. The Fed added another 75 basis points, eventually reaching 5.25% to 5.5%. Now, during that exact final hiking leg, Bitcoin rose 24%. This seems counterintuitive. Sit with this for a second. A simplistic model. What is the narrative in the market? They say that higher rates crush Bitcoin. They always say that, don't they? Under that cartoon version of reality, Bitcoin should have been lying face down in a drainage ditch behind a rent-to-own furniture warehouse. But instead, the Fed raised rates 3 more times and Bitcoin climbed. That result does zero magic for the idea that hikes themselves create a bull market. Rather, it really shows that Bitcoin had begun looking beyond the current hike. Yes, it looks beyond. It's forward-looking. Bitcoin is showing hypersensitivity to the perception, the idea that the Fed is about to cut rates. So by early 2023, investors, what did they do? They watched one of the fastest tightening campaigns in modern history. People stopped asking the question, is the Fed hiking today? And then attention moved forward, and then they started asking how much tightening remains. And that shift matters quite a lot because the central bank still had its foot on the brake while Bitcoin began pricing the approaching end of the breaking cycle. Just picture a man continuing to eat dinner at Golden Corral while quietly loosening his belt. His dinner was remaining active, but the direction, however, had become very obvious. Bitcoin was no longer reacting to the printed policy rate. The price starts discounting the regime that might follow, and that is the behavior that I care about right now in August of 2026. And this is where the sequence became completely psychotic, because the Fed reached its peak target range in July of 2023, slightly over 3 years ago, and they held it until September of 2024. Yes, more than 14 months later. So for more than a year, the official policy range sat at 5.25% to 5.5%. On September 18th, 2024, they finally delivered their first cut, a 50 basis point move. And by that moment, Bitcoin had gained 165% from its February 2023 level. So absorb what that means. Most of the monetary policy repricing happened before the official pivot happened, okay? Bitcoin never waited politely in the lobby for it to happen. The price front ran the change, and then November arrived, and do you remember? Bitcoin stood roughly 300% above the February 2023 level. By then, Fed cutting rates actually functioned more like a receipt than a starting gun. Groceries were already inside of the trailer. Now, obviously, several other catalysts clearly mattered. I'm not saying that Bitcoin moved just because the Fed cut rates and people front ran it as well. I'm not saying that in the slightest. We know that the Bitcoin ETFs were launched, the halving happened. We know that there was lots of positive sentiment in the air around the strategic Bitcoin reserve, the election, what strategy was doing at the time. I'm saying that the stronger interpretation about what happens really combines all of these forces. Monetary expectations creates the macro backdrop, kids. Dry timber met a flamethrower and then Bitcoin exploded. This is just showing you that Bitcoin can complete a huge portion of its repricing before monetary easing becomes official. And the people who bought Bitcoin before there was clarity about this, these are the people that actually made money in the market. And you guys might think I'm making this up, but no, there was a paper that was published this year. It was a 2026 study titled, "Is Bitcoin a Hedge Against Central Banking? Evidence from AI-Driven Monetary Policy Expectations." It separated the actual actions of the Federal Reserve from what investors believed the Fed would actually do. Researchers analyzed 118,479 market messages from the year 2014 to 2025. Then they classified those messages as hawkish, neutral, or dovish, and then they converted it into a monetary policy expectations index. And what did they find? Now, obviously, you guys know that hawkish means that investors expect tighter money, maybe fewer rate cuts, higher rates, or a a longer period of restriction. Dovish means that the markets expect easier money, lower rates, more cuts, or more looser financial conditions, just to clarify for those who don't know. Now, the key results here is very powerful for Bitcoin investors because this was a study looking at messages over 11 years, and they found that hawkish monetary policy narratives, they predicted weaker Bitcoin returns even when the federal funds rate stayed totally unchanged. So that means expectation alone carried lots of information. That is the perception piece that I was telling you about earlier. In addition to that, short to medium horizon tests also showed that the expectations index contained predictive information about Bitcoin returns. Now, translated into human speech for you, a Fed official can move Bitcoin without even touching the actual rate. You see, markets simply need to become more convinced that future policy will stay restrictive. Bitcoin reacts to the perceived future path. This is the best measurable version of the vibe. Within this study's model, the monetary policy expectations ranked among the most influential Bitcoin predictors. This here is comparing Bitcoin to silver, gold, S&P 500. You see the absolute response coefficient to the future rate path surprise. The researchers, they describe Bitcoin as a hypersensitive barometer of global liquidity conditions. And the reality is academic prose rarely gets that close to saying this asset is the first meth-addicted raccoon in the financial dumpster to hear the garbage truck coming. And I have another source for you. Listen to this. It will probably blow your mind. An earlier New York Fed staff report examined surprise changes in the expected future policy path during Fed meeting events. Their baseline estimate showed that Bitcoin responded more sharply to any other asset to the future path surprises. A one standard deviation policy surprise was associated with a roughly 0.6% Bitcoin move within 30 minutes. That is extraordinary sensitivity over a tiny window. And that sample was looking at 47 different Fed meetings and what Bitcoin did after them. So let's bring this argument into the present, because anybody who's anybody knows that we just saw the Iran war start in February, and then slowly but surely, if you look at poly market, the entire market started pricing rate cuts totally out of the equation for the rest of this year. At the last Fed meeting, we just saw that they held their target range at the exact same. No cuts, no hikes. They are holding steady. 3 members specifically preferred another 25 basis point hike. That is what we call a hawkish setup. What are they saying for their justification? They're saying that inflation remains above the Fed's goal. Economic activity still has life. Several policymakers right now, they are believing that more restraint may be necessary right now, given the economic conditions that we're currently in. Now, at first glance, Bitcoin bulls like myself, they see a hostile environment when they look at this. Right now, we are where the average cable news viewer, they hear hike and then they panic sell everything, and then they begin stacking canned chili in their basement beside a broken Bowflex. The forward path return tells a much more interesting story. The June 2026 projections placed the median appropriate Fed funds rate about 3.8% by the end of 2026, 3.6% by the end of 2027, and 3.4% by the end of 2028. You have to look at the shape rather than the first point here. The near-term policy can stay restrictive. One final hike can still happen, but beyond that window, the median path here, you can see it on my graph, it slopes downward. Now, obviously, probably more than anything in life, Fed projections deserve skepticism. These forecasts come from these ghouls in suits who always miss inflation and growth and labor market turns while wearing their suits that are more expensive than a used bass boat. Even so, direction matters obviously. The official median view, it currently suggests restriction now, possible extra restrictions soon. Now that sequence creates a setup, kids. Another hike might hurt in the short term. Once markets decide that the final hike has passed, every softer inflation print, weaker employment report, or deterioration in credit conditions start pulling expectations in the opposite direction. The last hike, when it happens, will it tighten financial conditions? Absolutely. But remember, at the same time, it may contain information that the tightening campaign is almost finished. So let's say the Fed stays hawkish through 2026. Rates remain restrictive, a final hike stays on the table, Bitcoin just continues to churn through this bear market. It frustrates people, it tests their conviction. But then the market sees the end of the tightening cycle. The hawkish news starts to lose its power, and then markets begin learning that the marginal tightening risk has already been absorbed. And then inflation, employment growth, or credit conditions start to soften. We already know that Chairman Warsh, this fella, he's starting to define inflation differently. And the Fed really doesn't want to give forward guidance anymore. What's that telling you? No immediate announcement is required. The 2-year Treasury yield begins falling. The Fed funds futures start pricing in more cuts. Real yields drift lower. The dollar strength fades. And then the expected policy path drifts downward. Now remember, what does research tell us at that stage? Bitcoin's hypersensitivity becomes the entire story. The Bitcoin price starts rising while the Fed officials still sound restrictive. This is why accumulation time is right now before the Bitcoin price reacts. So this is the timeline that I'm watching now through the fourth quarter of 2026. Yeah, maybe the Fed stays hawkish. Maybe rates remain restrictive. Another hike, totally possible. You have 3 Fed members voting for it. Bitcoin continues to test everybody's conditions. We might see some ugly volatility. Failed breakouts can happen, maybe some relief rallies. I don't know. I don't really care. I'm buying Bitcoin for the long term. But I really think in the next 6 months to 12 months, we really can see some expectations start to turn. Labor market data, it matters. We saw Bitcoin react to the latest 2 inflation reports 100%. But I really think a few several aligned data points can shift the entire expected distribution of future policy, and Bitcoin is more sensitive to those things than any other asset. We're going to start to see over the next year the market collect evidence to believe that additional tightening is ending and eventual easing is becoming more and more probable. And the reality is, if Bitcoin merely rhymes with 2023, you get some pretty crazy price targets here. A 150,000 Bitcoin price to $167,000, this really isn't moon math. This would require a strong rally from today, yeah, but the percentage gain would definitely remain inside territory that Bitcoin has already traversed during a late tightening to easing transition. This is something that we've seen before. We've lived through this before. And this cycle has stronger demand infrastructure because we have spot ETFs now. We have institutional custody, more popular than ever. It runs more deep. Public treasury company adoption is totally expanded. We see strategy buying Bitcoin hand over fist this year. So I really think of this backdrop as creating even more asymmetry, but the market's pricing this like it's not even going to happen yet. You have to get in when things are asymmetric, because from the beginning of this year, remember what the narrative was literally from the end of 2025 into January of this year? Fed cuts were totally on the table. They were expected. And then the war broke out. And ever since then, we have not seen a single headline about a potential rate cut. That has totally gone by the wayside. So you got to think, Bitcoin's perception of that possibility, Bitcoin reacts to that perception very positively. Right now, we need to be getting in before the perception is even there. This is not financial advice. This is financial entertainment. I just got to say, you have to buy when things are uncertain to receive the asymmetry. Perfect bottom picking adds very little to the thesis, kids. I don't care if we're going to wick down to 56K in September or October. I don't care at all. My argument is that future liquidity expectations drive Bitcoin's price. This is something that is demonstrable. This mechanism produces violence. And I would rather absorb volatility right now while accumulating than spend 2027 or 2028 explaining to my daughter that dad almost bought more Bitcoin, but he got scared because a man named Steve on Bloomberg said the neutral rate had moved upward. The objective is to retire the bloodline, kids. I could not be more bullish on Bitcoin, and I want to buy before clarity is here. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this video, please do me a favor, like the video on YouTube, subscribe to the channel. That way you can support me spread the orange orange gospel of Bitcoin to the masses. Have a very terrific day, everybody. Do not party too hard. Class dismissed. This video is sponsored by Solana, and if you are interested in gaining Bitcoin upside while keeping your principal protected, Solana may have built the most aggressively bullish product available for people who still enjoy sleeping at night. Yes, you as an investor can receive 50% or more of Bitcoin's appreciation with uncapped upside, while the structure is backed by the Bitcoin position itself and a lien on U.S. investment real estate. Basically, Solana is putting Bitcoin in body armor. You still get the moon math, while your principal has a rental property standing behind it with a baseball bat. If you are interested, scan the QR code or use the link below. Solana will help you every single step of the way. They will answer your questions and explain exactly how the structure works. Requesting information carries zero obligation or commitment. Go to Solana.io/capital to buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own, Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
What did you make of this cycle's DATs, as they were called, or Bitcoin Treasury companies?
Yeah, I think they're great things in the DAT space and terrible things in the DAT space. If all you're doing as a DAT is what I'm doing as an ETF, you shouldn't be in business. Which is to say, if you're just buying Bitcoin and putting it in a corporate wrapper that's then illiquid because you can't get your Bitcoin out, well, my ETF is better than you. But that doesn't mean they're not great things in the DAT space. If you bought Bitcoin and are sitting on substantial gains, and then you create interesting financial products against that built up equity position like MicroStrategy is doing, I can't do that in my ETF. And that is novel and useful for investors, and I think you'll succeed. If you're holding Bitcoin as permanent capital and doing things like lending it or utilizing it in interesting financial services, I can't do that in my ETF, and I think that'll succeed. So I suspect the future of DATs is like some of them that are doing hard things well will succeed. And the ones who just tried to jump on the free money train both will and should go out of business, because that's not, you don't make money by doing something easy. You make money by doing something hard. And so I think we're going to see a differentiated outcome from the DAT space. But are there legit DATs? Of course. And I think they'll persist for a while.
Now, you mentioned kind of the flexibility with the ETF of create and redeem. What's the current status for in-kind create and redeem, especially when it comes to like retail investors, for example?
Oh, great. A great differentiation. So institutional investors, authorized participants, actually can do in-kind creations and redemptions. Bitwise did the very first one, I think 6 or 7 months ago, and now we do them relatively regularly. There is still a step to take to get to retail creation and redemption. It's really important to me that we get there. And there are a few ways that it might be possible. One way is just to brute force it through the existing system. There is one gold ETF called Ounce, OUNZ, that if you redeemed it, you could get gold bars delivered to your house. So it's possible, but there's some real challenges doing that with crypto from an AOL, KYC, wallet verification perspective. The other interesting angle to me is if you can create tokenized parallel shares of an ETF and redeem through that tokenized version. And look, Bitwise is committed to pursuing this to the end. That doesn't mean we'll be first, but we really want to do it because I know a lot of people buy the ETF because it's easy, but it is a financial instrument. So it's not the same as owning Bitcoin yourself directly. And I would love to make it easy to buy and then easy for you to get it if you want it, to hold it in self-custody. We are working on it. It's challenging, but we were really working on it.
Yeah, that's really interesting. So for the institutional use cases, kind of what motivates wanting to use in kind versus going the cash route?
Yeah, there are a couple of reasons. So one is there's a mechanism for authorized participants to help wealthy investors who have large self-held Bitcoin positions in-kinded into an ETF in a tax-free manner, so they can transmute their shares into an ETF. You might wonder, why would they do that? One reason is when they're an ETF wrapper, it may be easier to get loans against them in the traditional financial system, or you may get better service because you have higher AUM, or it may be easier to pass down to your heirs. There are a variety of reasons. So one way the in-kind works is to facilitate that kind of in-kind tax-free transfer into ETF shares. The other reason is, look, like an authorized participant may find it cheaper to in-kind Bitcoin than to do a cash creation where they send us cash. When they send us cash, we have to go out and acquire the Bitcoin. It has to be deposited in our account before we release and undo the shares. So there's some lag in that system. So sometimes it's just slightly more efficient. In the traditional ETF world, for what it's worth, stock, bond, etc., ETFs do both. Most of them are in kind. So most of the equity ETF creations and redemptions are in kind creation and redemptions. It's a little bit odd that crypto started with cash. It did it for regulatory reasons, for what it's worth. And so over time, I suspect more and more of it will become in kind.
Yeah, that's really interesting. And then do you think that, are you an ETF maximalist? Do you think that you're going to take volume away from spot and from other ways people buy Bitcoin?
Yeah, that's what we've seen. So what we've seen is actually, like, the number of trades in ETFs now sometimes exceeds the number of trades on chain, which is a remarkable fact. I hope that there is a healthy mix. That's my ultimate view. In something like Bitcoin, particularly where the underlying itself is liquid, ETFs are just additional liquidity. But yeah, I mean, it's functioning a little bit like a layer two for Bitcoin, which is an embarrassing thing to say, not something I ever thought would happen, but that is what's happening. You're seeing small scale transactions on the ETF layer, and then larger transactions on Bitcoin itself. I don't think they'll all move to the ETF layer. People still want Bitcoin and they want it directly. I think it's net additive is my overall view in the end. For what it's worth, I'll tell a fun ETF story since I'm in ETF history mode. When gold ETFs launched in 2004, everyone was worried that it would destroy the physical gold trade. People would just buy the ETF. They wouldn't buy bars and coins, etc. Actually, what the data showed is the number of people who bought physical gold grew dramatically. And the reason was that the ETF, while it took share, it dramatically increased the number of people who owned gold at all. And once you own gold in an ETF, some portion wanted to self-custody their gold. I suspect that's the same here. So ETFs have financialized Bitcoin, but they've also dramatically grown the market. And I think you'll see the number of people who self-custody Bitcoin in absolute numbers also dramatically grow. And therefore, you'll also see transactions on Bitcoin itself also grow, just because it makes the market so much bigger.
Digital credit has not yet seen a full maturity cycle yet. It is under stressful situations that the true test of the market really would happen, and that has not happened yet.
For the first question, when we say digital credit, what are we actually describing, and why is it becoming an important part of Bitcoin's capital market right now? And maybe start with you, King.
Sure. I mean, if you look at Strategy, which obviously has developed the whole space for us, they've gone through this evolution of credit instruments, starting with margin loans, which were a great instrument in 2022, then convertibles, and then trying a number of different pref securities, really ending up with Strive, which obviously Saylor calls his iPhone moment. And at its core, it's basically a Bitcoin Treasury company has a pristine asset on the balance sheet, Bitcoin, and issuing credit against it. I do have to say that there are clearly a couple of, call it, definitions which are somewhat hybrid, because when you say digital credits, the pref securities are technically an equity and they pay a dividend, which is not feature of a credit instrument. So I think there is some of that probably also in the market leads to sometimes a bit of called confusion, call it. But as we're developing the space, I think that's key to clarify some of those things. But clearly, why is it important? Because it allows essentially growth of the ecosystem, and for credit investors who have a different risk profile to access in a way Bitcoin, and for those dollars to go into Bitcoin.
And I think yeah, if I could just add, I think they're particularly relevant now, right? Because as MNAVs have been shrinking, so the premiums are getting compressed. The ATM isn't working anymore, so just issuing more equity to raise money isn't working. So digital credit is a way then to raise it another way.
Rajiv?
Yeah, I can share and I agree with both these definitions, but I think I have two definitions. One is, of course, the usual one. For us, digital credit is where institutional debt is being settled on chain, which is happening a lot. But I think the definition that would be more relevant for the theme of this event and conference is digital credit would be debt where an unbacked crypto like Bitcoin is literally doing all the work as collateral, or as an exposure or as an economic exposure on the balance sheet. And it's important to understand how these two different types of definitions are recently starting to integrate with each other in a way where Bitcoin is being used as collateral for more institutional kind of assets. And one of them is the recent example where Moody's did assess and rate the Bitcoin-backed muni bond out of New Hampshire. And it's important to highlight that on one side, you have this highly volatile speculative asset like a Bitcoin. And then on the other side, you have this most conservative vertical in the financial space, muni markets, and how they both have come together in this issuance where the structure is what was underwritten, not really the collateral, and the over collateralization of Bitcoin with proper triggers and liquidity triggers put into place, thereby offering the relevancy and the rigor of the institutional finance space, allowing Bitcoin to become more institutional. And that is one kind of an example, along with a lot of other digital asset treasuries, where Bitcoin is being bought and held on the balance sheets, and the treasury strategy is the digital asset treasury strategy is about finding ways to generate yield and liquidity using that static asset on their balance sheet, which is sitting in a cold wallet somewhere. So I think the strategies are evolving as well. And as more and more institutional and crypto worlds start talking with each other, maybe Bitcoin as a collateral, that will lead to more and more digital credit being used as institutional capital and also allocation of capital in the institutional space using crypto assets.
That's a perfect segue into our next question, which is really about who is digital credit for today, and where is it going to go in the future? Is it primarily a way for Bitcoin native investors to seek income, or a bridge for more traditional institutional investors who want exposure to Bitcoin linked economics without taking on the full volatility? Although recently we've seen quite a bit of volatility.
I was just going to say, I think both really, and I guess that's the point. I mean, I think for Bitcoin natives, they're getting an income. They're actually getting something, and not without actually having to sell any sats. They're still betting on the power law holds, like the power law, similar to what we saw in the keynote this morning from like with the 200-week moving average and those bands. We're betting on that the price is going to at least stay within those bands, but reducing volatility, right? So we're basically placing a bet that the price is broadly going to go up, but we're not going to suffer that same volatility as if we were following Bitcoin directly. And I think for the institutions, then they're getting some Bitcoin exposure, but again, not at the crazy kind of volatility that would otherwise scare them.
King?
Yeah, maybe to add, obviously the yields being offered by, for instance, Stretch and SEDA are much, much higher than you can get in traditional financial fixed income instruments. So for institutional fixed income investors that are yield hungry, I mean, it's clearly you have a very low rate environment in Asia and Japan, but also in Europe, it is an attractive instrument. So you got to have an institutional investor that's comfortable with that exposure and that risk, but also looking for higher yields. And I agree. At the same time, it is also for retail a large instrument. And I like to think that's a combination of existing called investors that already have exposure to Bitcoin, but maybe also getting some new ones in that want a lower risk profile, and maybe over time graduate to also owning Bitcoin outright or treasury companies outright.
My take would be two types of audiences, and I think they were both covered. One is, of course, the Bitcoin native audience looking for capital efficiency, which they get if they try to find alternative ways to generate yield, which King said. And the other one, which was mentioned earlier, is the institutional side, where they get exposure or they can invest in Bitcoin without directly holding spot BTC, or even getting exposed to the direct volatility of the Bitcoin as an asset. So they would rather prefer doing that, which writes off the risk, but they still have access to the Bitcoin. So absolutely agree with both those points. And from a credit perspective, I think both those aspects are very important to look into. Of course, for us as a credit rating agency, we look at the institutional aspect more than the blockchain, the Bitcoin native one. But how the Bitcoin native audience or the exposure impacts the institutional side is equally important now.
It was reported in the last strategy earning calls that I believe 80% of Stretch holders are retail, and the question that came to mind for me is, what is it going to take for larger pools of capital, institutions, to really dive into digital credit head first in a serious way? Is that track records? Is it ratings? Is it standardization, liquidity, disclosures, education? What is it going to take?
Go ahead.
Maybe quick off there, thank you. So I think it's a combination. Certainly all the elements that you mentioned are very important. We've clearly seen some stress in the ecosystem in the last week. So cash reserves will be important, track record, how it develops. But I think at a broader level that this turns into an asset class, because once it becomes an asset class, it becomes unavoidable to invest in. At the moment, it's really two products, right? Again, Stretch and SEDA. But the moment you have an asset class and you have a number of swaps on it, derivatives, people can trade the curve, different issuers, currencies, then it becomes really, really investable for a very large pool of capital. Even though 10 billion is fantastic for a Stretch, it's obviously still quite small in the whole income scene. So I think to me, we're still the first innings of this asset class developing, literally a year old, really, and we need to build it in that sense.
I was going to say all of that. I agree, but if I were to rank them, it first would be standardization, which I think is very important and missing in the digital finance space across the board, but also in the crypto world, like Bitcoin and other unbacked cryptocurrencies. And the way that, and we as a credit rating agency think that credit ratings can standardize some aspects of the ecosystem, because a lot of credit committee discussions at institutions are driven by the credit assessments of the assets that need to be allocated. And that's why we think if we are able to somehow integrate with whatever blockchain the assets are being issued and be able to provide credit intelligence directly embedded into the asset or on the blockchain itself, that will solve a lot of these decision-making issues that probably some institutions are seeing when it comes to allocating capital in the digital space. And we are probably currently the only one that are able to integrate with Canton Network, Solana, and we are scaling that because of that very aspect. But also, I think what is important is the lack of history right now in the space. And what I mean by that, the track record, besides everything that you listed, is because the digital credit has not yet seen a full maturity cycle yet, because it is under stressful situations that the true test of the market really would happen, and that has not happened yet. So as we see digital credit evolve and that maturity of the assets and assessments with credit associated with them and the capital being allocated and how under stressful situations they stand, that test is going to be the real driver or the real solution to then understand what kind of digital risks that we were looking at and should be looked at in addition to what we have, and what other guardrails and frameworks need to be built in order to avoid those kind of situations which probably happen in the market. So that one track record is also another piece that is very important and is currently missing, but that will only happen over time and can't be just made up because we need one.
The stressful situation, I'm not sure if I can take another one like the one we've been having for the last week. I think also I would add to both your points there, also education, right? We're seeing half the market can't even distinguish these things between stable coins or Bitcoin proxies. So we're trying to help with that, to help educate the market, explain what these instruments are, how they work, provide tools, simulators, so you can sort of simulate what will happen according to different events of the company that's backing them and so on.
Amazing. Going back to the idea of risk, how should investors be thinking about the risks of these instruments, both on the Bitcoin side and the issuer side? What are the most important things that they need to understand and evaluate before potentially investing?
I would begin with coverage, right? So can the issuer, do they have the ability to pay the dividends? What are their fiat reserves like? Their Bitcoin reserves, if they have to go for that. If they start eating into their Bitcoin reserves, what's going to happen? Do they have an operating business that can support the dividends? So yeah, finding out like the financials of the company and their ability to cover. I mean, when you're buying, say, MSTR, you're buying an equity in a treasury company. You're betting that Bitcoin is going to go up. That's basically what your bet is about. When you're buying Stretch, then you're betting that strategy won't fail, right? So long as the company manages to keep going and it can serve its dividends, then you're good.
I mean, from a credit risk perspective, I think one fundamental doesn't change is the quality of the assets and the segregation of those assets. In a bank remote account as well, that's very important and the safest way to look at how the structure of the asset is then built on top of that. The second most important part is the legal enforceability that needs to be linked to the token version or the crypto version of the asset as well. So if it's an unbacked crypto like Bitcoin, it's also important that if you are currently holding a claim to a specific Bitcoin or a spot BTC or something else, does that claim actually stand in court, or you can assert it in a court of law? And that's really not been tested either. So the legal enforceability from a credit view is very important. And then, of course, governance mechanisms, the new mint and burn mechanisms, smart contract controls and designs, and the other technology risk, platform resiliency, the regulatory aspect, everything comes into play with that. But those are some risks that need to be evaluated from a digital credit perspective. And of course, I'm talking from an institutional debt, but that would also apply to a more Bitcoin native treasury or an asset class where we have to look at the collateral aspect and the legal enforceability aspect for sure.
Maybe one thing to add is if you look at digital credit compared to gold standard credit, TradFi credit, obviously the big difference is the volatility of the underlying asset class. And I think most of the digital credit issuers so far are also sized correctly, right? They have very low leverage, 10, 20% at the current environment, which really allows for a big drawdown, right? So I think that inherent volatility in Bitcoin is important to take into account for if you think about risk as a potential investor, and how that stacks up against the capital structure.
Also, in the earnings call, it was pretty clear that strategy is thinking about the potential products that could be built on top of Stretch or the other preferreds. In your mind, what are the opportunities here, and what do you think will be successfully built on top of stretch or SATA? What opportunities are here?
Yeah, I have to kick it off. I think there's always the two ways. There's a TradFi way and there's a DeFi way. DeFi is always very quick to develop, which is great. So we've seen certainly two issuers on top of Stretch, and that gives an easy tokenized access to Stretch. Then obviously there's a levered version of that. So it's almost like called the CDO or CDO squared maybe even, where they strip the coupons in a senior and a sub piece. So I think, as with always these things, it's very important to structure in a way that can withstand different shocks. And we see some of them right now, so it's a good test. And certainly, I think that ecosystem will flourish because it's a very solid underlying asset base. If they're well structured, it could really grow. And again, continue stripping. It's all about creating a curve, right? Creating stripping again, being able to allow different risk preferences for different investors.
I guess we'll judge the candidates. I'm not really sure what products will come next, but I mean, in terms of how we'll judge those, I'm going to be looking at, do they provide more transparency or liquidity versus just leverage? And I'm a little bit wary of just stacking leverage because I kind of feel like these digital credit instruments, I mean, they are like deleveraging instruments in themselves, like compared with pure Bitcoin or Treasury. I think most of all, I just want to see things that bring broader access, right? So getting inclusions in indices, ETF wrappers, those kinds of vehicles that will get broader access, basically.
I have nothing to add on this. I agree.
Well, we only have 2 minutes left, so maybe we could wrap up here. This conversation is about digital credit and the frontier. And let's say 5 years from now, we're at this conference and we're having the same conversation and we look back. What had happened in those 5 years in order for us to say, yeah, digital credit was the frontier, it was the future, it was the future.
I hope we'll be here, and there's a lot of width and depth, right? So lots more issuers, currencies, maturities, as you said, a whole curve than trade, but also depth, so a much deeper liquidity, much bigger size, potentially some different structured products on top of that. So really, like I think we're good at in general in the space, is taking the best of traditional finance and putting it on on digital assets, with hopefully again with the best practices and avoiding some of the pitfalls.
And I guess, I mean, all of that, and I guess if basically it stops being a crypto story and more like a fixed income story, right? Then that'll truly be success. When it basically becomes boring. Essentially, you've got an institutional allocator sitting there at their terminal comparing digital credit instrument with a corporate bond on the same screen. Like, that's when we've really succeeded.
In my view, a success in 5 years would be where we are looking at capital markets with embedded credit assessments or credit intelligence, and crypto-backed institutional structures are not looked at historical milestones, but any ordinary issuance in the markets where anybody, retail or institutional investors, are already aware of the risks and are investing without having to think twice or thrice into that aspect. And I hope we reach that point in 5 years.
Awesome.
European institutional investor base is massive, obviously, but also very fixed income focused. European fixed income, it's very much a fixed income culture. You got all the massive pension funds, all heavily weighted towards fixed income instruments. Kind of hard to get yield right now. I mean, I was in high yield credit for a long time, and high yield credit is basically very low yields these days. So I think that in itself is a big opportunity set.
Think about the scale of AI. How is AI going to use this? People just think that AI is just going to use it to pay. But what is AI? What do robots need? What do people need on a global network? A true extension of the internet. AI wants to use it for validation, authentication, accessing data, and they need to have it happen at the blink of an eye. In other words, money, which is trust, especially for agents and robots, needs to move at the speed of intelligence. You're not going to get that with Visa and MasterCard, but you're going to get that by being able to send, 1/1000th to 1/10,000th of a penny working sats with the blink of an eye to validate. And effectively, the Bitcoin address that they can validate that they have becomes the agent's agentic soul.
But again, Bitcoin can and will only ever be that safe haven in those types of environments if Bitcoin is viewed by the masses, by traders, as a currency. And unfortunately, we've kind of, as Bitcoiners, shot ourselves in the foot a little bit by calling Bitcoin digital gold, a digital store of value, rather than calling it what it truly is, the most perfect form of money that humanity has ever conceived.
Michael, since your May 5th earnings call comments, odds that Strategy sells some Bitcoin by year end have spiked from around 30% to 84%, and odds of a sell by June 30th are at 66%. Critics say stretched dividends and a narrowed MNAV premium are forcing your hand. How wrong is the market?
I think we enjoy keeping everybody guessing. It definitely makes X a lot more interesting. Our view is business as usual here. We're kind of matter of fact about this. The goal of the company is to drive Bitcoin per share and to increase its Bitcoin and increase the enterprise value continuously forever. We'll make decisions about how we fund our liabilities week by week, day by day. Sometimes we make them minute by minute, to tell you the truth. We set algorithms where we're looking at what is most long-term advantageous to the company. Are we managing our credit risk? Are we creating Bitcoin per share? And are we best off to pay a liability with cash, or to pay a liability by issuing equity, or to pay a liability by issuing credit, or to pay a liability by selling Bitcoin? We've done a lot of multivariate models, and in all the models, what we find over the long term is that by far the best thing for the company is to engage in a mixture of those four instruments. Any model that we put together that's limited only to equity or only to credit or only to Bitcoin always underperforms. So ultimately, the way to think of it is 7 years out, we would like to have maximized our Bitcoin per share. And what is it that we should be doing now that's going to maximize and optimize the company's performance so that we've maxed out Bitcoin per share 7 years from now? And I think it's not unlikely that we'll sell some Bitcoin between now and the end of the year. I don't know how much. We still consider these things. But it's also likely that we'll sell a mixture of equity, a mixture of credit. We'll manage our USD, our cash positions. And we do it in a very thoughtful, programmatic fashion where we're running our multivariate models, and we're literally running them. We're making trading decisions. To say every minute might be an understatement. We oftentimes make trading decisions every second, and we'll continue to do that.
Zero is the wrong number in terms of how much Bitcoin you should own.
Now, zooming out on Bitcoin as a whole, were you surprised by the success of the Bitcoin ETFs and Larry Fink going on TV promoting Bitcoin?
I think Bitcoin is becoming more popular. People are becoming more aware of it. I mean, the ETFs are a marketing game. I'm in favor of it because it helps people get exposure and interest in Bitcoin, to sort of understand it as an asset class, start to think about it how they include it in their own capital allocation. We have sort of team members that have come up with a phrase, which I enjoy, is sort of zero is the wrong number in terms of how much Bitcoin you should own. And I think that having more products out there that encourage that adoption and the adding of Bitcoin as an asset class in terms of some shape, form of exposure into your portfolio is great. So you've got ETFs. I think, again, what Strive and Strategy are doing, are allowing other ways to get sort of the income, the fixed income side. Exposure to that is great. And then for others, they're going to want to own spot and think about how do they leverage it in, based on that type of ownership.
And then competitively, how do you think about kind of the margin lending against IBIT versus against physical Bitcoin with Bitcoin-backed lending?
So right now, the space is very much, we lend against essentially spot, right?
Yeah.
In terms of the actual asset. I think it will be interesting to see how it evolves. For the most part, our decision in terms of what we lend against is against the liquidity of the asset in the market. How easily can it be traded? How fast can we sell it? What is the access to sort of liquidating it, selling it when we need to? And so I think what Michael Saylor shared yesterday in terms of how much strategy and strike, MSTR and strike are being sold in the market from sort of a volume perspective is encouraging. And I think you will see people start to think about how they incorporate those type of assets into portfolios, because that's been like, the ultra wealthy have been playing this game for centuries, right?
Yeah.
They've accumulated business portfolios, real estate portfolios, and stock portfolios that they've been able to leverage to make additional investments, to live their life in sort of a tax-free way. And I think sort of Bitcoin and these new sort of equity options as well as sort of digital assets are going to provide that opportunity going forward, with really Bitcoin being the predominant one that's leading the way.
And with large borrowers, have you seen them kind of add derivative overlays to manage their risk, or is that kind of more uncommon?
We do know of sort of high net worth and family offices and more sophisticated borrowers. They ask questions. They do have different sort of derivative strategies that they wrap around their borrowing. I do think, again, once the capital has come on board, you will see some more of those structures come into play as sort of the market matures and it grows, right? You have more people into it, you have more money that people are looking to take advantage of, and then they can also diversify how they think about their value building strategies or their capital sort of treasury managed strategies if you're business, or your wealth building strategies if you're an individual.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
BFC Live. My name is Jake Fenton. I work here on the Bitcoin for Corporations team. I am joined by Sam Callahan, head of BTC strategy at OranjeBTC, and Himanshu Sahay, the CTO and co-founder of Arch Lending. Gentlemen, thanks for joining me today.
Thanks for having us.
Thanks for having me.
Of course. Well, I want to start with some of the Bitcoin operating company news and just some macro stuff. In macro, I want to start with the Clarity Act. It seems like based on, reports that we're getting out of Capitol Hill that it may be close to the finish line. Whether the Clarity Act does or doesn't pass, Sam, I'm curious to hear, if the Clarity Act passes, what are the consequences for not just Bitcoin treasuries, Bitcoin operating companies, and just the average Bitcoiner and pleb out there? From your perspective, what does this mean for the space?
Well, I think the Clarity Act, it's a potential tailwind for Bitcoin. It's a catalyst. Bitcoin's the most established, most liquid, largest, most secure digital asset. And even though the Clarity Act is more, I'd say, prevalent for broader the crypto space, other cryptocurrencies, stable coins, who can regulate them, who has oversight over them, how do you categorize them? That's kind of really what the Clarity Act is about, just clear rules and regulations for the entire digital asset space. Bitcoin's had regulatory clarity for going on a decade now. It is a commodity, but it will benefit because a lot of institutional investors still, unfortunately, conflate Bitcoin with the rest of the digital asset space. And so they might be hesitant to allocate to the entire space, including Bitcoin, until there's more regulatory clarity, until there's a framework for the market structure around this new asset class. They might be hesitant to allocate to Bitcoin. So if we do get this passed, I think Bitcoin would generally benefit. Now, there is some language that is good for Bitcoin itself. There's language around protecting open source developers. There's some language around self-custody. I'd like to see that language strengthened a little bit, but it's good that there is some protections in place for self-custody. And so it's not completely irrelevant to Bitcoin. There is some language that's good. I'm just for no regulation over bad regulation. So it'll be interesting to see what the language is after the recent markups and kind of debates and whether it'll actually go through or not. But if it doesn't, I don't think Bitcoin necessarily needs it. Bitcoin thrives with or without the Clarity Act. But I think in the short term, if it passes, then the market would see that as a tailwind, and we could potentially see the price respond to that.
Yeah, Himanshu, I'm curious. You come from a totally different angle or perspective in the sector. I'm curious, what does this mean for lending? What does this mean for Arch in particular, and the way you guys operate?
It doesn't change too much for our business as it operates, but it does help regulate a lot of people around us. So, for example, it makes someone like Coinbase, or when you like Coinbase, a commodities exchange, right? It also, I think, gives our customers and customers in general clear frameworks on segregation and how their property is protected. So it creates clear frameworks around bankruptcy protection. It's a question we get a lot from our clients, and we've made steps along the way to make sure that in any negative scenario, our clients are always protected. Now, this makes everybody in the market have to operate along those parameters. So I think that is quite helpful as well. And then as it relates to intermediaries versus people who sit at the front, like DeFi developers, it treats them a little bit differently now. So intermediaries or centralized businesses that do provide access to DeFi, which a lot of other lenders do, and there have been a lot of conversations on wrapping DeFi into C5 models. They may now actually have to face proper regulatory clarity and face sanctions, risk management, etc., compliance obligations like they normally would with their centralized business, along with the DeFi wrapper as well. So I think it does change a few things there. I think outside of Bitcoin, I would also prefer some stronger drafting around what is the security versus commodity conversation, because it does provide certain pathways for SEC to CFTC's like regulation from labeling something as secure, which would be a security, as a commodity. So it's interesting to see how it operates on other assets. I think for Bitcoin, absolutely a tailwind. We are seeing some price action improvement as a result as well. Still nowhere close to, I think, a bull market or anything. But yeah, I think it's gone through so many changes in the past several months, and it's still unclear what version actually is is going to go through if it ever goes through. So it's unclear what happens still. I'm cautiously optimistic.
Yeah, I'll just add, like, I think kind of what he was getting at there is that it is going to make it easier for these institutions to start to build in the space too. It just gives clearer rules for them. Like he mentioned, the segregation, it obviously goes beyond that. When you think about the institutional adoption that's happening, some of the large banks, for instance, getting into the space, launching Bitcoin products and services and digital asset products and services, tokenization, having a clear framework would allow them the confidence to build, really make investment into the space, which is good for the broader, ecosystem as well in terms of improving investor access, lowering the cost for end users. For instance, like Bitcoin lending would be an example of how this could benefit Bitcoin in the long term to have clear rules. Now, there's some other important parts for Bitcoin, like for instance, I would like to see the strategic Bitcoin reserve get codified into law. I would like to see Bitcoin tax treatment improve for de minimis transactions. Those things aren't in the Clarity Act. They're in different pieces of legislation that are a little younger in the process. And so there's important legislative efforts beyond the Clarity Act that I think actually move the needle more for Bitcoin adoption. But make no mistake that if it passes, I think broadly speaking, it's a good thing for Bitcoin.
Both of you mentioned Clarity Act being a potential tailwind. Let's play devil's advocate here, and let's assume the Clarity Act doesn't pass and it's dead on arrival. Outside of the Clarity Act, what are some of those other tailwinds that you see in the space right now that might be positive for Bitcoin?
So in the past week, we've seen the first actual week of inflows in ETFs. I think we've seen 700 million in inflows. It's still a tiny fraction compared to the actual outflows that we had of, I think, 13 billion at its peak in the past few weeks. So that's, I think, a bit of a tailwind there. We are seeing some ETF demand. I think it's just a rotation out of crowded AI AI and semiconductor stocks. We also saw a huge inflow into the IPO for SpaceX. We'll probably see another one for the Anthropic IPO if and when that happens. So it's more of like a correction. Like it's less mania. It's just like the market attempting to rebuild a little bit. I don't think it's euphoric in any way. But if it does hold this breakout and it's not just short covering any event-driven stuff, and if you don't see another big blowout in the war in the Middle East, we could see a steady climb. I don't think it's going to be a massive jump where we see a 30% month, but I think we will see a bit of a steady climb.
Sam, curious to hear your thoughts.
Look, in the short term, I think Bitcoin's going to continue to come under pressure because there's more competition for marginal capital. We think about the IPOs, highly anticipated IPOs, and how large they are that are still anticipated towards the end of the year. That's going to compete for capital. You obviously have the AI craze, tech stocks running. Now that's starting to correct, right? Anybody who bought into the SpaceX IPO is now underwater. And that's the kind of what you'd kind of expect to see. So I do think you're going to see a rotation back. But right now, there's more competition for marginal capital for Bitcoin. So it might still struggle. Now, when I think of Bitcoin, I think of it as a long duration asset, and it's very volatile in the short term. I always go back to the fundamentals during corrections like this. Has my thesis changed? Has the reason for holding Bitcoin changed? And what I usually focus on is the fiscal outlook, the amount of government spending, things like that. Recently, the fiscal numbers came out. We're actually on set to have a larger deficit than last year, right? So spending actually increasing. You have yields rising. You have inflationary pressures rising. You have more geopolitical fragmentation, more capital controls. These are the real tailwinds for Bitcoin long term, and they're only getting more clear. And the traditional financial system is continuing to deteriorate in many ways when you look at its long-term health. And so those are the real tailwinds that I think people should focus on and during these price corrections that really go back to the fundamentals of why you would want to hold a decentralized asset that can't be debased, that can't be censored, that provides some diversification against fiat debasement risk, which is what stocks, bonds, other assets that might be in your portfolio, they might not be able to hedge that fiat debasement risk as well as Bitcoin or other hard assets. So, it's probably not the answer you want to hear of like what's the short-term catalyst for how do we get out of this bottom. Really, it's just time. It's just a period of accumulation of where Bitcoin moves from weak hands to strong hands with conviction. You're seeing that in the on-chain data with long-term accumulations. There's a lot of bottom signals, sentiments poor, but really the reason to hold Bitcoin has never been stronger or more clear. So those are the things that I look for. If I saw governments starting to act responsibly and stop spending, maybe I'd be a little bit worried about Bitcoin not making a bottom here.
Yeah, I tend to agree. I don't really look at the Bitcoin price. It's more about the long-term monetary scarcity thesis. I do believe that in the short term, it is still trading at the moment as an event-driven liquidity asset, but absolutely in the long term, it's very much still if you believe in the thesis. I mean, there's no better time to get in than now, if you aren't already. But I think it's still very much a long-term reserve asset, in my opinion. I think it's Sam's opinion as well.
You mentioned Sam. You mentioned institutions, capital allocators, IPOs coming up, and then you kind of explained your general thesis on why Bitcoin makes sense to you. I think after working in the space, I've seen that there's a lot of skepticism toward these institutions that hold Bitcoin or some of the infrastructure partners like Arch Lending. I'm curious to hear your thoughts on, for the average Bitcoiner that agrees with you on this like large debasement trade. I'm curious, why wouldn't an institution that's made up of people that also can see the writing on the wall with fiat debasement, why wouldn't they also buy Bitcoin, hold and move their company onto a Bitcoin standard?
Well, I mean, it's a big lift for a lot of companies, especially it seems like the older they are, the larger they are. It takes a lot of convincing to change your treasury strategy and allocate to a new Treasury Reserve asset that's only been around for 17, 18 years.
Yeah.
And there's a lot of bureaucracy involved. There's a lot of internal controls that need to get placed. How do you secure the Bitcoin? Operations to set up to allow yourself to even hold it or allocate to it in the first place, let alone convincing your board or committees on the investment thesis of why you'd want to hold it, especially at a time like this when it's down 50%. There's real reputation risks. So there's a lot of like bottlenecks. Now, the actual reasons when you actually dig down to the fundamentals and the, run the numbers, every single company I think is going to hold Bitcoin on their balance sheet eventually as inflation and debasement become increasingly worrisome and severe, where they think about how do I preserve capital, not just for the next quarter, but for the next year, 2 years, 3 years, 5 years. When you look at the options available to them as a public company, I mean, you have cash and cash equivalents, but obviously they underperform the rate of monetary inflation, which is around 6.5, 7%. So you're losing in real terms, but you want that liquidity. And so you think about what are the alternatives, and this is what Saylor did in 2020, right? And there's regulations in place where they can't necessarily hold like securities. And at the same time, if you buy like the S&P 500 for protection as a company, it's interesting because you're kind of like, if you have competitors in the S&P 500, you're kind of giving them capital. So there's a little bit of incentives there. But you want to hold a commodity then, right? Because it doesn't infringe on any of the 1940 Act, and you won't get reclassified if you hold more than 40% of your balance sheet in securities. Like you want to hold commodities, and then you think, well, I could hold gold, I could hold real estate, but that comes with other headaches and other problems due to their physicality. And then you land on Bitcoin, right? And so I think it would be really reasonable for really every CFO and corporate treasurer to eventually come to Saylor's conclusion. But I think it's going to take time. I think it's going to take, there's still a lot of education that needs to happen. There is still work to be done on the regulatory front. Like we've seen like a whipsaw over the last couple of years where they used to fight against it. Now there's clear accounting rules. But there is still barriers there that need to get brought down before a lot of these companies can feel comfortable allocating to it. So time is the biggest teacher, and debasement will continue to wither away the value of all these other Treasury reserve assets. And then education on Bitcoin, and Bitcoin just building a stronger track record will do more than anything to get people to finally allocate to it.
Himanshu, curious to hear your thoughts on again, because you offer such a unique perspective. You're really helping these companies expand their operations or bring liquidity to maybe some of the assets that they hold on the balance sheet. Curious to hear your thoughts on next steps for institutions in Bitcoin.
Yeah, I think it's important to differentiate public and private institutions. I think if you're public, you typically operate on a quarter by quarter basis, and you have real risks in having a negative quarter, right? Especially if you have that like two negative quarters in a row, you may have a strong operating business, but if the Bitcoin is going down, which it has in the past 2 quarters, you're going to have a lot of questions, and your management like credibility will be put into question. There's a lot of risk for a business that is public, with a significant number of public shareholders to go on the Bitcoin standard. So I think we'll see a larger number of companies over the next few years maybe allocate a small percentage to Bitcoin. But I think it takes a lot of time before we see a lot of companies operate significantly on the Bitcoin standard. However, on the private side, companies are a lot more nimble and often founder-led, where they can actually make that decision. And we actually have a much larger number of private companies that borrow from us than public. Obviously, there are a much larger number of private companies that hold Bitcoin. It's easier for them to allocate to Bitcoin if they are in an industry that isn't as regulated as, say, banking. They can allocate much more easily. I was speaking to a chief digital officer at a very large fund that everyone's heard of, and he's been there for 3.5 years. All they've done in the last 3.5 years is set up the infrastructure to be able to hold Bitcoin. They haven't even bought any yet. Just set up the infrastructure to be able to hold Bitcoin. So the speed that we think about with smaller companies, with companies that maybe have chosen to go on the Bitcoin side publicly and have set up the operations like Sam has for that specifically, is very different from a company that has a very different operating business in the traditional world and has shareholders that are frankly focused on something completely different, right? So I think it'll get there. And as we see more monetary debasement, as we see the dollar continue to, I think, or as we see people get clear on the fact that you are losing money to inflation and debasement every year, we'll probably see more, but it's not going to be, I think it's going to be a lot of nothing and a lot of small steps until we get to like a true inflection point. We're still very early, and we'll continue to see small steps along the way as people get there. And I think as we have more utility on the Bitcoin, it's much easier for people to actually operate on that standard. Like today, if you're allocating to Bitcoin, you have to have your own strategy that's unique to you. There isn't something off the shelf that you can pick up, and you have to do a lot of work. And like someone like Sam has to operate in every single company to be their Bitcoin strategy officer, right? But I think long term, we'll see more off-the-shelf solutions for people to actually do more with their Bitcoin. Today, you can borrow against it. There's some places where you can get yield against it, but you have to have someone decide the quality of the tools they're using. And there's not that many options in the market today still. We have some good options, but I think the market will continue to benefit from more varied options in the market.
When it comes to institutions, I think, there's a lot of fair and unfair skepticism especially some of the treasury companies. Look at like what's happening with Stretch and Seda. Big question out there whether, are they going to get back to par? Is this just a temporary moment, or is this where these products land? The exit of Jack Mallers from 21. It definitely feels like bear market vibes right now. And I know there's a strong sentiment among Bitcoiners, and I see it out there on X, that there shouldn't be Bitcoin companies. Companies shouldn't be holding it on the balance sheet. I'm curious, Sam, I want to hear from you first. What would you say to the skeptic of some of these, or some of the critics of the Bitcoin companies, that say like Bitcoin is just meant for me and you, it's not meant for the institutions?
I've never really understood it, because when I thought about what Bitcoin adoption would look like, Bitcoin being adopted as a new digital money, everyone is going to hold Bitcoin. Every single institution, every single person, every single household needs sound money. So it's going to get adopted at every single level. And so to me, to say like, oh, these companies are acquiring too much Bitcoin, or they're adopting, they shouldn't be adopting Bitcoin. It's quite silly to me. I don't understand it. I don't know. It's like screaming at a river that represents Bitcoin adoption, and they're saying it's moving the wrong way or something. This is just nature. This is how Bitcoin's being adopted. You can scream and say it's not right, or you could try to highlight some of the risks, and that's fair. But to me, this is how naturally it was always going to happen. And Bitcoin companies that have their KPIs based on Bitcoin, and they pay their salaries in Bitcoin, they're really thinking on a Bitcoin standard, and they're using the traditional debt-based system to accumulate more Bitcoin at favorable terms, because as a public company with a large balance sheet, you can get more favorable debt terms that, say, an individual couldn't. And that allows you to basically put on this short fiat, long Bitcoin position in an intelligent way that results in more Bitcoin exposure for your shareholders per share. So, this is, you can also, as a public company, you can build out Bitcoin operational businesses. There's a optionality between how you use the Bitcoin on the balance sheet. There's been different strategies taken by different management teams to make that Bitcoin productive and put that Bitcoin to use to ultimately drive Bitcoin adoption. It also improves investor access. I mean, even OrangeBTC, we just launched our ADR last month. I mean, if you're a US investor and you're bullish on Bitcoin, but you're also bullish on Brazil or Latin America or emerging markets more broadly, if you think about the currency dynamics, or you're just bullish on that region, it's been one of the most outperforming sectors over the last couple of years. Now you have a way to get exposure to Bitcoin and a public company in Brazil by buying potentially our ADR, if that's of interest to you as an investor. And so it's just about building exposure and improving investor access across the world to Bitcoin-backed securities. And I see it as a bridge. As there's large pools of capital that can't buy spot Bitcoin today. There's restrictions that exist in Brazil, for instance. It's about meeting investors where they are. Bitcoin is still volatile today. That volatility is declining over time. But when you have, as an individual, you have your long duration savings, and then you just put that away. And I'd recommend Bitcoin in cold storage. Remove any kind of counterparty risk. But as a short duration needs, in terms of, hey, I'm saving for my kids' college, and I need this money in 3 months to pay the tuition, you really can't afford to do put it into Bitcoin and have what it did the last 3 months. It would be pretty catastrophic. And you say your kid, like, no, sorry, you can't go to college anymore because Bitcoin's volatile, but it's still the best money. She's going to be like, what are you talking about?
Yeah.
And so you got to try to find solutions. And that's what Stretch and Seda and these different preferred products are trying to deliver, but backed by Bitcoin or supported by their Bitcoin balance sheets. And we can go into their recent price action and why I think they'll return to par, but I'll stop there to let him share his thoughts over here before I continue with that. But that's kind of how I see the Bitcoin corporate adoption and the critics around it.
Yeah, Himanshu, I'd like to hear from you as well because I do want to jump into digital credit here in a sec. But yeah, Himanshu, I want to just hear your thoughts on the critics of the overall like Bitcoin operating business, Bitcoin treasury space. Any thoughts?
I think a lot of the critics today are speaking to the fact that a lot of treasury companies haven't had a plan of what they're going to do after they go on the Bitcoin standard. And I think that's fair. I think very few treasury companies have made the efforts to actually do stuff beyond it. I think digital credit is one very interesting approach there. And I think most treasury companies are seeing the value of that. So we're seeing a few of the European treasuries also operate like with similar models, but it's private like Apple B or something more public like the Smarter Web is looking to do as well now. I think so it's very clear from even if you speak to Saylor, it's very clear that he has always expected that we will have to sell, or he would have to sell Bitcoin at some point, and I think the market overreacted to that, and that culminated with Bitcoin also like sliding quite significantly at that time. So it did have a bit of a depeg. It's not quite a depeg because it's not a hard $100 mechanism. It's a target. It's not a requirement. SATA, on the other hand, is a little different. It does a daily yield. It also buys stretch under the hood, so it has some buffer there. It's not just Bitcoin backed. And it's almost back at par. I think we're at 98 something on SATA right now. For stretch, it's definitely come back from its bottom. I think we're at 88 something on stretch right now. And I do think stretch comes back, but I think people have to be very clear on understanding that MicroStrategy is going to have to sell Bitcoin at times. I think I had dinner with Saylor recently, and he was explaining the mechanism. I think it was something around if the Bitcoin growth rate is less than 10%, then they're going to sell Bitcoin. If it's over 10%, they're going to sell stock. So it's something along those lines. I'm probably butchering it a little bit, but basically the idea is that it's a mechanism where they have enough of both to sell, and it's a choice on which does get sold. I think the market has to understand that Bitcoin will get sold at some points in the cycle, and that shouldn't affect Bitcoin negatively or stretch or strategy stock itself. Yeah, and I think a lot more treasuries are going to issue these perpetual preferreds, and we'll probably see more utility in the market with these. I think there will be a point, much like the treasury company stocks, where there's probably too many that are similar. So there'll have to be differentiation on them as well, whether that's a securitized layer on top, which smooths out the volatility. So if you have a securitized or like a senior secured structure that you're selling that operates on top of stretch, and that gets rated better because it's smoothing out all the volatility, that can then be sold to bond markets, for example. They're much, much larger than the markets that are being than traditional public markets, right? So if you can access those, I think we'll see a lot more liquidity and a lot more investor access, because investors at the end of the day are looking for yield that's rated, and that's rated at least AA and above, right? So if you can get that, you can access much, much larger insurance markets and such.
You called out something which makes me think about the total addressable market of digital credit, and I want to get to that, but I want to backtrack a little bit. Sam, can you just take us through what happened with these digital credit products? It seemed like they're printing money every day. We're at par every day. Saylor and MicroStrategy and Stata, they're buying all the Bitcoin, and all of a sudden it seemed like we had this big unwind. Can you explain to us what happened? And
yeah, I could do my best. I think the first thing you have to understand is that these are very, very young instruments and innovative instruments that the market's still trying to wrap their head around. Like Stretch just turned one, I think, or is just about to turn one. And in the financial world, they're babies. They're also innovative. There's nothing that's existed like them. Having a perpetual preferred equity instrument that's backed by Bitcoin or supported by Bitcoin balance sheets. It's a very new type of instrument. So the market's still wrapping its head around it. And I think what we learned was that Strategy, when they paid down some of their convertible debt by using the USD Reserve, that the market had viewed that as specifically earmarked to service the dividends, even though that wasn't the case. That's obviously how the market viewed that. So when it got drained down to pay the convertible debt down, the market kind of freaked out a little bit. And that's when Stretch started to trade at a discount to par. And, it was interesting because I think that's actually a good move for them. Maybe they should have tapped the ATM of MSTR to pay down the convert, but it's actually a good thing for the MSTR common shareholders as well as the preferred shareholders to remove some of that senior obligation. That's a hard cash obligation. And if you actually look at the put dates of some of these converts over the next 2 years or so, if the stock price doesn't improve materially and it doesn't get into the money for these converts, they could demand their money back. And so that's actually like a real risk for Strategy over the next couple of years to remove some of that convertible debt. But the way they did that by draining the USD Reserve at that time, and then right after Bitcoin puked, it just wasn't really lucky timing for the whole thing. And so now that when it dropped, and then I think at the same time, we learned that there was a lot of leverage being taken on top of Stretch as it kind of, the volatility started to decline. People started to leverage up, people started to carry, they didn't manage risk well. And so you saw the initial drop from this drain of the USD Reserve, but then you hit these liquidation thresholds all at the same time. And that's what caused the real spike down to 74. Once it got to like 90 and then it just kind of like trapdoored, that's usually where there's a deleveraging event that happened. But since then, I think Strategy has done all the right moves. They've shown that they want to prioritize their preferred equity shareholders by raising the USD Reserve. They're almost back to 2 years of USD coverage. They earmarked their Bitcoin and the USD Reserve specifically for the dividends. They announced a Stretch buyback program, which is also, I think, a good move. And so they're really showing to the market, and then selling the Bitcoin, I think was completely the right move. They're an operating company with a large liquid asset on their balance sheet. They can do whatever they want. They have complete optionality to do whatever they want if they feel like that action increases shareholder value. And if selling some Bitcoin to raise some cash or to pay back or to buy back a preferred, if any of it is accretive to their shareholders on a Bitcoin per share basis, or puts them in a stronger position and puts their capital structure in a more durable position to be in a position down the road to increase Bitcoin per share at a greater rate for their shareholders, they're thinking long term, then they're going to do that move. And so they bought almost 90,000 Bitcoin in Q1. They bought a little over 80,000 in Q2. And now people are freaking out because they sell a few thousand Bitcoin. Like, you really got to zoom out and look at the big picture of what they're trying to accomplish here. They're trying to build a Bitcoin accumulation machine for the long term. And the best way that they found to raise capital is through these preferred equity products in an accretive way, because it doesn't have a maturity wall. It doesn't have refinancing risk. It doesn't have all these things that, say, a traditional debt instrument has. And so, I think since Stretch has broken down, they've made all the right moves. I think now the market's just trying to, the stress test is trying to work its way back towards par. But as a Stretch shareholder, the only thing you should care about is, will they service the dividend? And if it gets back to par, will I have the liquidity to get out of my position? It's still trading, $400 million, I think today. That's MSTR. Hold on, let me go to Stretch. No, it's trading $270 million over the last 30 days. So it has the liquidity for the preferreds. And then they're going to continue servicing the dividends. So they now have serviced over $1 billion of preferred dividends Strategy. And now SETA has just hit their 30, I think, daily dividend. And so it just takes time to build a track record. But really, that's all you should care about is like, will they service the dividend as a stretch holder? And the answer, I think, is definitely yes over the next at least several years because they have the reserves built up to do that. And then will it get back to par? And I think that's just a matter of the market absorbing it, market learning more about it, building a track record of servicing the dividends. It all comes with it. And once it gets back to par, I think the liquidity is there where if an investor does want to get out, they will be able to, especially when you compare it to other preferreds liquidity in the market. I mean, it's night and day. So I think they're young products. They'll recover. They've done all the right moves that they've had to do since the stress test. And I think, probably over the next couple months or so, it'll get back to par.
Are you trying to say that the random anonymous Twitter troll doesn't know financial engineering better than Michael Saylor and Fong Li? Is that what you're inferring?
I mean, there's some times though where I do think to myself, I'm like, because I've had dinner with Saylor, and he really is truly like a special brain. The guy is not a what you see on screen is what he's like in person too. He never stops. He's always thinking about Bitcoin. Always, it's just amazing talking to him. And I always just think of the critics. I'm like, is this guy smarter than Saylor? It's like, no, like not a chance. And so I think it's important to question. It's important to debate. Saylor and Strategy, I think they should get a lot of credit for building a brand new business model in public, learning in public, pivoting in public, being extremely transparent. They're never going to make mistakes, but it's important that they learn from those mistakes and pivot. And so I think that's what you've been seeing over the last year or two as they build out this new digital credit, financing franchise that they're developing here. And so they should get a lot of credit for that. But a lot of these critics, you really go through it and like, have you run the numbers? Have you actually read the filings? Have you done the deep dive? It's okay to have reservations and to point out risks and trade-offs and to question some things, but you really want to at least do the basic homework and run the numbers yourselves before you open your mouth publicly about a subject.
Yeah, I stopped tweeting my criticism of Saylor on my Anon account a while ago. Okay. One more question, just kind of about the larger Bitcoin company space. The exit of Jack Mallers from 21. I'm really curious. I don't want to speculate, as to like what happened. We're gonna, what they say is what happened. But I really want to hear what this means for the larger space. Is it a signal of like a trend that we're going to see? Or is this just Jack going back to Strike to focus on his baby?
I can speak to this a little bit. I think it's the latter. A lot of the 21 initial approach was centered around like the star team and the capital behind it. They didn't do much with it, but the expectation always was that they'll roll up into Strike and then that'll be one big company. And also with Electron. Again, it's all speculation. I haven't spoken to Jack about this, but Strike has been doing a lot on their side as well. They're our competitor, they do a lot as well, and it's a very demanding business to run, I'm sure. I think rolling down to 21 with him leading both would probably have not been the right approach for 21 or for Strike, especially given a lot of Strike's marketing and go-to-market efforts are centered around Jack. With 21, in the announcement for his exit, they said that they're going to go on with their approach on adding lending, etc. So it looks like they're going to be competitive with Strike now, which probably means that it wasn't like a very happy exit. However, it remains to be seen whether they have the operational capabilities to build those things. Now they will obviously join up with Electron, it looks like, so it might be a two-way merger. They do have a strong Bitcoin balance sheet. So it remains to be seen what approach they take. They haven't done anything with their Bitcoin yet. So I think it's still very early. I wouldn't call this a trend in any capacity. There hasn't been another merger like this where there's been a strong or like there's been a large Bitcoin treasury looking to acquire a financial business underneath. So I think we will probably see more consolidation in the treasury space, looking with companies looking to acquire operating businesses. We're seeing treasuries specifically launch to acquire operating businesses as well. There's a few new treasuries coming out over the next few months and years that are going to do that. So I think it's not a trend, it's just a very unique circumstance. The timing is certainly very interesting. Why now versus a few months ago? But it's all speculation on why now versus
No, I agree. I think you will probably see some more consolidation, some more acquisitions of operating companies, and you have treasury companies that are trading at significant discounts, which could be attractive for another treasury company to come in and acquire some of the assets at a discount. But in terms of the specific news, I'm a big fan of Jax. He's been a great Bitcoin advocate, entrepreneur for many, many years, and I think he's a good person. And so I hope everything works out. He's just going to keep building Strike and do great things for Bitcoin from here. I just think in general, like three-party mergers, the odds of this actually happening were low from the very get-go. I mean, it's very difficult when you have an energy business, mining business, Electron Energy, you have 21 Capital, and you have Strike. How do you value? You have to agree on how do you value each of the companies, who has control, and the governance. You have different business models. It's very, very complicated. You saw Nakamoto, they were doing a merger, and they had the same owners in the companies, and it took almost a year to even get that across the finish line. Now we're talking about three companies trying to merge. It's just complicated. So these things fall apart all the time. And so I don't think there was any kind of like drama necessarily. I think in general, maybe negotiations just kind of broke down. Maybe Jack just wanted to focus on Strike, simplify his life a little bit. It's also there's real demand on an individual when they're running a public company, right? In terms of what you can and can't say publicly. Jack's always been a really authentic guy, likes to say exactly what's on his mind all the time. Maybe that factored in a little bit. Like I think from the video you saw, he kind of spoke a little bit about that. And like I just want the Jack Mahlers that feels happy and driving Bitcoin adoption and education and building Bitcoin financial services. So happy that he's just going to still focus on Strike and keep building. But I also have a lot of confidence in Hafa Seguri, who's taken over as CEO of 21 Electron Energy. They run about 5% of Bitcoin's hash rate. I think you might see it turn into more of like a public Bitcoin mining company, and they'll probably develop other Bitcoin strategies. They have a giant Bitcoin balance sheet there. A lot of question marks about what's going to develop from there, but I think you're going to hear a lot from them over the coming few quarters here. So I'm excited. I'm excited to see what Strike builds from here. I think everything's going to work out. I don't think it's like some big sign of bear market or something fall apart. I think these deals fall apart all the time, but there was just a lot of spotlight on it just because of the names involved and the companies involved and everything like that.
I think one argument to be also to be made here is I think if you ask someone a year ago, do you need to be acquired by a public company to have the capital markets expertise or the capital markets access to be able to serve a large number of clients and a large amount of lending activity? And in the past, maybe the answer was yes. Today, I don't think that's true anymore because capital markets in the last few months have evolved quite significantly where you can actually access a ton of debt as a private company. So you could have said that, hey, you need to be part of a public company to get to the next billion or the next 5 billion, but you don't really anymore. Strike did raise a $2 billion line with Tether. A number of other companies, including us, have very large lines with different capital partners as well in different structures. So maybe you don't need to be, from Strike's perspective, like they didn't need to be part of 21. to do what they need to do. And I think other companies will probably make similar decisions or will be in a position to make similar decisions. Whether that's yes or no for them is very unique to each structure. But it is something to note that I think capital markets in Bitcoin lending has evolved quite significantly. It evolves on like a monthly basis at this point. So what was true when this was proposed, which I'm sure was 6 months ago before it was, before it was ever public, is probably not true anymore.
Good point.
Go ahead, Sam.
No, I was just saying, good points.
Yeah, I'm excited for Jack. I'm a listener every once in a while of the Jack Mallard show. Enjoy him. A happy and authentic Jack is the best one. Okay, we got a few minutes left. Want to kind of wrap it here. Himanshu, you mentioned, I think it was you mentioned how much Bitcoin 21 holds on the balance sheet. So for these companies that want to make Bitcoin productive, that want to make that that balance sheet productive, obviously we've seen products on the market like digital credit. I'm curious, with digital credit, the advent of digital credit, I'm curious what you guys think. What's the total addressable market here? I mean, this attacks like banking, fixed income. There's a lot of different places you can park your money. I'm curious what the future of digital credit looks like. Sam, you said we're only a year into this.
Yeah, I think it's very early in who we're addressing. So with Stretch and SATA, 80% of Stretch holders today are retail. So it's not even gone to the bigger institutions and such. But it's also not an instrument that's rated in a place like at least AA or above where any serious institution is going to buy it. So it's still very early in how it's wrapped. Now, Saylor has always said, I'm going to create the tools. People are going to build on top of that. So we have two products called Apex and SATA that are basically like a smoothing layer on top of Stretch. We're going to see people build securitized products on top, which use Stretch, but have a smoothed out, non-volatile product that actually does work as fixed income. So you're just getting a yield. It's not something where you're targeting a yield. And I think that will probably be something that yields a couple points lower, but does get rated very favorably and can then be sold to bond markets and such. Bond markets are the largest credit markets in the world. They're orders of magnitude bigger than like traditional public like stock markets, right? So that market has not been touched yet. We will certainly see someone build. I think we'll see many approaches to build there. We only just saw the Bitcoin-backed lending markets hit the bond markets, right? Very recently. Ledden did their securitization of their book. We have a book that's been on-chain securitized. So it's still very early in those approaches as well. This is something that's so new. Like it took 7, 8 years of Bitcoin-backed lending to exist before we did that. We're only a year into digital credit, or maybe a couple of years if you count the earlier products that Stretch had. So I think we'll see approaches in that where institutional investors, with all the other tailwinds with Bitcoin, finally who understand what Bitcoin is, but want to offer a fixed income product, will offer something that is more agreeable with large institutional investors.
Sam, curious to hear your thoughts.
I mean, I just agree. I mean, I do think we're early. I think a lot of the moves that strategy has made has been revolved around some of the feedback it's gotten from the credit rating agencies, right? S&P Global said that they'd increase their rating or upgrade them if they did a few things, if they improved their USD liquidity, which they have, if they demonstrate that they have strong access to capital markets in challenging conditions. They've raised billions of dollars over the last several quarters at a time when Bitcoin corrected 50%. I think they've demonstrated that pretty well. And the last thing is reduce some of the convertible debt. And so they did do that. The market kind of puked a little bit because Bitcoin fell right after they did that. But in general, these are all steps they're making. This is when I say think long term. They're thinking long term. They're trying to improve the credit rating to bring in more capital, to bring in more institutions to feel comfortable allocating to these new instruments. And so each move can't be viewed in a silo and not just short term. It's all made to achieve greater goals, to bring in more demand for these instruments. And that's just how the traditional financial system works. You need a better rating to unlock access to these larger pools of capital. So, I think this is early days. I think this is a stress test that when you look in hindsight, it's actually, they're going to point to this as say, we were able to bring this back to par, by continuing to service the dividend, continuing to build a track record, continuing to be disciplined. And I think that's what they're going to continue to do. And so it's the market, time does a lot of things, like I said earlier. And so the more that they can demonstrate a good track record, the more the larger institutions will feel comfortable allocating to the instruments.
I think that's a good place to put a bow on it. Sam, where can our listeners today, where can they find you if they want to hear more?
You can find on X at Sam Callah, SAMCALLAH. You can also find more about the company, OranjeBTC. That's spelled with a J for the orange. That's orangebtc.com, or follow us at OranjeBTC on X, where we share company updates.
Himanshu?
So you can find us on X at Arch Lending. Our website is also very simple, archlending.com. I'm not as active on X as I should be, so just follow the company. We do have a newsletter that goes out with market news every Wednesday. So it just went out this morning. That's on our website. You can go sign up very easily. We have a ton of people who follow that just for a 3-minute read of what's going on in the market. Yeah, if you have any questions on lending, on borrowing against your Bitcoin, on how you can activate your stack in a very safe, creative manner. We do serve both individuals and businesses, so 2 different product lines for both. But yeah, happy to answer questions for anyone at any time. Our team always takes calls from people all over the world.
Awesome. Well, gentlemen, thank you for joining me today. If you're listening live, both of these guys have spoken at our symposiums. Our next symposium is coming up in Hong Kong on August 27th. If you can join us, we would love to have you there. Gentlemen, thanks for being on today.
Thanks, Jake.
Thank you. Have a good day.
You too.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Today, we are going to be talking about good old Strive, because I wanted to make a video today that wasn't some grand philosophical thesis. I wanted to make a video about getting rich, kids. Now, none of this is financial advice. This is financial entertainment. I am not telling you to go out and buy Strive shares, even though I will be doing that myself. I look back on this last year of my investing journey, and what have I found? I have found that Bitcoin, super volatile, and Bitcoin Treasury companies are super volatile entities that are not for everybody. Not everybody can handle Bitcoin volatility, let alone Bitcoin Treasury company volatility, because the thesis does require more work. Bitcoin is kind of the prerequisite, and then you got to understand more stuff on top of that, why you would buy stock in a company who's just buying Bitcoin. That takes additional work. But I have done the work. You see, I continue to go back to the drawing board and look at the long-term math, the value proposition on a long time horizon of a company like Strive, and I continue to get blown away by the risk proposition here, the risk reward calculation that is presented to me. I continually love this trade. Lately this year, I don't know, I've usually been buying Bitcoin. Sometimes when I get cash, I get analysis paralysis where I'm like, I like MetaPlanet, I like Strive, I like Strategy. Which one do I buy? And sometimes I just end up buying Bitcoin. Sometimes I literally will split a chunk of cash into 3 of them and then buy an even third with a chunk of cash that I have. But regardless, I really think that Strive has a very interesting value proposition, and we are going to be talking about that today, because tomorrow I think I'm going to buy more ASST shares based on the growth potential that I see in this stock. Today, we're also going to be doing some stock price modeling. This is all off the cuff, nothing planned. So hopefully you can kind of see how my mind works as I work through this myself. myself. If you guys could do me a huge favor, hit the like button, subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to the masses. Before we get into it, I really want to take a moment to thank my sponsor, The Bitcoin Way. These guys are my friends that will help you become a sovereign Bitcoiner because the real revolution is Bitcoin in self-custody. Bitcoin is the ultimate form of savings. If you're not custodying your own Bitcoin, what are you doing? Get them off the exchanges. They will teach you to be your own bank, eliminate counterparty risk, become a sovereign Bitcoiner. You can scan the QR code right here, or you can go to thebitcoinway.com/Adam to get started and schedule a free introductory call right now. I'm not asking you, I'm telling you. Click the link below. The Bitcoin Way is awesome. So obviously the question continues to be, with most market participants, Adam, why would you buy a Bitcoin treasury company other than Bitcoin? I don't want to explain myself too much. Sometimes I do think I like to take additional risk with my capital. Bitcoin is savings. I like to invest some of my risk capital to outperform Bitcoin. Yes, price the stock in Bitcoin and then outperform Bitcoin to hopefully get more Bitcoin by the end of this journey. This does not require any multiple expansion over long time horizons, not in the slightest. And I think a lot of people misunderstand my content or what I'm telling people. My dearest listeners, have I ever been a chart squiggling trading signal to you? Guys, you gotta get in now because it's gonna go up. No, I'm not a trader. I am a long-term value investor. My projections run months and years into the future. I'm talking sometimes 5, 10, 15, 20 years. I like to be positioned for long-term convexity over long time horizons where I see advantages in the market with the pricings of these equities, especially because I don't think we're in an efficient market. The world's not even orange pilled yet, not even close. So anyway, as it relates to the value proposition, I see alpha in buying these things before they are even close to consensus. And that is how money is made, because Bitcoin isn't even consensus yet. And you can buy an amplified expression of that. That means you can make more money. You can buy more Bitcoin, provided management does what they have to do. They execute the plan. Bitcoin continues to go up and everything is fine and dandy. Obviously, you are accepting additional risk, but I think it can be worth it. And today you're going to see why. Now, when it comes to Strive, what you must understand is that they are not just buying Bitcoin. They are amplifying your Bitcoin exposure. And that, my friends, is a beautiful thing because they're not doing it with debt. They have zero debt on the balance sheet. They have 19,921 Bitcoin that you can see right there. That is at least until tomorrow, when they probably announce another buy. Over the last year, they are buying almost 45 Bitcoin per day, and the share price is $11.49 as of the Friday close, and guess what? $1.3 billion of Bitcoin. So there it is in one single snapshot view there. You can see that there is zero debt outstanding. The Bitcoin NAV just under that 1.3 billion. So you might be asking, how are they amplifying their Bitcoin exposure? They are issuing preferred stock to buy Bitcoin. They issue SATA shares, and then they take that capital, they go off and buy Bitcoin. What is SATA? It's a preferred stock that pays you a 13% dividend, and guess what? The dividend is paid daily. So over the course of a year, provided that the variable rate dividend stays at 13%, you can make 13% per year, but you are paid daily. The daily dividends hit your account every single business day, so that's super cool. So basically, they have $1.29 billion of Bitcoin, but they have more than half of that acquired by issuing preferred stock. And you can see that here, they have just under $783 million of outstanding SATA. So basically, when you do the math, when Bitcoin goes up, that preferred outstanding stays at that $782.95 million, and then the residual that's left over for you after those dividends are paid, the residual expands, and that is how you get outperformance over Bitcoin. So let's break down the math because I'm not being emotional today. I know a lot of Bitcoiners like to be these purity spiraling hooligans, but I don't care. I want to get rich. That's right. I'm a Bitcoin capitalist, kids. I'm here to divide and conquer. I'm not here to take part in your libertarian ANCAP LARP. All right, so let's load up the terminal and get to the number crunching. We are now going to import Strive here. Here is their balance sheet, all fine and dandy, ready for us to import. Let's go ahead and do that, and this should be fun. So let's start going through our assumptions for what we think that Bitcoin is gonna do, because this could be fun. Now, this is the cool part. Because I'm holding the stock for a long period of time, time because I acknowledge that with volatility, there will be additional outperformance because that's how amplification is just going to work here. Whether Bitcoin goes to 200K in 5 years or 500K in 5 years, I outperform Bitcoin by holding ASST shares, and I don't need a multiple expansion to outperform Bitcoin, and the numbers get pretty crazy here, which is why I absolutely love this company. I love the management team. They're based. So we've loaded it up here. How fun. We have $11.49 as our stock price. You know, they're paying those 13% dividends. You already know what the deal is. I don't got to go over that. But what we do have to put in is, you know, maybe an assumption. How long do you guys want to hold the shares? For me, let's just put in 4 years. 4 years sounds fun because, you know, I can probably hold them until July of 2030. And we're going to assume that Bitcoin goes linearly to $500,000. Will it happen linearly? Absolutely not. Bitcoin is volatile, but I can't predict the volatility of the move on the way there. But I do think it's going to go up over long periods of time. So we're going to say it's a linear move. The math still works out. We're putting in 500K. Now, what is another assumption? The assumption would be how much they can issue in preferred stock, because as Bitcoin goes up and to the right, unfortunately, to keep the same level of amplification, you have to hope that there's more demand for SATA shares so you can continue to issue those into the market, sell those shares to get that capital to keep your exposure amplified. And unfortunately for me, this number is totally unknowable. Just like how I don't know exactly the path that Bitcoin is going to take over the next 4 years, I also don't know how much SATA they're going to issue. We can make a reasonable estimate to be fun. In my opinion, what's reasonable? If you don't think it's reasonable, you can leave a comment and let me know. But SATA is only 8 months old. I think it IPO'd back in November. So basically we have 8 months since then. What you could do to be conservative is take the amount outstanding that they have, the amount that they have sold in year one, divide it by 12 and not 8 months. And you know what I get? I get $65 million a month. So this assumption would be assuming that they don't speed up the pace after year one when digital credit is still in its infancy. So to me, that's pretty reasonable. It's assuming a slowdown. So let's just go ahead and leave a $65 million per month on average issued. Let's just assume that the digital credit model works, but it's even slower than their year one pace. Now I'm going to go ahead and assume that they sell 0 common stock to ever buy Bitcoin. Now it would be rational for them to do this if their stock was trading at a premium, and it is trading at a premium today, about a 35 or 40% premium or so. We're going to see that shortly. But regardless, I'm going to be conservative, assume that they sell 0 of the common stock to buy Bitcoin. So this is another conservative bearish input. The point of this video is I really want to dial into how much of the outperformance of the stock is just from the embedded amplification and the Bitcoin move. So if there's additional levers like selling common equity at a premium, we're just going to take that out of the equation. And in fact, not only are we going to do that, we are going to assume that the dividends are funded by issuing those common shares. So they are issuing ASST shares, taking that capital to pay the SATA dividends. So yeah, you're being diluted. Oh no, so scary. But regardless, you're probably going to like it as we dig deeper into the math. Now, once you've figured out all of those other inputs, the last piece of the puzzle is the valuation. What type of valuation does the market then assign that residual for you, the common shareholder, or the enterprise, or the market cap value of the company? You can calculate the MNAV in a variety of ways. It's no surprising to anybody that I like to look at the MNAV, the true MNAV of the residual that's left over for the common shareholders. That is a 1.36 today. And you know what? We're just going to go ahead and assume that when Bitcoin goes up that much, the MNAV stays the exact same as it is today. So we're going to put in that exact same number, and the multiple path is just going to be flat right there. So we're going to go ahead and see what this does when Bitcoin goes to $500,000 over the next 4 years. The ending implied price at that MNAV, if they issue that many shares and Bitcoin goes to that price, sorry, it's not my opinion, kids. It's literally just a math calculation, and I went ahead and disclosed every single input. There you go. It's a $189.83 implied stock price at that MNAV valuation. Would I take that? Absolutely, because the stock is a little over $11 today. So there you go. That is a 16.52x stock multiple. I absolutely love that return. They are amplifying the Bitcoin move with the balance sheet. That is a beautiful thing. This is the stock return broken down with a simple multiplication problem that lets you know what gains you get. The stock multiple equals the move in the Bitcoin, then the move in the Bitcoin exposure, your residual increasing in value because the Bitcoin price value, it's going up. So Bitcoin going up makes your common equity Bitcoin exposure also go up. One thing happens, and then guess what? One variable is turning 2 gears because of amplification. That's beautiful. That's the engine actually working as designed. And then on top of that, you could multiply it by a move in the MNAV, the move in the premium, but we kept that flat. And because of the embedded amplification, Bitcoin is a 7.73x, but the stock does a 6.52x. So it more than doubles Bitcoin's performance just off this scenario. With the MNAV staying flat, we don't even need the MNAV to go up to outperform Bitcoin. We more than double Bitcoin with just the same MNAV today. Now, do you think the MNAV will stay at 1.36 whatever when Bitcoin goes to $500,000? I think the MNAV will likely expand when we see violent moves in Bitcoin's volatility to the upside. But regardless, who knows what the actual MNAV will be? I'm not pretending to know. I'm just showing the outputs of the calculations. But you know what? Let's go ahead and talk about the premium risk, because right now you are paying a premium over the residual Bitcoin. That is literally true. That's the math right there. You can see you are paying that 36% premium. And so many people ask the question, why would I pay the premium? Well, I just explained it. You're paying the premium for access to the amplification. But of course, the premium could go down over time. It also could go up. You have to underwrite your own assumptions about what will happen. You have to think about your own holding period. You have to think about when you're entering. Do you think Bitcoin is cheap or expensive right now? You probably wouldn't want to buy a heavily amplified Bitcoin Treasury company if Bitcoin is super expensive. But let's just assume that the MNAV does go down to 1, even though Bitcoin goes to $500,000. Let's make that assumption and let's see what it does to the math. And this is something that the bears absolutely hate because they act as if the only reason to buy a Bitcoin Treasury company is hope that the MNAV multiple expands and then you can sell at the top. And then everybody buys from you and then you get out. As if that's somehow different than you're selling Bitcoin, but it's not. You're selling to a willing buyer. There's 2 sides to every trade, but whatever. Even if the MNAV goes down to 1 at the end, remember, I went ahead and said we're going to hold that ending MNAV at 1 right here. The premium collapses. What do you think happens? You still outperform Bitcoin. You get an 11.4x stock multiple. Because you get the move in the Bitcoin price, you get the move from the amplification, and then because the move in the MNAV, you would multiply that by something that's below 1, the 0.73, and then there you go. That is outperformance over Bitcoin by a pretty sizable margin there, 11.4x versus 7.73. If we move the Bitcoin price from $500,000 to, let's say, 300K, that situation would still outperform Bitcoin, even though the premium collapsed down to 1. And that would imply an ending stock price of $72.06 here with the MNAV going to 1 and the Bitcoin price going to 300K. So yeah, this is just proving that you don't even need premium expansion to outperform Bitcoin. That is a myth from people who cannot do math. And in addition to that, you also could expect a premium collapse below 1 and you would still outperform Bitcoin. This is just the math. You can calculate your own break-even MNAV if you think, I want to be able to sell 3 years into the future to hopefully capitalize on a Bitcoin bull run, buy my family lake house, whatever your financial goal is. Maybe you want to buy a crack house. Maybe you want to start a meth lab. We all have different goals here. I'm not going to judge, everybody's different. But right here, I've went ahead and calculated a break-even MNAV because I went ahead and put in a 0.81. And still, let's go back to that return decomposition. What are you seeing here, folks? You are seeing still outperforming Bitcoin, even though the MNAV collapsed from 1.36 to 0.8. 1 right there, 4.69x in the stock, 4.64x in Bitcoin. So after assuming the premium collapse risk, you still get the amplification and that leads to outperformance. So let's do a more bullish scenario, shall we? Let's say Bitcoin is at 600K in 5 years. It's the year 2031. We're in the summer. We're going to say Bitcoin goes to 600K over 5 years. And let's just say digital credit really takes off and they actually increase their rate of preferred issuance this. Let's bump up that $65 million per month to 80 because, you know, I think that still would be close to the year one pace. Because remember, we adjusted that number for 12 months, a full year, but it IPO'd in November. So let's just go ahead and put 90. Let's just do 90. And let's just say that the MNAV expands linearly over time. Now, let's also do something interesting. Let's assume that they sell some common shares at a premium too. How much that should be, I have no idea. Let's just do $40 million a month. You know, we'll see what that gives us. That would make ASST go from $11.49 today to $283.01 per share. Your current residual exposure is right here, just over 13,000 sats per share. This scenario would amplify that to 31,446 sats per share of common equity Bitcoin exposure. That is pretty rad. Your 1x MNAV price would be $188.67. And then assuming the MNAV moves linearly from a 1.5 to a 2, this is where it starts to get really fun. You would have $393.50 per share for a share of ASST when it's $11.49 today. Now let's go back to a 1.5 MNAV and let's go ahead and assume that Bitcoin hits $1 million in 8 years. The MNAV has moved down to a 1.5 again. We're holding that flat, but we're going to project out 8 years and $1 million Bitcoin. Super fun stuff. And also, this is assuming that that dividend rate never gets lowered. They pay 13% cost of capital for 8 straight years. So is that realistic? Probably not. I think it'll probably go down, but hey, another bearish input. That is an ending implied stock price of $491.63. Pretty bullish stuff there. The ending 1x MNAV price is $327.76, and this would be close to a 43x over a 15.4x for Bitcoin. So great outperformance over Bitcoin on the way to $1 million Bitcoin. That would be the graph of your common equity Bitcoin exposure going up and to the right over time. You know, that would be pretty rad because it's amplified Bitcoin. Now, what's interesting is that they would have to raise a lot more SATA to keep it amplified at the level that it's at today. That is the senior claims as the percentage of the balance sheet, and that will drop pretty considerably on a violent Bitcoin move upward to $1 million. So, you know, clearly in order for them to really keep Bitcoin amplified, they got to keep issuing SATA at a higher degree than that $90 million a month that I just put in. So there is your full table, that linear move of Bitcoin going up and to the right over time, and essentially the implied stock price just marching on upward month after month after month. Is it going to move in a linear basis like this? Absolutely not. No, it isn't. The MNAV is not going to go up linearly, nor will the stock price, but I don't know what the volatility is going to look like, so I always like to do linear projections. Now let's just do a fun little bull case, because we're going to assume that Bitcoin goes to $1.3 million over 10 years. Let's see where that takes us. I just put the number in. $1.3 million over 10 years. And let's assume that they issue $100 million of SATA per month on the way there. Can they do that? I don't know. That'd be rad if they could. We'll see. That seems super bullish, but that is a lot of money raised. What is the implied stock price at that point? It is $665 right there at just a 1.5x MNAV. Remember, this is not me saying this will happen. I'm just showing you the math blatantly in public here. Not financial advice, financial entertainment. But this is where it's interesting. Even with this bullish scenario, look at actually what it does to the total ending Bitcoin. This sounds crazy, sounds bullish. This only gets them to 61,792 Bitcoin, which is wild. The senior claims will shrink over time. Your common equity Bitcoin goes up, but you only end up with 61,792. And this just shows you that, hey, we're in a digital gold rush. The management team will probably sell more common stock at a premium to buy more Bitcoin to juice those returns long term. So this is just showing you that, you know, this math seems super crazy, but look how much Bitcoin strategy can buy once they got to scale. Who knows what can happen with Strive. Anyway, that is the video for today. Pretty bearish results, you know, with some bearish inputs in my opinion. We did have some fun at the end there, but hopefully you can now understand the value proposition, why somebody might buy a treasury company over Bitcoin, because the amplification is sitting there. It's already embedded. I don't really need them to issue that much more SATA, and I don't need strategy to issue a lot more STRC because the math works with the amplification that's embedded right now. Anyway, that's the video for today, guys. If you could do me a favor, like the video, subscribe to the channel if you have not. I will see you later, my dearest little goblin rat children. Class dismissed. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for Corporations, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. People continually ask me, Adam, why would I buy MSTR over Bitcoin? A lot of people do not understand the magnitude of what strategy is building, and this is a video about the grand vision going forward. People continually think that Michael Saylor is trying to run the world's largest Bitcoin ETF with a software company stapled onto the side. But that is not true. He is attempting something vastly more ambitious. Strategy is really annexing the monetary base of the next civilization, and this is misunderstood by so many people, whether it's those crypto bro traders on Bitcoin X claiming that Saylor is being a bad Bitcoin trader. There are some people who understand what the grand master plan is, and there are some people who do not get it at all. You got to understand that Bitcoin is cyber Manhattan. It is finite digital property, and MSTR is the acquisition vehicle. You can look at Bitcoin as territory, and the endgame is a new hierarchy of global capital with strategy at the center of it. MSTR has been a great acquisition vehicle for finite, scarce digital capital in Bitcoin, but now we have the preferred securities. They are this embedded financial machinery that is being welded onto the entire apparatus here. The ultimate objective is to construct an entire hierarchy of credit, income, liquidity on top of this scarce asset, this scarce reserve asset that strategy cannot manufacture, okay? And this is what is important, because when you look throughout history, every single previous financial empire eventually acquired the ability, either directly or through the government, to just create more units of the thing supporting its liabilities. And then when the arithmetic becomes uncomfortable, the rulers, they always change the arithmetic in society. This happens time and time again. You can look to countless examples. Coins get clipped, paper claims get multiplied, convertibility disappears, you can't redeem your paper currency for gold. That happened in the United States. Central banks just purchase the debt and it just gets easy for everybody. And then they just kick the can further down the road with monetary repression of the country's citizens. This is a tale as old as time at this point. But Bitcoin obviously refuses to participate in this ritual, and Saylor, I feel like, understands the game better than anybody else. He understands that the free market is a PvP game. Hey, when you want to accumulate the most of the best asset and you are in first place, that means you're winning the actual game here. So the market participants are participating in this digital gold rush of acquiring Bitcoin. And you know, if you're going to acquire the territory honestly, if you're going to win the game and play it better than anybody else, that might be a reason to invest. That is my entire thesis as to why I am an MSTR shareholder. So this is the grand plan. We're going to get into more detail. Essentially, it's to build a monetary institution on a foundation that any institution cannot corrupt. MSTR is one financial product out of many, but it is the first vehicle that has been capable of making the crossing, monetizing the bridge between the old fiat system and the new Bitcoinized future. We are pilgrims on the Orange Mayflower, kids. We are being transported into the age of the next monetary architecture, and Saylor is steering the ship. You guys are going to love this video. It's super bullish on MSTR, and it will actually explain the strategy, the end game, the grand vision of what is going to happen and why this will be the most valuable company in the entire world. And you guys know how much I love MSTR. I love the institutional adoption wave of Bitcoin because I want the network to be monetized and I want to get rich. But if you really must understand the true revolution, it's Bitcoin in self-custody, and my friends at the Bitcoin Way will help you be your own bank. Be a sovereign Bitcoiner running your own node with the best open source tools, and they will help you do it with a free introductory call. You can go to thebitcoinway.com/Adam. You can scan that QR code. The link is in the description. Participate in the real revolution of the first ever monetary neutral free market of money, and that is Bitcoin, my friends. So please click the link below, get started today, become a sovereign Bitcoiner, and take control of your sovereignty. So let us count the sacred tables of arithmetic, because when you break down the numbers, things start to get a little crazy when you put it into perspective of what this operation has done in a little over half of a decade. Since August 10th, 2020, the Bitcoin miners have produced 1.595 million Bitcoin. That's simple, but during the same period, Strategy has accumulated 843,775 Bitcoin. That is 4.21% of the circulating supply. I am not claiming that Strategy purchased these Bitcoin directly from the miners as they became available. This is a supply equivalent comparison here. 52.87% of all miner issuance. Yes, they acquired the equivalent of 52.87% of everything the global mining network produced for nearly 6 years. That is one of every 1.89 Bitcoin mined. One corporation now holds 4.21% of the circulating supply of the hardest monetary asset humanity has ever created. You need to read those numbers again very slowly if you do not understand the magnitude of what is happening here. Thousands of mining facilities, just across multiple continents, they consume power across these multiple continents, billions of dollars of specialized equipment screaming inside of warehouses, engineers negotiating with energy grids, the mining pools coordinating global hash power, the protocol executing the largest decentralized monetary issuance program in human history. And one man with a suit stood at the other side of the conveyor belt with a corporate treasury and has collected the equivalent of more than half of that output. And the bears describe this as a Bitcoin ETF with extra risk? Really? Do you not understand the accumulation? It would be like if these people transported back in time to 1803 and they witnessed the Louisiana Purchase and they thought that it was Thomas Jefferson doing a real estate flip that should be on HGTV. You got to understand that it's not trading here. Saylor is not placing the chips on red. He's not walking into a casino and placing a bet on a roulette wheel. He is absorbing monetary geography. And the market just remains obsessed with the next week, the next day, the next quarter. Will MSTR issue shares? Will the premium expand? Will Bitcoin visit the realized price of $53,000? Is there going to be a death spiral? You know, right now there's some 43-year-old balding guy named Brent. He's on his trading view and he's drawing descending wedge patterns on an MSTR chart, while strategy is accumulating a percentage of absolute scarcity that was previously reserved for religious endowments. Strategy has now acquired 843,775 of the only units that can never be replenished, okay? This is not corporate treasury management anymore. This is monetary annexation that is being performed through SEC filings. So you might say, Adam, that's cool. Those are some fun numbers, but what is the big deal? Let me tell you, you need to understand that civilization itself, civilizations are built on substrates. What do I mean by that? Well, we can look to Rockefeller. What did he understand better than anybody? He understood that industrial civilization would run on oil. Andrew Carnegie understood the physical skeleton of the new world would be steel. Railroads accumulated rights of way because controlling the corridor meant controlling the movement of goods, people, and capital. And this is how civilizations are constructed. There is a base layer. Why did empires hoard gold for thousands upon thousands of years? Because military power and commercial power eventually settled their accounts in the same scarce metal. So when you look to how society is constructed, you need to understand that the intelligent actor out there, they don't wait until everybody agrees that a resource is indispensable. They accumulate it while everybody else thinks that it's still optional. Saylor is seeing the end game decades before everybody else, literally decades, and that is why you have to have a very long time horizon view. He sees Bitcoin becoming the world's capital infrastructure before all of the pension funds and insurance companies and sovereign wealth funds and the other corporations, before they fully understand what is happening. As oil powered industrial civilization by converting that stored chemical energy into useful work, the same thing is happening Bitcoin, but instead it's going to collateralize the digital civilization by providing a scarce, globally transferable asset against which financial claims can be measured and finally settled. But still, Bitcoin possesses a characteristic that oil never had. More territory cannot be discovered with Bitcoin. There is no Saudi Arabia of undiscovered Bitcoin beneath some orange desert. Exxon cannot announce that satellite imagery revealed another 14 million Bitcoin under French Guinea. Congress cannot create a strategic Bitcoin manufacturing administration and appoint a bunch of men named Craig who print every email before reading it. The entire geography is known of Bitcoin, 21 million units forever. This is the continent. These are the borders. No expedition is returning with future Bitcoin, okay? You can't make more of it. Which might mean that accumulation of Bitcoin has a terminal character to it. Every single Bitcoin strategy acquires permanently changes the distribution of an absolutely scarce asset. Most market participants, they absorb this information after being psychologically lobotomized by 70 years of financial television. They can understand a quarterly earnings beat, and they can also grasp the concept of a price target and an earnings call, earnings per share. They can understand a man who looks like a medicated goat farmer, like Jim Cramer, yelling oversold while standing next to a touchscreen on CNBC, but they struggle to understand permanent acquisition. Saylor is drawing property lines around digital scarcity before the rest of civilization recognizes that it is standing on monetary land. And by the time consensus arrives, guess what? The surveyors are going to be finished. And it's beautiful. Bitcoin solved the base layer problem. Saylor understood this before anybody. And honestly, I'm surprised it took anybody 11 years before they got it. Digital scarcity, final settlement, a monetary asset that can move across the planet without permission from anybody. But unfortunately, a reserve asset alone is not a complete financial system, okay? And this is where the philosophical disagreement in the Bitcoin community starts. because it's very simple. Some people like Bitcoin as peer-to-peer electronic digital cash, just what the white paper tells you, which is all fine and dandy. It serves that purpose, and that is a beautiful thing. I love being able to transmit value to somebody else across the globe at the drop of a hat with no permission from anybody. That is a beautiful thing. But Bitcoin is a free market. It is a neutral technology. Satoshi disappeared, and guess what? He left humanity to absorb this beautiful creation, and we are finding other use cases. What is it? Well, civilization itself, it has required for a very long time things like income, credit, collateral, maturity, transformation, duration, working capital, and instruments that hold relatively stable value over short periods. Now, obviously, Bitcoin is incredible, but it's very hard, in my humble opinion, to make the case that it can be sold to everybody, especially after it just nuked 50% in a world that is still, unfortunately, fiat denominated. And I also think that a lot of the Bitcoin community, they have a subjective political preference about the end state of Bitcoin, what it must mean for me for Bitcoin to win. But unfortunately, the Bitcoin white paper, it is not a political document. It is literally just describing final settlement of peer-to-peer electronic cash, no counterparties involved. That serves a beautiful purpose, but it's not a political manifesto. It's a technological document. And the reality is that humanity is always going to follow rational incentives, just like they did with the next best thing, which is gold. You can look throughout history. Gold existed for thousands of years, but economic activity eventually developed banknotes, deposits, bills, bonds, loans, and the credit markets above gold. So some people think that Bitcoin's win condition is that the government just disappears one day because we can live in an ANCAP society where we're transacting together. Investment doesn't exist anymore. Equities don't exist. People don't want to return on their capital, so they don't invest it. It's total nonsense. That will never happen. And this is why I'm more of a pragmatic Bitcoiner, because I believe that Bitcoin can serve as the foundation base layer. And not only that, but the best ever base layer that humanity has ever seen. Bitcoin has arrived with this magnificent bedrock and almost no architecture around it. And Saylor's grand master plan is to build that upward. Credit instruments will always exist with humanity. That will never, ever go away because people want to distribute risk across time and across balance sheets. This is something that will always occur. We're never going to live in some anarcho-capitalist utopia where everybody abides by the non-aggression principle. Unfortunately, for a lot of the libertarian Bitcoiners, I'm sorry, this will never ever happen. A much more realistic win condition for Bitcoin is we can still get rid of fiat money 100% if you think that is your win condition, but your subjective relativistic political preference of governments being obsolete, that will never ever happen. So there's a difference between fiat money and government money. We've only had fiat for 50 years. Sorry, but government itself is just an abstraction. It's a word that we use for a group of people that enforce rules upon society with coercion and violence. The libertarians have that correct, but unfortunately, that's never going to go away because humans will always have a different definition of what constitutes aggression. So people will never agree on abiding by a non-aggression principle. So the libertarians in the Bitcoiner movement, unfortunately, they are too idealistic. This is the path forward. It's going to happen. You already see it. That's why you see so many people kicking and screaming right now, because they think that their precious libertarian stateless money, nobody will ever touch it. But unfortunately, governments are an abstraction. They are made up of people, and unfortunately, people follow rational incentives. Therefore, people in governments will also want the most of the best asset. We already see that happening right now with the strategic Bitcoin reserve, legislation around the world. What El Salvador is doing, we're already seeing this, so this isn't even my opinion, it's a fact. Bitcoin is going to remain the incorruptible reserve asset. If you want to spend your Bitcoin, that will always be there. Nobody's ever going to take that away from you. You can run your own node. You can transact with somebody else who is also running a node. But clearly, this thing that's being engineered, it can be bedrock for a monetary architecture. Bitcoin-backed credit is in its infancy. It's going to be combined with conventional liquidity reserves to create stable value instruments useful for corporations, retirees, savers, and payment systems. And this is the leap leap that most people are missing. Saylor doesn't believe that every single retiree should raw dog a 60% annualized volatility while checking his hardware wallet while he's 85 years old and he's in the waiting room of a regional orthopedic clinic. Don't you think it's probably smart that network effects can be derived from increased capitalization of the Bitcoin network? I think that is a much more rational path forward as Bitcoiners here. We should recognize reality, recognize that there are pools of capital out there that should have a Bitcoin compatible instrument designed for its particular mandate. Bitcoin can be the foundation for that, and strategy is becoming that financial transition layer. The protocol remains simple precisely because the institutions built around it can become complex to serve different needs of individuals. Bitcoin can improve the lives of millions if we let the development around it happen. The cathedral does not improve the granite by rewriting the molecular structure of the granite. It builds upon it. You can think of Bitcoin as monetary crude oil because it's enormously valuable. Obviously, you've seen what's been happening with the oil prices lately. But modern civilization does not pour crude oil directly into your Honda Civic. It refines one resource into gasoline, diesel, jet fuel, lubricants, plastics, and thousands upon thousands of structured, specialized products. And strategy is just attempting that same transformation with raw Bitcoin exposure. Raw BTC serves the sovereign individual who wants direct ownership of digital capital. I'm one of those people. I love saving my life energy in Bitcoin. But MSTR serves the investor who wants first loss equity. You know, you are getting the residual after the senior claims are accounted for in that capital structure. You get maximum upside with the amplified sensitivity to Bitcoin price movements. Now, there's also part of me that wants that as well, so I am actually both. I like my sovereignty, but I do like going out on the risk curve to try to outperform Bitcoin in Bitcoin terms to hopefully acquire more of the sovereign digital capital for my bloodline. Strike combines the income plus some equity participation as well, so you can get paid to wait for Bitcoin and then therefore MSTR to go up. Stride and Strife, they offer the more long duration credit, you know, with different degrees of seniority and investor protections. And Stretch is more of the par oriented with that par stability mechanism that hopefully gets kicked back into gear here soon, but it is more shorter duration credits, you know, this experience with this variable dividend. If you're interested in Stretch, like most people are, that is pretty much the simple, if you like money, you buy Stretch. And they have proposed this concept of digital money. Now, in my opinion, Bitcoin is money. We can use it as money, but unfortunately, it is in its monetization phase where it is absorbing the monetary premium from all the other assets in the world, and it is a very volatile process. So we are in the infancy of using Bitcoin as money. Now, there's a lot of people that absolutely hate that Saylor has even used the term digital money. I have a very nuanced view on this. I don't like the term either necessarily, but if you could think of some securitization of Bitcoin and maybe even a derivative of a credit instrument where you strip more of the volatility out, you have a zero volatility thing that pays you maybe 5 or 6%, something above the risk-free rate that you can transact with hopefully zero volatility, whether or not that can be constructed. You know, obviously this is a niche. I think a lot of people do have an issue with the semantics of calling something like that money, so I'm not a fan of the title, but I do think if you can serve an investor pool, a global capital pool that wants something like that, and if you can deliver it using Bitcoin on your balance sheet where you're making it economically feasible and you can help capitalize the Bitcoin network, I think that is a win at the end of the day. This might be a controversial position to have as a Bitcoiner, but in my humble opinion, I really think that increased network effects are going to happen as we continue to capitalize the network. I think $1 million Bitcoin will drive a lot of eyeballs to Bitcoin. They will be directed to an endless stream of Saylor podcasts and Bitcoin Wizard content. Hopefully these people get orange pilled. I think that something like what they are calling digital money, that can still serve Bitcoiners and improve people's lives at the end of the day. So I don't throw my arms up in rage when they use this term. I'm not the biggest fan of it, but you know, that is what it is. That's my opinion. But this is the grand master plan that we don't need the entire world to become ideologically orange. We just need the world to select the instrument matching its risk budget. And the beautiful thing is that Bitcoin is permissionless. You can go ahead and continue to transact with the network any way that you want to, despite these things being built on top of it. Just like how if you didn't like gold credit, you can go buy gold if you want to. You can walk into Costco and buy gold. I just think as long as the dollars continue to flow into strategy, it's the ultimate corporate speculative attack. Borrow in a weak currency, buy the best asset, accumulate Bitcoin, and then the monetary territory continues to disappear into increasingly permanent hands. We power up the network, drive capital to it, and then Wall Street can deliver dollars and receive the financial hydrocarbon of its choosing, yada, 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 but Saylor keeps buying the oil field. It's just reality that different investors want different relationships with the future. That is, when you get down to brass tacks of it, that is reality. Credit investors want income today, maybe because they think they're going to be dead in the next 3 to 5 years. Corporate treasurers might want liquidity tomorrow morning. Now, if strategy can provide these different tools to these different classes of investors using Bitcoin as that monetary base, and I get rich in the meantime, and they work around the clock to continue to make Bitcoiners rich as Bitcoin continues to be adopted in the world, in my opinion, I think Saylor and Strategy have done more for Bitcoin than anybody, and nobody else comes close. There's literally not even a close second place. They can continue to sell certainty to the impatient and convexity to the patient, and I have zero issues with that because they're not stopping you from buying Bitcoin. And in fact, nobody has done more to advocate for Bitcoin than Saylor himself. And this is why Michael Saylor's Endgame is bigger than just MSTR. MSTR is the covered wagon. Strategy is the settlement. Bitcoin is the continent, and the orange frontier is closing. My name is Adam Livingston. I am the Bitcoin Wizard. Thank you so much for tuning into today's transmission of the Orange Gospel of Bitcoin. If you enjoyed this video, please hit the like button, subscribe to the channel on YouTube. That way you can support me spread the Orange Gospel of Bitcoin to the masses. Have a terrific day, everybody. Do not party too hard. Class dismissed. And you know how excited I get about Bitcoin treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own, Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
What we're really trying to do is blend both the balance sheet kind of investment component with true Bitcoin native operating businesses.
Okay, so now I want to pivot back to UTXO management, and we had this latest announcement that UTXO management and BTC Media are joining under the Nakamoto umbrella, which apparently some people were surprised about, but it's something that had been discussed from day zero. I remember that kind of being an obvious alignment. And so what's the vision for kind of building a Bitcoin native company in the public markets?
So yeah, with Nakamoto, we finally finished this large M&A transaction to really consolidate the businesses we've founded and grown over the past decade into Nakamoto, now a publicly listed company on the NASDAQ. And really our vision is to kind of continue the work we've been doing for the last decade, but with the support of the public capital markets, and also to chart kind of a new course or a new vision for what a Bitcoin treasury company, a Bitcoin balance sheet company could look like in Bitcoin markets. And we have a ton of respect to Strategy and Michael Saylor and MetaPlanet, all the companies that have created their own vision of what they could look like. What we're really trying to do is blend both the balance sheet kind of investment component with true Bitcoin native operating businesses. And we see there being so many synergies and opportunities that are created not just by buying Bitcoin and raising capital to buy Bitcoin, but also to be able to deploy that capital into businesses that are aligned within the Bitcoin ecosystem, that all have their own growth trajectory and financial potential. And so, UTXO and BTC Inc. are the obvious candidates, being a part of what we've been involved in the past decade. But I think our vision even goes beyond that, and there's other sectors, other types of financial services, other types of opportunities we see to serve the Bitcoin community that we could do even more effectively at larger scale through a publicly listed company like Nakamoto.
So the idea is that we all think Bitcoin's value is going to increase. There are businesses that are operating businesses that, like with the conference, as Bitcoin's value increases, the conference grows. I mean, that's empirically what we've observed. And so the vision is that on top of the Bitcoin balance sheet, you've got these operating businesses that are really correlated with Bitcoin.
That we think give us, effectively even more leverage on the growth of Bitcoin and hyper Bitcoinization. Yeah. And I think, it's great if you're running a construction company and you want to put all your net income into Bitcoin and grow it that way. But it's a whole another paradigm if you're running businesses that scale proportionally with the growth of Bitcoin. And so like a custodian or a prime broker or a media company or a hedge fund, things that, if Bitcoin 10x's from here in price, not only does the value of your balance sheet go up, but the market for your operating businesses also grows 10x, or the fee income you can generate from your custody business, et cetera, grows proportionally with the price of Bitcoin. And so we think that's what will give us kind of the most leverage on the growth of this industry and creates a ton of synergies within those different operating companies.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Strategy spent last week selling more MSTR shares to add cash to the USD Reserve, and they purchased 0 Bitcoin, and immediately this inspired the usual online funeral procession for MSTR shareholders. We are being diluted. We are being sacrificed. Yes, we are hearing this over and over again from the totally uninformed out there. Apparently, cash entering a corporation vanishes into the same metaphysical dimension as missing socks and congressional accountability. Yet inside Strategy's capital structure, liquidity has a job. It supports the preferred stock, especially STRC. Because the increased liquidity, it improves the credit profile. It helps Stretch migrate back toward that $100 par value that we're all waiting for. The transaction of adding $200+ million of cash to the USD Reserve, that might look defensive at face value, but in reality, it is reloading the balance sheet for another offensive capital markets campaign. We are going to run the transaction through CEBE today. We are going to examine Strategy's credit rating roadmap. We are going to model Stretch's impact on MSTR. How actually important is it to get Stretch back up to $100? Everybody's freaking out right now. They want it back to $100 ASAP. But I'm going to run the math on how big of a deal it actually is for your MSTR gains if you are an MSTR shareholder. Also, I'll be talking about SATA and ASST, good old Strive. Which one might be the better buy right now? You guys are going to love this content today, whether you're a Strive shareholder, an MSTR shareholder. This is a digital credit update and a reviewing of the capital markets activities last week from both companies. Do me a favor, hit the like button on YouTube and subscribe to the channel if you have not. That way you can support me spread the orange gospel of Bitcoin. Bitcoin to the masses. And I do want to take a second to thank the Bitcoin Way for sponsoring the video. You guys know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption that we are seeing, but do not lose sight of the real revolution. Bitcoin in self-custody, 100% owned by you being sovereign and you being your own bank. My friends at the Bitcoin Way will train you to become your own bank using only the best open source tools that are out there. They will turn you into a node runner and they will make you a sovereign Bitcoiner. Do not delay, your freedom depends on it. You can scan that QR code right there. Go to thebitcoinway.com/Adam. Link is in the description below. So as we review what exactly happened with Strategy last week, well, they sold a bunch of MSTR shares, 2,732,318 common shares sold, and that raised $263.5 million. Now, out of that, they added $225 million to the USD Reserve, so now they have $3.225 billion in that USD Reserve. So basically, when you want to talk about the dividend coverage, they have 31 years in Bitcoin. Yes, 31 years. That is over 3 decades of dividend coverage in Bitcoin, and in addition to that, now they have 22 months. They are zeroing in on that 2 years of dividend coverage in their USD Reserve. So the surface level reaction to this, it's all about the zero Bitcoin purchase last week because people are freaking out. The shares went out, the coins failed to arrive, civilization collapsed, and then of course you have the retail shareholders or people who are not shareholders but somehow have a very nuanced opinion about this. They carve out a tiny tombstone called Bitcoin per share. They cry that it's going down. This was a cash and credit transaction, and it was done while Bitcoin was under stress, which is very important. That liquidity supports the dollar-denominated obligations above the common stock here. Why is this important, you might ask? Because when you look back at when Strategy got their credit rating, and S&P Global published 2 articles about the criteria for, number one, their initial credit rating and what they could do in order to potentially get a better one. They explicitly stated whether Strategy can access capital during a Bitcoin stress. And what were they concerned about? They were concerned about the USD liquidity. The management of Strategy, they walked straight into a bear market in 2026. They raised a lot of money. They deposited some of it into a reserve, and then they took some of that to pay off some debt. That turned out to probably be a little bit of a mistake. Maybe it wasn't totally optimized. Regardless, it wasn't existential, and now they have built it back up to a level that we've never seen before yet. So this is observable credit positive behavior, regardless of whether or not the timeline applauds. So we have 22 months of dividend coverage in cash right now on the balance sheet. Now, is this a positive? Is this a negative? In my opinion, it's a positive if you can get the stretch machine turned back on. This reserve, in conjunction with Bitcoin going up and to the right a little bit, I think it will really help the coverage of STRC, and I don't necessarily think that the market will be demanding such a high effective yield to hold STRC. So I do think this is credit positive. It's good, and at the end of the day, when you are swapping the common equity for cash, and if it's even at a slight premium to the common equity Bitcoin exposure, it's actually accretive for shareholders. It's not dilutive. It is CEBE neutral. So if you can swap equity for cash, remember, as an MSTR shareholder, you absolutely are exposed to the cash. I know it's not Bitcoin. What's the problem? We know that cash earns less than Bitcoin because cash has the metabolic rate of a tranquilized houseplant. Its value comes from endurance because the preferred investors, they want their dollars on a schedule, while Bitcoin continues to experience lots and lots of volatility because it is true, Bitcoin is still in its infancy a little bit. Liquidity just buys time for volatile assets to continually recover, and for a company that's just built around an asset capable of losing 50% in the blink of an eye, time is very productive, so I really like this liquidity runway here. So running the exact math through common equity Bitcoin exposure, because there are some shareholders and non-shareholders that are hyper-fixated on the week-to-week actions of Strategy's management team, I have routinely shown on this channel that ultimately so much of the percentage of the latent gains that are waiting there are already embedded with that 40% amplification ratio. So a little bit more Bitcoin on a week-to-week basis. It actually doesn't matter all that much. I will actually break down the math for you in a little bit here, but if we want to look at the snapshot of the prior week versus this week, if you count only the $225 million reserve increase, it is very, very, very slightly negative in CEBE terms. But if you count all of the net proceeds that were raised, because there was a bit of a discrepancy here between the $263.5 million versus that USD Reserve $225 million contribution, it is actually accretive. But I think what happened, they probably sold some MSTR common stock to pay some of the stretch bi-weekly dividend. So regardless, it seems like it's very close to neutral here. It's a few basis points of neutral. I mean, let's just take a midway point here. I don't know, let's call this 80 sats per share between the two. Using today's Bitcoin price, we just went above 65,000, which is cool. 80 sats is 5 cents. So it's literally 5 cents of NAV per share. That is essentially the difference. So who really cares? And the reason why we are looking at the CEBE and ultimately not the gross Bitcoin per share, because like I just said earlier, well, you are exposed to cash as an MSTR shareholder, so that's pretty cool. Because if you do sit on cash on the balance sheet, you know what a percentage of the balance sheet cash is not? It's not a senior claim. It is part of the residual that you are exposed to when you hold MSTR, so you gotta factor that in here. So this nearly sets off all of the gross dilution. This is why the dilution clowns are ridiculous. And remember, what did I just say about 5 cents of CEBE NAV per share? Who really cares here? If this helps get the stretch machine turned back on, I think it will be worth it for the MSTR shareholders. And strategy is laser-like focused on getting stretch back up to $100. I'm sorry, but we don't even have to look back a month. On June 29th, you guys got to remember, they came out with the Digital Credit Capital Framework, and obviously Saylor and Fong Li, they have both come out on X ever since this was published, and they've said they want stretch back up to $100. And the exact sentence from the management team says, Strategy's corporate objective is for STRC to trade over time in a range of approximately $99 to $100, close to its $100 stated amount. And this is the simple plan in a flowchart form. You take the cash, you increase the credit confidence of the instrument. Hopefully that lets stretch go back up to par, and then the ATM reopens, and then you get to buy more Bitcoin and juice the amplification of MSTR even further. By now, I'm sure you're starting to notice that all of the MSTR bears that have been crying about MSTR's imminent death spiral since February, all of these people are ridiculously stupid clowns. And I have been proven to be totally correct, that there isn't an existential crisis during this bear market. They are raising billions of dollars at the drop of a hat, a fraction of the deep pool of liquidity that MSTR trades at. Bitcoin bear markets don't last that long historically, and we have been in one since October already. We're 9 months in, and guess what? Strategy continues to raise more capital faster than they ever have, and all of those latent gains are sitting there just waiting for Bitcoin to go back up. And remember, during a Bitcoin bear market, S&P published their 3-part credit roadmap for strategy. Number 1, improve the dollar liquidity, which they're doing. Number 2, reduce the reliance on the convertible debt. They retired $1.5 billion of that. And number 3, access capital in stress. So through this Bitcoin bear market, after Bitcoin has corrected 50%, they are literally hitting on every single part of S&P's roadmap that they handed strategy back in December. So by literally any objective measure, even if you don't want to look at anything and use BTC yield, it's still up year to date. Strategy's having their most successful year of capital raising ever, and they are knocking out the criteria for inevitable S&P 500 inclusion because their credit rating is going to go up. You think it's not? Bitcoin's going to $1 million. They're going to have 1 million Bitcoin. That's $1 trillion in net asset value at a minimum. So Strategy's dominating, and the haters are just foaming at their mouths. Now everybody is freaking out about stretch getting back up to par, and honestly, I haven't even looked at today. So let's look and see if the market liked this cash reserve edition. Hey, check that out. Not bad. It's actually up a couple dollars, 2.13%. Not terrible. We'll take it. And it almost hit $89 intraday just about 28 minutes ago. So it seems like this is working so far. But regardless, the big question is, oh my gosh, can they please just get it back up to par? There are so many MSTR shareholders who have the time horizon of ants. They literally don't have patience at all. They're saying, Adam, stretch needs to get back up to par. We need to buy more Bitcoin. Yeah, That would be ideal, I'm not gonna lie, but I also have patience. The real question is, how much more stretch issuance will juice my MSTR returns? So I went ahead and crunched the numbers, everybody. I ran some projections and I basically normalized, I indexed all of the returns by controlling for a variety of variables. I assume that Strategy does not issue any more MSTR except to pay the dividends. I assume that Bitcoin goes back to $100,000 that you can see right here. And then the different scenarios are that MSTR goes up with no stretch issuance, and then 4 different scenarios where they're issuing $500 million a month, $1 billion a month, $1.5 billion a month, and $2 billion a month for the next 12 months as Bitcoin climbs back to 6 figures. And also there is zero MNAV expansion. The MNAV stays exactly where it is today, which is very slightly over the net asset value. So it is a very small premium. And what are the differences? Well, it's actually not too crazy. I know the additional stretch issuance, it will help 100%, but people continue to ignore the latent gains that are already sitting there. Bitcoin is going to go up and to the right because we're all Bitcoin bulls. And there's also embedded amplification there already because of the outstanding preferreds and the outstanding debt. And so MSTR with no stretch issuance, the two gears in the formulaic equation of what actually dictates the MSTR multiple, you got the Bitcoin going up and CEBE per share going up, which is actually derived from just gear one, the Bitcoin price going up. So one variable changing actually influences two variables in the MSTR multiple. Therefore, amplification happens. This is what the math tells you with zero MNAV expansion. MSTR with no stretch issuance at all in this scenario goes up 76.35% and it outperforms Bitcoin by 22%. So there you go. You get a 76.35% return. If they're able to issue $500 million per month starting today for 12 months, you only get less than 3% additionally, less than 3% again if they go back up to $1 billion per month issued. $1 billion per month would be slightly over their first year pace ever since STRC came out. $1.5 billion would actually still add less than 3 percentage points of return. And then $2 billion a month, which is close to their 2 best months ever, April and May. This would juice the return up to an 87.9%. So that would be about a 34% outperformance over Bitcoin versus the 22%. So yes, would it be great if they could get the stretch machine turned back on as soon as possible? 100%. I think it's a matter of waiting for Bitcoin to go up, hopefully raising that dividend, because I do think they need to be more competitive with SATA, because I think both instruments right now are competing for retail cash flows here. I don't think that the retail investors are doing sophisticated credit analysis at all. They are seeing the higher headline yield for SATA and they are seeing more frequent dividends. That's why I think SATA is being more successful right now. And that is the math broken down for what actually $24 billion of stretch would create for the residual if we did have Bitcoin go up to $100,000. The numbers are pretty sweet because Bitcoin is cheap right now. That's why people do want the stretch machine turned on, because this would get them over 300,000 Bitcoin. And honestly, I thought that they were going to get that much this year because they came out this year swinging for the fences. Stretch was really successful. They were issuing a lot of MSTR. So they were buying a lot of Bitcoin. We're having a bit of a slowdown as of late, but we've seen some Bitcoin price stress. Ultimately, I'm not concerned knowing that the higher the Bitcoin price goes, Strategy just has the capital markets access available more to them, and that's when they can buy more Bitcoin. Regardless, that's how the math breaks out. Now, SATA is running the same exact play inside of Strive, but they do have a smaller denominator. The corporate wrapper is dramatically smaller. We know this. Strategy has over $50 billion of Bitcoin. Strive has about 1 billion. So literally 50x the size we're talking here. Now, basically, I went ahead and modeled that same exact Bitcoin move going from $65,453 today to $100,000. There is a slight discrepancy in the Bitcoin price from when I calculated. You guys will see that. But regardless, it seems like ASST is going to rise 82.01% if the MNAV stays exactly where it is, which probably won't happen. But adjusting for just the current amplification, them issuing zero more SATA, and this is just the amplified move with the amplification that already exists on the balance sheet. They don't have any leverage because they don't have debt, so it's only amplification with Strive, but this is closer to a 30% outperformance over Bitcoin. Now, obviously, obviously the big question is, okay, with their smaller scale, they're not able to issue as much preferred equity because you can only issue so much before you're 110% amplified Bitcoin. And do they want to run it that high? Probably not. Is there demand for that? Probably not, because it's trading below par right now when they are offering a 13% dividend. But regardless, I did plug in some projections. What if they're able to issue $100 million per month in SATA for the next 12 months? I'm not saying they will. I'm saying, what if when the machine gets turned back on? What if they can do $200 million a month? What if $300 million a month? Now, I don't know which of these numbers is possible. None of this is financial advice. This is financial entertainment. You need to underwrite your own assumptions, but I did want to demonstrate how much harder the SATA issuance hits the convexity of the common stock, this amplified expression of Bitcoin, as you continue to add on those preferred senior claims. The difference is quite staggering here, because if they issue nothing and Bitcoin goes to 100K, that's an 82% return for ASST with zero MNAV expansion. But if you can issue $100 million a month, that juices the return by 30 percentage points, literally 30, while Bitcoin is obviously staying at that 52.78% return. If you could add another $100 million on top of that, that would be an additional 28 percentage points. And then if you could issue another $100 million on top of that per month, that means that that would add on another 28 percentage points of return. Look at the gap here between the Bitcoin and the SATA issuance. It's a considerably bigger gap. The torque that's hitting the balance sheet when you compare it to strategy. ASST magnifies the effect because each dollar is landing against a much smaller equity base here. Obviously, Strive is super small. Would they be able to issue $3.6 billion SATA over the course of a year? I think it's not impossible, maybe in a Bitcoin bull market when everything's firing on all cylinders. But regardless, you can kind of see how much this would help amplify those Bitcoin terms when you look at the senior claims as a division problem with the Bitcoin assets there on the denominator. It goes up considerably. They juice the amplification despite Bitcoin going up. And because it's a division problem, you have the senior claims rising faster than even the Bitcoin going up. So who knows exactly how much they're going to be able to issue, but I just wanted to demonstrate that small denominator is killer for ASST. And if you wanted to calculate how $10 million of each preferred stock issuance would hit both of these equities, it's very simple. Look at the $10 million as a percentage of the MSTR wrapper here. It's actually 0.027. That's it, but compared to Strive, it's 0.971. That is a 50x advantage for Strive. 50x. So yeah, that small denominator is a killer advantage. And there's the math broken down for you. You get 4.58x more common equity Bitcoin exposure sats per share per $10 million of preferred issued. And that is a 10.9x increase more return impact per sat for a 50.15x modeled return sensitivity per preferred dollar that is issued. Now that's obviously just within the models that I went ahead and projected those Bitcoin price movements with, you know, the MNAV staying the same, all of those inputs. This is not a permanent physical constant. I'm not saying that. This is just the math on this snapshot. But remember, if you want to talk about the advantages of both of these companies right now, look at Strive. They just bought 21 Bitcoin. They're still having buys that are, you know, relatively really small versus MSTR. Clearly, Strategy has the capital fire hose. They have the scale, but ASST has the Bitcoin sensitivity. That is a great advantage to have. The big question is, hey, if there's a 50x advantage for preferred dollar issued for ASST, how much more can Strategy raise of preferreds due to their scale once Stretch gets back up to par? It's a very interesting question. Can they outrun that small denominator advantage that Strive has? So as we look to this week right now, what I'll be looking at is what Bitcoin's going to do. It's performing really well, above 65,000 and holding very strong despite all of the chaos in the Middle East, having another flare up. And when I look at digital credit, is it dead? Absolutely not. Every single dividend has been paid. I actually think that if you count all of the Strategy dividends from when Strike came out in January of last year, and when you look at all the daily dividends that SATA has paid out, I think that the digital credit issuers have successfully paid out over 60 dividends successfully. If it's not 60, it's like 59 or 58. It's really close to 60 for 60 dividends paid. I look at the asset coverage of both companies. They are massively over collateralized in my humble opinion. They're not pledging it as collateral, of course, but you know what I mean. The coverage is there. Over 3 decades of Bitcoin for Strategy, you know, close to 2 years in cash. And I just showed you that so much of the common equity returns is made up of just Bitcoin going up. So yes, would it be nice to get the preferred issuance machines turned back on for both companies? 100%. It's not an existential crisis to me. I think that we're going to be back at 70,000, 80,000, eventually $1 million Bitcoin. And I think there's going to be a lot of money made on the way because I think that digital credit is still offering a great return per unit of volatility endured. And we are still in the infancy of this thing. So when I look to MSTR, I continue to be nothing but bullish because of the returns when I'm running the CEBE models. Same thing with ASST. I'm heavily allocated to both. And right now we're just in bear market survival mode and both companies are surviving incredibly easily. To me, it seems like they can meet their obligations, whether it's the debt, whether it's the preferred dividends that they have to pay out. And check this out right here, because they're now sitting on roughly $55 billion of Bitcoin, their net leverage is down to 6% only. I don't think I've seen it this low. I think I only saw it at 7%, but their overall debt as a percentage of the balance sheet continues to drop. Just wait till Saylor and Peng can pay off all the debt, do their Dave Ramsey debt-free scream, and then amplify Bitcoin with stretch issuance and boost that amplification percentage from a 40 to a 70. Yeah, you excited for the volatility super gains then? I am. And then we'll load up the CEBE terminal to get that true MNAV where we're at right now, because at the end of the day, we got to use their real MNAV, right, folks? Let's go ahead and import this. And there you go. It's a 1.03x premium to the common equity Bitcoin exposure net asset value. That means that if they want to, they can probably just go raise another $200 million this week. And it would be accretive to MSTR shareholders. So this is my entire point. Can they survive the bear market? We're 9 months in. Keep raising the cash. It's not dilutive. Get the stretch machine turned back on, kick the can down the road, and patience will play out, in my humble opinion. My name is Adam Livingston. I am the Bitcoin Wizard. If you guys like this video, please hit the like button, subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to the masses. Have a very terrific day, everybody. Do not party too hard. Class dismissed. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own, Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
European institutional investor base is massive, obviously, but also very fixed income focused. European fixed income, it's very much fixed income culture. You got all the massive pension funds, all heavily weighted towards fixed income instruments. Kind of hard to get yield right now. I mean, I was in high yield credit for a long time, and high yield credit is basically very low yields these days. So I think that in itself is a big opportunity set.
Think about the scale of AI. How is AI going to use this? People just think that AI is just going to use it to pay. But what is AI? What do robots need? What do people need on a global network, a true extension of the internet? AI wants to use it for validation, authentication, accessing data, and they need to have it happen at the blink of an eye. In other words, money, which is trust, especially for agents and robots, needs to move at the speed of intelligence. You're not going to get that with Visa and MasterCard, but you're going to get that by being able to send, 1/1000th to 1/10,000th of a penny working sats with the blink of an eye to validate. And effectively, the Bitcoin address that they can validate that they have becomes the agent's agentic soul.
But again, Bitcoin can and will only ever be that safe haven in those types of environments if Bitcoin is viewed by the masses, by traders, as a currency. And unfortunately, we've kind of, as Bitcoiners, shot ourselves in the foot a little bit by calling Bitcoin digital gold a digital store of value, rather than calling it what it truly is, the most perfect form of money that humanity has ever conceived.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
With Bitwise in this ecosystem, how do you think about who you're competing with, right? We're going to see traditional Wall Street firms come in and start ETFs, but also who you're working with, right? Who are your counterparties and kind of the partnerships that you see developing?
Yeah. Our view is that in every area of the market on a competitive side, there is a specialist that people turn to because they trust, right? If you're looking at private equity, you might go to Blackstone or KKR. If you're looking at debt, you might go to Apollo. If you're looking at liquid bonds, you might go to BlackRock or PIMCO. People like specialists because they have specialist expertise. Our goal, even though we compete with BlackRock and we compete with Fidelity, is to be the leading specialist crypto asset manager in the world. There are obviously a few firms that we're competing with for that title, but that is our goal. And we think we bring unique benefits, whether you're a crypto native. I note that our Bitcoin ETF donates 10% of its gross profits to open source developers for Bitcoin. That's fairly unique. Or you're a financial advisor. We're like the only firm with a 25-person sales team that's out there meeting with financial advisors in bull markets or bear markets. If Bitcoin is down, we don't shift to talking about private loans or AI stocks. We're always on crypto. So our view is that specialist crypto asset manager space is really large. And we hope to fill that space. On the supplier side, look, we work with everyone. And one thing that is true is we're always trying to level up the quality of our counterparties and always trying to diversify and work across a wider and wider variety of counterparties. I've been at Bitwise long enough to remember the days where we couldn't even have a custodian for some of the assets in our funds, and we had to self-custody those. And then it was like a minor custodian like Kingdom Trust, which was, I forget, located somewhere in the American Southeast. And now you can custody Bitcoin with Coinbase, with Fidelity, Bank of New York, with name your person. We're always trying to level up in that direction. So we'll work with everyone. We want a diverse ecosystem. We love firms that are crypto native, and we work with them when we can. And I think it's just going to get better from an infrastructure perspective.
You mentioned Bitwise is invested in building out a sales team. I think that's really critical to have really, human service and education on the front lines, because there's a huge surface area, right, of different advisors that they have a wide mandate. They don't have like the crypto or Bitcoin specialty, and that's what y'all bring to the table.
100%. Yeah, I used to say that the future of Bitcoin is being built over lunch at Morton's Steakhouse, which is true. Our team does 15,000 meetings a year with financial advisors. So 15,000 touch points, educating them about Bitcoin and the broader crypto market. Someone needs to do that work. If you think about your own personal journey into Bitcoin, I know for some people, they read the white paper, instantly got it, and fully understood but most people are not that. I was not that smart. It's not like the first time I encountered it. I mentioned I left the meeting with Spencer and bought coffee instead of buying Bitcoin. It takes a while. It takes multiple touch points. And so the value of our sales team is we can provide those touch points to people who are managing trillions of dollars of money. And that doesn't mean the assets all come in at once, but it does mean hopefully that there's this rising tide of people who understand what Bitcoin is and the role it can play in the world and in their portfolios.
And that y'all are doing this work even in the bear markets, right? Where I think that investor interest kind of naturally wanes and they're looking at AI or whatever it is, but y'all keep beating the drum because that's the best time to invest during the bear market.
It's the best time to invest. And selfishly, from a Bitwise perspective, it's where we gain ground. We often talk about like the way you win in a bike race is when it's raining. When it's dry, everyone can go fast. Yeah. So while we're talking about Bitcoin in a bear market, I'm not sure people with broader businesses across all assets are doing that. And so we really found that we gained substantial ground in 2018 when we were out there talking with people. I still get thank you notes from people I spoke with in 2018 who are up, 25x on their position. In 2022, the same thing. And indeed, this winter, I think we're going to see the same thing. So that's what comes with being a specialist. This is all we do every day. We wake up. It's crypto only from 6 a.m. until we go to sleep.
So if we think about the most recent bull market, it seems like the catalysts were the launch of the ETFs and then the Trump election. And is Bitcoin down just due to a lack of catalysts, or is there something kind of brewing underwater?
Yeah, I think the Bitcoin is down because the 4-year cycle has an emotional resonance, and OG investors, people who've held Bitcoin for years, sold some, not all of their Bitcoin starting in the middle of 2025. And that's an annoying answer because it's inherently reflexive. They were afraid of Bitcoin going down, so they sold some Bitcoin. But that's what you see in the underlying data, right? Like $100 billion sold out of long-term wallets in whales. But you have to give them a little bit of credit. These are people who probably bought Bitcoin when it was $10 or $100 and are sitting on really substantial gains. And they've lived through crypto winters before, and they know that the market can pull back 75%. And if you were sitting on like a $10 million gain or $100 million gain, and you had seen twice before this freight train come down the track and destroy 75% of your wealth, are you sure you wouldn't sell 10%? I don't know. I mean, I love Bitcoin, and I didn't sell any, but I don't have $100 million of Bitcoin personally. I don't fault them for wanting to step outside a little bit. It doesn't mean they're gone forever. We talk to these people. It doesn't mean they sold their whole stack. It doesn't mean they're panicked about quantum and they're getting out of Bitcoin and buying Bitcoin Cash or something. It means that they're humans and they were sitting on gains, and so they sold a little. And that's really what drove the pullback. Look, I think it's basically over. I think we're merging into spring, and I think we'll go to massive new all-time highs. I'm optimistic what gold says about the store of value market, and I think we'll get our share over time. But I think that was it. These people are human. 4-year cycle still has a resonance with them. And so they took some off the top, and that was enough to send the price down.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets that could pose a threat to Bitcoin.
The quantum concept is, what do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself.
I would say the threat is less imminent than the headlines suggest, and work being done already to address any potential threat in the future is more robust and diversified than people think. And what I mean by that is there's lots of different work already underway that they range from changing the protocol itself or updating the signature scheme to post-quantum proof signature schemes versus, say, having contingencies and plans that would allow somebody, in case in the future they need to move or migrate to that signature scheme, they can. And so there's a lot of work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%. Despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient, and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999, where the world was going to implode. Technology marches forward, and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more, quantum will break everything way, way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin will adapt to it, already is. The discussions are great around it. And we're going to see many, many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but there was even just a paper that was released a couple of weeks ago where, without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
My stance is I should not have to worry about your thing. Like, you can go do whatever you want. I'm not forking off with you guys. I largely agree with 110 ideas to limit data. I disagree with the execution and tactics used to push it.
Is it the right frame to call it a change if they're saying we want to go back to what we were doing before?
But it's not. The 110 fork changes a lot of other things too. I get vitriol from all sides, core included. The core camp is not without fault here. It takes two hands to clap.
You feel like BIP 110 is doomed to fail, basically, or like you don't think it's going to actually work. Why is that?
Emotions are running high right now, but this is not consensus. It can't fly. Otherwise, the barrier to attack Bitcoin is so low.
Samson Mao, welcome to the show.
Thanks, Jake. Great to be on.
Yeah, great to have you today. I'm excited for this conversation. For those who don't know you, you are the founder and CEO of Jan3, whose flagship product is the Aqua Wallet. You're also working with Jimmy Song on a nonprofit called Production Ready, which is a really interesting development to me in the Bitcoin space right now. You guys are working to fund the creation of a third Bitcoin node software implementation. And you're looking to provide an alternative to core and knots. And you're sort of focused on maintaining a conservative node implementation, not focused on let's add all this new functionality to Bitcoin, more leaning towards let's keep things conservative, essentially, which makes a lot of sense to me. Your career background includes serving as Chief Strategy Officer of Blockstream, which was interesting. I learned that doing research for this. When was that you were working there?
well, that's a while ago. I think it was 2017 to 2022 or 21, something like that. It was a while.
Okay. Yeah. Cool. You did before that COO of BTCC, so you were working on a Bitcoin exchange and mining pool, and you had a video game development studio before that as well that you founded.
Yep, I still have it. Pixelmatic, still running.
Oh, okay. Very cool. Yeah, maybe we'll get to that at the end of the conversation. First things first, I thought since the core versus knots BIP 110 conversation is so spicy, we could start there. You're working on this third node implementation with Jimmy, and I wonder first if you could start by summarizing BIP 110, like what is going on there with the core versus knot side of things, and do you have a specific take on the matter? Would you like to remain neutral as a third party in this? Yeah, I wonder where you stand on all of that right now.
Yeah, well, there's no end to spicy things these days. There's a lot of spiciness going around all over both sides, everywhere, up and down, left, right. But yeah, where to start? I mean, the thing is, like, I don't think 110 is a viable solution, and I've kind of tried to ignore it a lot, and people kind of ping me and say, well, you should state your position and say something. And Jimmy tried to take a neutral stance, and he was sort of crucified on that stance by both sides. So the core people said, how can you be neutral? It's going to fail. And then the NOS people said, you're weak and you're unwilling to pick a side. But I think neutrality or ambivalence is a viable stance in this case, right? So I was planning to write a blog post about this or an X article or something, but I haven't had time. Maybe I'll do it this weekend. It depends on when you publish, but maybe I'll get ahead of you. But my stance is BIP 110 is largely unviable, and it should be ignored. And this largely ties into the principles of my thinking behind Production Ready, which is we need a stable ossification-leaning implementation, because Bitcoin is first and foremost money, and you don't want to play with the system and software and network that enables the first sound money that we've really ever had in the world, that is better than gold, better than anything, because it's information and it's bearer. So there are obviously technical arguments against 110 and reduced data and everything like that. But I think the biggest thing is you should be able to not need to care about the current thing in Bitcoin. You should be able to be in a coma for 3 years, wake up and run your node on core 29 and still be able to transact, right? Like having to rally behind and push for something that is an emergency is the antithesis of Bitcoin, right? It's supposed to run perfectly without intervention and the need to campaign and convince people that this is important and you need to do something. The whole point of Bitcoin is that you can do nothing and just sit there with your Bitcoin in cold storage. So,
can I ask you a question about that real quick?
Sure.
Because that seems to me to be, and I'm still trying to wrap my head around like getting deeper and deeper into the technicalities of this conversation. But it seems to me that the NOTS BIP 110 side of the conversation is sort of saying we had a functioning idea, thing that we were aiming at here, and then when Core 30 released, we blew open the filters that maybe weren't perfect, maybe didn't fully do the thing that they intended, but it wasn't saying, okay, now we're going to make this change where we're going to completely open this and allow all of these larger sized pieces of arbitrary data onto the Bitcoin network. So it seemed to me, from my understanding of it, that these were the guys that were saying, hey, how about we don't try to like change it and increase the functionality and add data storage as a feature of Bitcoin, yet we preserve it as focusing on it only being money. Does that seem right to you?
There's a lot to unpack there. So we'll start with the latter part. Like, Yes, I agree. Bitcoin is money. And there was a few months ago, or I forgot, 6 months ago, there was a lot of vitriol tossed at core developers for not saying Bitcoin is money. And then some of them said, yes, Bitcoin is money. But it's not about whether you want Bitcoin to be money or not money. Money is an emergent property. Bitcoin, first and foremost, is software. So I see the really aggressive 110 people coming out saying, Bitcoin is money. If it's not money, it's not anything else. But money is an emergent property of Bitcoin. If you look at rhinestones, you can say, if rhinestones aren't money, they're nothing. Like, what is a rhinestone? It's a rock, right? If gold isn't money, it's nothing else. Like, what is gold? It's a rock too, right? A shiny
rock.
gold rock, but it's still nonetheless a rock. But you wanting Bitcoin to be money does not make Bitcoin money. Like, it is a network effect. It is an emergent property, and it is emergent property stemming from its innate properties. That it is bearer, it is information, it is permissionless, and you can zap it around the world with no intermediary or third party or any gatekeeper. So you can't really say we want Bitcoin to be money. We need to make it money harder. And I see that a lot. Like, even I think in your notes before, you're talking about strategy and digital credit. But this is also a prevailing theme amongst the people that don't like strategy. They're saying, wrapping Bitcoin up in this instrument, STRC or Strive with SATA or MetaPlanet with Mars, it degrades the property of Bitcoin as money. But it really doesn't. It's not that because they did something, Bitcoin is less of it, less like money. It really has nothing to do with it.
Application on top. Yeah, it doesn't change the base. Yeah,
and it is viable for people to use Bitcoin in any way they choose, right? Like, they can put it in an ETF. They can have it as a base asset, a digital capital, building digital credit on top of it. That's the nature of Bitcoin. And if Bitcoin can't do that, then there's something wrong with it. If it has to fit within a narrow definition of a small group of people that, it is money if you do these 5 things with it, then it doesn't really work as money. So you can see it's kind of like it's kind of a conflicting thing there in and of itself, the argument. But going back to your other point too, it's Bitcoin is a very interesting thing. It's almost counterintuitive to a fault. And we saw this with the Bcash, the Bitcoin block size civil war, right? It's a well-meaning thing where you say, well, we need to increase the block size because otherwise people can't transact for cheap, right? It's a very well-intentioned goal that sounds good on the surface, but has deeper implications. Like, well, before we figured out that you could have a block size increase through a soft fork, the thing that was looming on the horizon was a hard fork. And that basically is a totally new thing, a new coin, a new blockchain. And that's not immediately understood, that your well-meaning intentions over here has deep repercussions over here. But not just that it's a hard fork. You're basically changing the rules for some goal. And that's a slippery slope. Like, okay, well, what if the new thing is, well, there's not enough coins. Not everyone can be a whole coiner. We need to increase the supply. So you can see where it goes, right? Once you start tinkering to optimize for some perceived emergency situation, then you just become a fiat currency and you're subject to the whims of a centralized organization or mob rule. And I think it's similar with BIP 110, which is, it's an emergency. We need to stop bad data, CSAM, whatever, everything from getting on the chain. And while, yes, it sounds like a good ideological stance, and it certainly doesn't help that Luke calls everyone a pedo that disagrees with him. But the thing is, it doesn't change anything that Core removed the limit. They shouldn't have done that because it obviously impacted a lot of people and it fragmented the Bitcoin user base. But you could do that even before Core 30, right? And this is me saying that as someone that vehemently disagreed with what they did and thought that they should have left the policy intact, even if it was simply a detriment or a deterrent. But it still doesn't change that you could have done that before, right? Like, even without Core 30, you could still embed data. There are easy ways
what's
around
the case? Like, why did they say that they did do it, right? Like, we agree that it seems to me to be a terrible idea. Like, why make it easier for, you know, this non-monetary data to get onto the blockchain? But what's the case for doing it? Is it just like we want to be able to sell NFTs and, you know, why did they say they were doing it?
It's because for them as a developer, it's really easy, right? You can easily bypass the limit and get the data in. If you're, I think this is the divide. You have very technical, very sharp people that are not that that empathetic or high in EQ, and you have the rest of the users of the network, which largely just download the software and run it. And if you just download the software and run it, then there is no real opportunity to embed data, right? You're just sending a Bitcoin transaction with the Bitcoin client. Either you're running Bitcoin Core itself or using it as a node and something on top of it, but it's pretty straightforward. But if you are technical and you're in the command line, you can easily do all sorts of things very easily. And I think that is probably the biggest gap in understanding here, that core developers think they did nothing wrong because you could have done that anyways. It's like, you know, the image of a park, and there's like a path where people are cutting across the grass, and I guess the city put up a little gate there, right? And it didn't do anything because people just walk around the gate. From a developer standpoint, that's exactly what the case is. From the less technical user base, it looks like they removed something that was stopping people from doing something that they view as bad for the network.
Here's a question I get asked almost more than any other question. Mark, how much Bitcoin should I actually own? Not should I own it, but how much? Now, almost nobody can answer that with a real number. The retirement system was built for an era. It's gone. Meanwhile, they're printing away your purchasing power while your 60-40 portfolio, it limps along trying to keep up. Now, that's exactly where Unchained comes in. Now, if you want, you can book a free 30-minute session, which is a one-on-one call with one of their specialists, and they'll walk you through the retirement calculator all live. They'll model, you know, the Bitcoin strategy side by side with a traditional 60-40 portfolio over the next 20 years. You'll also see what your balance sheet could look like at retirement, how much Bitcoin you could be holding, and what different tax structures do to the outcome. At the end of the call, you're going to walk away knowing exactly what your number is. And they'll send you a complete personalized link where you can keep it, you can revisit it, you could share it with your friends, your family, whoever else needs to see it. So book your free session at unchained.com/markmoss.
I don't want to put words in your mouth, but you said something along the lines of like, you feel like BIP 10 is doomed to fail, basically, or like you don't think it's going to actually work. Why is that?
Well, it doesn't have consensus. So there are a lot of comparisons to the block size wars and activation of SegWit, but there was major consensus that SegWit was the path forward for the network to fix the malleability bug and to enable Lightning. And it was just a few people blocking it for financial gain, personal gain, ASIC boost. And it was really more about the activation mechanism and activation timeline over the change itself. Whereas 110 and everything, it does not have consensus, especially amongst technical development experts, you know, people that actually work on the software. And even outside of that, there are a lot of ordinary people using Bitcoin that don't agree with it either. So it's a very small group of people that really want to push this forward. And they can be very aggressive and nasty. So it's not a good combination for building consensus. And that is exactly what you need to do to get change in Bitcoin. But all of the technical arguments aside, I go back to, you should not be forced to need to worry about something urgently for Bitcoin. Like, that's just not the case. Right now, 110 is popular, it's fashionable, people are rallying, a small group of people are rallying behind it, and I'll get blasted for everything I've said here because, you know, if you're not on their side, you're their enemy. But I don't view it that way. Like, I empathize with them and why they're upset with Bitcoin development in general. But that's not really the path forward. But my point is, if you replaced all the figureheads of the 110 movement, and you pick something else, like who in your view are the major ringleaders for 110? Luke?
I think Luke, Matthew Cratter, and probably Bitcoin Mechanic are the people I've heard the most from on it.
So people agree with them. They like them. And you have to kind of take a higher level view of this and think from a more macro perspective. So let's replace those three people with, I don't know, three other people for something. Like, what was the last thing that was urgent for Bitcoin? Making Bitcoin quantum resistant. So you replace that with Nick Carter, who invested in the Project 11 thing to help blockchains secure themselves against quantum attacks. You put a podcaster in there to replace Matt, like, I don't know, Mark Moss, right? And then, I don't know, pick someone else that goes in there and is a
Bitcoin Mechanic equivalent.
I don't know, someone, whatever. But you get the idea, right?
Sure.
Like,
sure.
Just because they make a big fuss, there are some nodes running it. There's like 1% of hash rate signaling. That's not consensus. And you, as a 110 supporter, would absolutely be against that, right? I would think so.
Well,
right?
yeah. And the argument that they're saying is that there would be reason for miners to wait to the last minute to signal or something like that, like from this game theory perspective.
I mean, you can say that, but I don't see that as the case at all. If you look
what do you think of knots? Like the fact that, I think knots has gone from 0 to 20%?
You can't just look at node signaling. That's an easy Sybil attack, right?
Yeah,
Anybody
sure.
can spin up a node. I'm not saying that they're fake. There are definitely real people running knots nodes. I know them.
Right.
But if you look at some of the, like, I read my feed. Like, I see people, like, they're saying, I'm running knots, but I'm switching back to core because now knots is saying I have to signal for 110, right? So now you're being forced to do a change. And, I don't believe that's how Bitcoin should work.
Is that the right frame, though? Is it the right frame to call it a change if they're saying we want to go back to what we were doing before, right? Before Core 29, that was the procedure. So because it seems to me, in my view, that Core 30 was the change.
It's
and
not.
So then I guess it would be a change.
That
to the
change didn't matter. So if you want to undo that change, just edit your config file.
Yeah.
The 110 fork changes a lot of other things too. Like,
sure. Yeah.
So let's pause for a second. I largely agree with 110 ideas to limit data. I disagree with the execution and tactics used to push it.
Okay.
So back in 2025 in Lugano, I actually organized a meeting to see if we could talk things through. And a lot of the players in the space that are fighting with each other now were at a table discussing things. And there was some tentative agreement that, things can be hashed out. And maybe there can be a way to limit data to make everyone happy because, nobody wants data to be stuffed into Bitcoin. I think the camps are really divided on, should we do something because it is futile, and we should minimize harm to the network by discouraging. So I think it's a very thin line where the disagreement is actually over. But
what about like the David Bailey side of the crew that has, what's it called? UTXO management and, and like Bitcoin Magazine in 2023, I think they were like, you can buy special sats. These sats are like, special sat sort of thing. So it seems, we have a photo attached to this sat or we have whatever. So it seems like at least that group would have a financial incentive in being sure there's not a restriction of non-monetary data.
Well, the thing is,
right?
you can never stop all data, right? Bitcoin is data itself, right?
Yeah.
We can define spam, and that's another whole topic and can of worms, but you can't stop it forever. Like, there is always going to be a way you can smuggle some data in, right? It might be more convoluted, it might cost more money, but there is always a way. And I think that is what the point the core side is making. that you really can't stop it. But then there is a happy medium where I think you can say, well, something should be done to limit this extraneous data, right? Because it ultimately fees are the filter, but obviously you also don't want spam. So there's a happy medium to tread here. And there was a discussion to try to find a path forward, but then the 110 camp decided just to go it on their own and push for this thing really aggressively. But, you know, going back to my example, you can replace everything with quantum. And I think a lot of 110 supporters would say, no, like, that's obviously not good for the network, and we don't agree. There's no consensus.
You just don't rush, you know, just let's slow it down a little bit. I hate the rush.
There are so many cases of this. Like, there's covenants. Remember, Jeremy Rubin was pushing hard for covenants. I don't disagree that covenants are good, but you cannot go and campaign and try to make it happen. It doesn't work. Consensus is organic. It has to emerge, and we should agree. If you don't agree, you'll fork off. And that is the destiny for 110, because there is no consensus. But you can go on and on. There are all these examples in Bitcoin history where some group of people thought, this is really important, and we need to do this. And you just have to step back from the current situation, maybe take a breath and calm your emotions down. Emotions are running high right now, but if you replace the situation with any other situation, you'll see, like, this is not consensus, and this is not going to fly. It can't fly. Otherwise, the barrier to attack Bitcoin is so low. You and I and Mark can launch an attack on Bitcoin and disrupt the whole network. That's not Bitcoin. It doesn't work. Bitcoin will shrug it off.
What do you think of Mechanic's take that, like, I've heard him say in response to this, that Bitcoin was designed to be partial to a minority that wants to have more restrictive rules? So if you have, I think, does that make sense? I don't know that I can explain it as well as I've heard him explain it, but he said, like, it was designed in a way where it was to be more conservative, it would be partial to a minority of users who wanted to be more restrictive in terms of the rules than expanding them.
That's just not true, because Luke wanted a decrease in block size, and we didn't get that. Like, that didn't happen. And I don't think that would happen, right? So if that is true,
would
then,
that be a more restrictive rules? I guess. Yeah, I don't know. It might go over my head. I might have to talk to Mechanic about it.
You can soft fork and make the block size smaller. And I think that's probably what was the right step, but that ship has sailed. But you see, you can think something and have an opinion and not go against consensus. You know, it's not that you have to flush the whole thing away. That's how altcoins are made. That's how Bcash was made. That it has to be this way. Bitcoin has to be used in a certain way, or else it's failed. Like, again, we've heard that time and time again in the past, right? Over and over, either authentically or inauthentically as a reason to create a fork and profit from that too. But your other point about the ordinals people, like, I've said it publicly, like, ordinals are a joke. They were always going to die. And yeah, like, of course they have an incentive, but I don't know if restricting data would stop that incentive. It would make it more difficult for them, but they can always work around it. And the benefit of scamming is far higher than whatever fees would be prohibitive to prevent you from putting data into Bitcoin.
Okay,
I mean, that's their whole economic model, right? They made more scamming people into ordinals than they paid in fees, but they still made money scamming people.
Yeah, I don't think that's something that can be solved with Bitcoin software. The fact that people are going to try to scam other people, you know, that I don't think we can program that one out of humanity with software exactly. But that's interesting. I guess my last question is, so why, related to BIP 110, it's a RDTS, right? So reduced data temporary soft fork. So why is it temporary? And if it is temporary and there is a chain split, what happens after the temporary, soft fork ends?
Well, it's going to just create a fork, a minority fork with low hash rate. And then I don't know. I haven't thought that far ahead because it's not a priority to me. And it should not be a priority to me. Like, who are you to tell me that something is happening in what? I don't even know the day. What day is it that they're going to fork off?
I think it's like 28 days from now. So like 25 days from when this releases or something.
Yeah. So who are you to tell me that there's going to be a fork in 28 days? Like, You don't get to say
Yeah.
that. We're
Yeah.
all self-sovereign nodes on the network. And
Mhm.
you can think that, you can do whatever you want, but that has nothing to do with me.
Yeah. Well, yeah, it'll be interesting to see how it plays out. I wasn't around really for the last. I mean, in 2017, I was way out on the fringes, so I wasn't really around for the conflict, you know. But I'm interested to see how this plays out. Is there anything that you feel like your average Bitcoiner should do or be aware of going into this?
I mean, if you're just running a node that is consensus compatible, you have nothing to worry about. So what you have to figure out is, are you consensus compatible? And, I'll leave it at that.
Okay. Yeah. So moving on from BIP 110 specifically, but still node implementation conversation. Why did you start production ready, and what do you think success for it would look like?
Well, the goal was that there will be another client that is focused on security and stability instead of adding new features, because adding more things increases attack surface. And there is a disposition in Bitcoin core development to keep on adding new things and changing things. And as we've seen, that's not necessarily the best thing for the software. There are bugs introduced. And there was like a bug where funds could be lost too, which was, I think, 2-3 months ago. But it just seems like the priority is not on stability and moving towards ossification, but adding new things. And I think that's not ideal. But again, like, this is a point that is lost on a lot of people. I can't stop core from doing anything. I can't tell them what to do. It's a collection of individuals that have funding or work on their own funding. So the best I can do, and I think Jimmy and others agree that when we started Production Ready, is that we have to fund our own client, and you have to have economic skin in the game. We have to raise money like all the other orgs, like OpenSats, Brink, whatever. And we have to fund development, because if you're not funding development, then you really don't have a say in what happens in any given software client. So our solution is to build our own. And then, people like it, they might run it. But we think it definitely is an option that should exist out there. And we're trying to take it slow, not rush things out the door. We want to find good developers that want to work on this for the long term and are aligned with the vision of safety, security, eventual ossification. And one of the most misunderstood things is, we get attacked on all sides because we're kind of in the middle. But Production Ready is not the client. It is a funding organization. But a lot of the people that are staunch core supporters like to go after us and say, well, how dare you launch this thing and raise money because you don't have the software yet? But we're raising the money to build the software and to put the team together. And the client is not Production Ready. Production Ready is the nonprofit that is raising money to fund developers to build the thing.
Mm-hmm. I really like the idea of a third client. I mean, hopefully we have 4, 5, 6, 10 at some point in time. I think it seems to me that the more the merrier would be good. But I really like the idea of a third client because, like in, let's say, politics, you have like right and left, or even look at core versus knots, and you have like the two sides, and it becomes this like character attack. You guys are evil, like because they want their side to win so bad, it's so focused on tearing down the other side. And I think a third implementation allows for people, allows for a more nuanced conversation versus like, you guys are evil if you're not doing this, or that sort of thing. That is really promising to me. So I was really happy to see you guys were doing that. I talked to Jimmy at the last conference, and that was the first time where I really understood what you guys were up to, and I was like, that seems really important to me. This is kind of a funny question, but I've heard people make the case for dropping op return to 0, or like getting rid of it essentially, and saying that we should like retard max the approach to like the Bitcoin software, that we need to stop trying to say, oh, we want to increase functionality, add covenants, add whatever things on top of that. Do you think about that, like in creating a node implementation that just like stops trying to do new stuff, or maybe even goes in the other direction in terms of functionality, like reducing functionality?
We don't know yet. That will be up to the devs that we recruit and hire to work on it. But the vision is ossification and stability. But if you ask me personally, I don't really think that does anything. The whole point of adding the op return was that you could prune it. Because if people want to stick data in, they can do so in a number of ways. So you're going back to trying to reinvent the wheel. The op return was put there so you could put arbitrary data, a little bit of arbitrary data, and not bloat the UTXO set or whatever weird thing people figure out to do later. But there is something I think that should be done. Like right now, if you run a prune node, you're pruning everything. It'd be nice to be able to just prune the op return and still have all the data itself, not the op returns. But that is probably a bigger lift and a longer term project that, I don't know, no one's looking into it or funding it right now, but I think that would be worth funding, because right now the rallying cry from core is like, just run a prune node. But then, you don't have a full node at that point, or archival node that has all the blockchain data, because by pruning it, you pruned everything.
And for those who are concerned about like the CSAM side of things, I think the argument there is like, well, I have to download it first before I prune it, right? So then still you have to, like, your computer needs to scan, or something. You have to gather the data and then have something that does the pruning, if I understand that. So
yeah, but there is no, like, I really don't want to get into it, but there are no pictures on the blockchain, so you can talk to AI and figure it out.
Additional software to try and piece things together.
And contiguous, not contiguous. I don't want to get into it, because the more I get into it, the more I'm going to get attacked. So I'll just say, like, my stance is I should not have to worry about your thing. Like, you can go do whatever you want. I'm not forking off with you guys.
Yeah, I mean, I'm glad to have people like you who have done the painstaking job of being like, I'm going to remain neutral and everyone's going to be pissed at me and I'm just going to eat it because, like, that's, I know it's not fun. So, I've kind of, it seems I've kind of been in the Knots BIP 110 camp more from an ideological perspective, but I try to hold on to these things loosely, primarily because I recognize that I'm in the point. I come to Bitcoin from more of a cultural Austrian economics sort of perspective, and not like, kind of what fiat currency, the problems of fiat currency and what it's doing to our world, and not from the technical perspective. And so because of that, I sort of have to trust me, bro, with what the developers tell me. I didn't like review the code myself for Knots, Core 30, whatever. And so that I kind of have to be like, yeah. And I think in doing that, you have to look at what people are saying, what their values and morals are. I don't know. It's a difficult thing to navigate. I've tried to like maintain an open mind as I've tried to learn more and more about it.
Yeah. As I've said, I agree with the key principles that there should be efforts taken to reduce spam. And if there is something like ordinals, we should try to filter them out. But that's not a fight you take to the consensus level. You can do that in policy. The issue, I think, is they're trying to shortcut fighting for policy, because policy, you could just talk to the miners and convince them all to follow the policy. But that's hard to do. It's easier to just say, well, we're going to bring this to consensus level changes, right? And soft fork, hard fork, doesn't matter. You're still affecting consensus rules at that point, and you're pushing something onto the network that you should not be pushing on the network, because that's not how it works, right? Like, I think Satoshi had an alert key or something where he could send a message to everyone to upgrade. And that was removed because you don't want that, actually. In a decentralized network, nobody should be saying, hey, upgrade your thing. It's not like, I don't know, pick your software. It's not like Spotify or your Claude Code, where you have to install the last update blindly, right? And
yeah, we don't want that.
Yeah, you don't want that. And you don't want to be forced to worry about something on some timeline that someone arbitrarily picked, right? Why in 28 days? Why not in 37 days? Why not in 378 days, right?
Well, yeah, I'm glad you're working on a third option, Samson. So thanks for doing that. And I'm sure there's a lot of other people who feel that way. I'm sure you get lots of the vitriol but I'm sure there's a lot of people who are really appreciative of what you're doing that are just not on X posting all day, you know. So
Well, I get vitriol from all sides, core included. So
yeah,
and,
right.
and I want to add one thing too, like the core camp is not without fault here. It takes two hands to clap. You know, a lot of developers, yeah, they said a lot of stupid things, and they gave the ammunition to the not side to use
I was
against
just pissed off at some of that stuff that, you know, there's a few things that they're saying where it makes me want to be like, all right, well, whatever this guy's doing, I'm out. I want the other side, you know, because this guy, like, yeah.
And you have to, like, you just have to understand people in general. Like, Bitcoin is money to people. People put their savings in money. If they feel you're mucking around with it, of course there are going to be emotions running hot. And a lot of those core white knights, you know who they are. They will just leap to defense and attack too, right? And it doesn't help the case in either way. So it's not like, you know, the Knots people are at fault. Core side obviously did something, right? Even if they're technically right, you know, you can be technically right and still incite a riot, which is what's going on right now. So my hope is that everyone stands down, because no one's really going anywhere, right? Everyone's going to be around unless people decide to fork off and go with an altcoin. You know, in 5-10 years, everyone's still going to be here, hopefully, you know. But yeah, you can't really kick someone out of Bitcoin, right? You can't force someone away and make them leave. Even the altcoin projects have Bitcoin, and they're still holding their Bitcoin tightly.
Well, we'll leave that there. Yeah, well, it'll be interesting to see how it plays out and how everybody reacts. And yeah, hopefully it is just not that important. However it plays out, hopefully it's just not that big of a deal either way. Let's talk about Jan 3. How would you describe what you do to the company to somebody who is, or do for the company to somebody who is hearing about it? Like, what's your guys' mission?
The mission is to accelerate hyper-Bitcoinization. So everything we do is to get Bitcoin adoption worldwide as money. That's why we build the Aqua wallet, and that's why we engage governments. It might sound like a conflict, because we do get people criticizing us, like, why are you trying to help governments get Bitcoin? You know, it should be the other way, separation of money and state. But the thing is, a government adopting Bitcoin is separating money and state. Like, it's not that you bankrupt a government, it's that they don't print money anymore, right? So it's a very subtle point that you have to really think about to understand. But getting them to use Bitcoin is a good thing for people, because governments are made up of people, and they determine a lot of the laws and regulations that, you know, can impact the ordinary people. So the more people in the government that understand the Bitcoin ethos, understand how Bitcoin works, is better for a nation state and for the people that live in that nation state. And Aqua is just it's a Bitcoin wallet. We're trying to bank the unbanked, onboard billions of new people into Bitcoin. So we focus on stable coins, because a lot of the global south, our biggest market is LATAM. They're using stable coins. So we give that to them, but we also give them Bitcoin. And we've since branched out a bit. We've built Agentic Aqua, which is MCP and CLI that lets any agent, like your Hermes, OpenClaw agent, get their own Bitcoin wallet and do everything that you can do in Aqua. So we're doing a lot of stuff.
That's very interesting. There's got to be a point in time where these AI agents just they figure out ways to be insanely productive and just start siphoning off Bitcoin supply, you know, taking supply out of circulation. Jeff Booth's commentary on that seems really interesting to me, where he's like, I think that he said something along the lines of like, I think that AI is basically going to become like electricity, where it's like a commodity, where it's like something that is, it's not like the AI bubble is going to pop. Basically, there's a bunch of money going into AI, and that at some point in time, yeah, it's like it's all going to be demonetized. A lot of that value is going to come out, and it's going to be more like the applications using AI rather than like the models themselves, because the models are replaced by something else every month. There's a new best model, and then that model becomes open source 2 months later. And then, yeah, it doesn't make sense to me like there'd be a lot of long-term value stored in something that has like no moat, like a moat of 30 days, somebody else makes something new. Yeah, that's really interesting. You also said in the conversation, go ahead.
Sorry. I think the future is largely going to be agentic commerce. So you can see where it's going already, people spinning up their own agents. And yeah, like the language models are just a part of it. It's the agent with context and tooling that really makes a difference. And as it becomes easier to create these agents, and as the agents get better, smarter, and more capable, then it's just going to be a lot of agents doing commerce with one another and using services and paying with Bitcoin. Because if you think of it from a macro level, agents are unbanked, right? They can't really get a credit card or debit card. So they have to use either Bitcoin or USDT or something, right? That is permissionless.
What are the most interesting developments you've seen at the nation state level with Jan 3?
Well, it hasn't been that interesting lately. So it's a direct parallel of the real world, a nation state and a head of state. Like if you imagine you're trying to orange pill your neighbor, it's just a random person that has maybe little understanding to no understanding of Bitcoin, and you need to try to get them to want to buy Bitcoin. It's just as challenging. So what we find is when Bitcoin price is low, like now, there's very little interest to talk with us. When it's up, then there's interest. So the meme where it's like the two tables.
I've heard that before.
You know, Bitcoin is 63, whatever, 63, 64. There's no one lining up there. Bitcoin at 150 or 250,000, long line. So we're just kind of focusing on building right now rather than engaging. Of course, we still do have some engagements here and there, but it's not, we're not aggressively going out to do meetings because we know it's not going to work. And it's also harder to get the meetings at this time.
You said recently that you think the bottom is in already, which is sort of a contrarian take. I feel like most people, I think, are expecting the cycles, most people in my circles at least, are expecting the cycles to just continue to play out because they've been on this like shockingly programmatic, you know, they've played out the same way. The pattern has been very, very similar. We would see this bear market year around October, November is when we've typically seen pretty on schedule. We've seen bottoms in that time. Yet you recently said that you think the bottom's in already. Why do you think that that's the case?
First, I'm a permabull, so I'm always bullish on Bitcoin.
There we go.
Second, it doesn't make sense. Like, why would it follow perfectly the schedule? I mean, a lot of people expect it to, and I think it's a self-fulfilling bear market in that sense, where people are expecting the bottom in October, and they've sold, right? They're preparing. But, you know, Bitcoin has a habit of doing what you least expect it will do, and I think people are going to be surprised very soon. But third, we're already at the 200-week moving average, and we've never broken below that for any significant amount of time. And that there's also the power law that's showing, you know, time is not on your side. As time progresses, Bitcoin does tend to follow a power law model, so it should keep going up over time. So every month past now, I think, is moving into recovery territory, if not, you know, straight vertical to the moon movements. But the other reason I think this time is different is because this time is different. If you look at the Bitcoin Treasury companies, if you look at the ETFs, they've largely added additional shock absorbers to the system. If they didn't exist, maybe we would have crashed much lower with this last crash, which, if you think about it, there was really no reason. Like, what was the trigger event? Nothing really blew up. We just kind of went down and then down again. And then, like, why are we here at 63? Nobody blew up. There's been no tragedy, no bankruptcy, nothing. So we're just sort of...
It seems to me to just be an over-leverage pattern, right? Like, it looks to me where we get to a point every 4 years where everyone thinks Bitcoin's going up forever. Everybody levers up to the top, and then we just see that deleveraging. You know, I mean, the day where we did hit that final bottom, there was just like a massive liquidation cascade that hit, you know, like, yeah, crypto broadly.
Yeah, it's definitely possible. But if you look at it, like, the supply of Bitcoin is limited, and all of these entities have been buying nonstop. And it's not just them. There are many more entities buying Bitcoin than the publicly listed companies, right? But I see it as sort of shock absorption. Like the ETFs, they will only go so low because people won't sell below their cost, because a lot of that money is long-term capital, and the treasury companies are also shock absorbing too, right? And they're also holding still. So I see it as a very different structure these days than in the past, where you might have had Bitcoin slide 80% because nothing else existed to shock absorb. But we have a lot of shock absorption right now, which I think stops it. So we'll see. Like, nobody knows for sure, but I would honestly be very surprised if we went lower now, because that would break, the 200-week moving average standard, and it would probably push the power law out of its comfort zone.
I am kind of expecting us to go lower. Like when you look back in 2022, I believe it was, we were under the 200-week moving average for a little while around this time in the cycle. But I also tell people, it's like I'm not sitting capital on the side waiting for it. That's for sure. Like I that would freak me out. I pay my bills and put my excess economic energy into Bitcoin. I don't overthink it really. I do think we'll probably, when people ask me like, where do I think the price is going? It's like, I think we probably go a little bit lower, just because it seems like we're in a simulation, and it just seems like it all goes according to this predetermined, not predetermined, but it just, I expect the pattern to repeat until I see it not repeat. But but also
you
I'm
might
not
see it not repeat this year.
Yeah, certainly. Yeah, I'm not setting aside any capital waiting, that's for sure. Especially now, right? You hit the 200-week moving average. It's like, don't overthink this, like just get in there.
But the way I look at it is, those massive drops, it's usually because the players in the market are not ready to take action, right? Like if you look at some of the past drops, it's just because of cascading liquidations and whatnot. But time is really not on your side if you're a Bitcoin bear, because if you look at strategies as one example, they've largely repositioned. So they've taken a hit too, right? Like their share price is down, their preferreds are down, but they've adjusted. So if you think of it as, the Bitcoin price is moving down is some attack. All the battleships have kind of reoriented, pulled back a little bit, and they're ready to defend against the next wave. So, Metaplanet, they've acquired Cybo, a securities firm, and that will allow them to do more things. Like everyone is ramping up against the potential next onslaught of a dip. So everyone is in a good position now, and I think the market as well. Those big scary dips are usually because they're just cascading and there's nothing to catch it. But when you have the mechanisms in place, then it cannot dip that far. Those really only happen as a shock. Like it's just within a day or something like that. But as time goes on, everyone repositions and prepares, and it makes the likelihood of dropping a lot lower a lot less.
And you just have the classic, the coins move from lower conviction hands to higher conviction hands throughout the bear market. So as we go lower, the probability that we go lower decreases.
Yeah, I view it as rotation of short-term capital out and long-term capital in, and that's really how money is made in not just Bitcoin, but every market, right? If you look at Warren Buffett, that's the game. The long-term capital wins, short-term capital panics and exits.
Yeah, I think we're going to be having an exciting, epoch, an exciting few years moving forward. You get through the slog of the bear market and everything's boring and everyone's fighting and nobody's getting along. But we'll get back to the glory days. Not too long from here, I don't think.
I agree.
So I'm with you there. Yeah. This is kind of, I wonder if you've ever considered presenting an argument like this to the nation states when you're talking to them. So I'm going to string together a few ideas here, but you in another podcast were talking about how gold can be created in fusion reactors, essentially. And if Bitcoin monetizes energy by requiring energy pumped through computers. That's how Bitcoin is created. So you place this monetary premium on the energy. And when a commodity is monetized over time, it typically becomes cheap and abundant. You had like glass beads in Africa where that was the money that they used. And then as soon as that happens, you have people who figure out how to make new glass beads and not discover them naturally. And then, glass beads become cheap and abundant. And we've seen that take place on copper or whatever commodities. You'll see that take place when they're used in that way. So if this process continues to play out and the cost of energy drops closer to zero over time from solar and nuclear, we may end up in a position where the downstream implications of Bitcoin mining driving energy near zero makes the ability to create gold come around, right? Because you can create it in fusion reactors. So if you have a bunch of energy, you could create gold, and that the downstream implications of Bitcoin mining would destroy the scarcity that makes gold valuable. And it seems like that would be not too far out of a possibility for us as we have more and more creative ways of generating massive amounts of energy. And so I wonder if that's something that like you've ever considered presenting to nation states who are relying increasingly on gold, right? They're decreasing their USD reserves and increasing their gold reserves. And if energy continues to drop, we'll come to a place where you can make gold and then it's not scarce. And then the monetary premium we attach to it could be destroyed quite rapidly, just like glass beads in Africa when somebody figured out how to create those. Have you ever considered that? I'm just, I had that thought when I was listening to you talk about the gold fusion reactor thing.
You make sense in theory, and it is a compelling argument. Obviously, I agree, but I don't think it matters. Money is really, it is your ingrained beliefs. I think for gold to suffer some existential crisis, it has to just be, it probably won't happen. The way to cycle out of gold is time. The people that grew up with gold and believe in gold, not understanding Bitcoin, they will eventually, move on and retire and pass on. And eventually it'll be people that understand Bitcoin, understand technology, understand the dynamic we have between energy, information, and money with Bitcoin. And they just replace those people in those positions where they can make decisions to adopt Bitcoin. Because, technically, if you compared that finding where you could manufacture gold in a fusion reactor, that concern is just unexpected inflation, right? And that's the same concern with quantum computing, that, it will do something and increase the supply somehow or bring old coins back into circulation. But if you look at the market, there's no reaction at all because they don't care. They've already decided that the older generation has already decided gold is safe. And nothing will convince them of anything counter to that point. So
until we figure out cheap alchemy, basically.
Yeah.
But who knows
because
when that will be. Yeah.
Gold is far more centralized, right? It's really central banks buying at this point. And Bitcoin is bought by everyone. And because Bitcoin is bought by so many more people, sentiment is much more powerful because there's more sentiment to go around. But how much sentiment is there for gold when the decision is made by, I don't know, probably count them on your fingers and toes, that many people at the central banks making a decision. And they're not reading the news or anything. So they're kind of immune to sentiment because they're so disconnected from reality. So in theory, yes. In practice, we just wait and let Bitcoin take over.
It seems probable that it would first come to pass where the consensus would just shift, right? Where the consensus would shift from using gold as money to using Bitcoin as money without any major variables changing. But I do wonder if 12 years from now, it's like, fusion reactors are much more popular. And now we're pumping out a bunch of gold that we're creating, or the asteroid minings, or whatever it is, whatever technological advancements that allow us to rapidly increase the supply of gold. And then we'd see some shifts take place at that point in time.
Yeah. But if you think about it a bit more, it's also a demographics issue, right? The central banks, who is their customer? It is the people. They have to provide stability to the people of that nation state. And demographics are all skewing to the older side right now. So they need to have the valuable thing that the older people think is valuable.
Mm-hmm.
So it's a catch-22, really.
Yeah, that's interesting because everybody running the governments is 70. You know, they're not, and there's the percentage of 70-year-olds that are Bitcoiners is pretty low. It's like RFK and four other guys or something. Yeah,
but those 70-year-olds are catering to the bulk of the population, which is the aging population.
Yeah, that's interesting. Yeah, just 15 years passing would change a lot. It seems. They say technology progresses at every, one death at a time or whatever. Science progresses, something like that. Couple quick. You got time for maybe one or two more quick questions? How you looking?
Maybe one more.
One more. Yes, sir. All right. I'll squip my. I had a couple questions about the Great Pepe War meme that you reposted a while back, but maybe we'll talk about that another day. You had on Aqua Wallet, you guys provide stable coins, which I hate the term stable coin because it's not stable, but whatever. I'll let it go for now. You support Liquid and Lightning, and I'm curious about why you decided to support both Liquid and Lightning, and how. I understand how Lightning operates at a technical level more, but maybe if you could tell me how both of those operate, and then why you guys made the decision to support both of those.
Right. So Lightning has evolved, I think, from the initial design, where you would run your own Lightning node, and that's it. Like the substrate and the interoperability, it would be one and the same. But right now, Lightning is more of just an interop layer, connecting many different substrates. So base layers or base systems. If you look at Wallet of Satoshi as one of the first Lightning wallets, it's like connecting a database substrate to the Lightning network, right? And then you have other things like federated mints. You have eCash, you have Arc, you have Spark, and you have Liquid. So Liquid is just another substrate, and I think it's the best substrate of all the ones available. It's the most battle-tested, longest running, with the best properties like privacy, confidential transactions, and reliability. So yeah, basically the challenge is, what is the substrate? Because if you remember, there was a Moon wallet back in the day, and it was very popular because they were doing submarine swaps to Lightning from a main chain. But as soon as main chain fees went up, then that substrate, the main chain substrate, stopped working.
You lost me there a tiny bit. Submarine swaps to main chain. What does that mean?
So basically, you're swapping an on-chain transaction to get Lightning capacity.
Okay. Yeah.
So we're doing the same thing, but on Liquid. So we're immune to fee spikes on main chain. But Liquid, Aqua is a Liquid wallet at the base. So the base of everything is Bitcoin and Liquid. And Lightning transactions in Aqua are just swaps out of Liquid into a Lightning transaction atomically. And USDT is natively issued on Liquid as well. So when we interface with other
I didn't know that.
USDT blockchains, we're swapping as well. Like you can pay in Liquid USDT, and the receiver will get Tron USDT or Polygon USDT or all the different USDTs. So at the base, it's a Liquid wallet, and then everything is a swap out from that Liquid wallet.
Okay. So basically, you're saying so these are a bunch of different applications. I'm going to try to reduce it to average Joe terms, because I almost had to ask you to speak slower for me so I could keep up. But so, essentially these are alternative versions where you have your on-chain Bitcoin. You'll take that on-chain Bitcoin, pull it onto this network, Lightning network, or let's say Liquid network. You're going to operate. You have then the trade-off there is you kind of need to trust at this level a little bit whoever you're operating in that ecosystem with, so that you can have that rapid transactability of that Bitcoin. And then at some point in time, if you want, you could take that Liquid Bitcoin and pull it back off onto the on-chain where you have no requirement of trust of that person, essentially, or entity or whatever it is.
So it's like a middle layer, layer 2, whatever you want to call it, that you want to use to interface with Lightning. And you can do that to aggregate small UTXOs. Like Ben BTC Sessions, he likes to take payments in Liquid, and then when he gets a big enough Liquid UTXO, he'll swap out to main chain. But there's, everyone's promoting their own substrate, and they're all different trade-offs, and I think Liquid offers the best set of trade-offs, because a lot of other things are just a server or 3 servers, and if they go offline, yeah, you can exit, but does it make sense economically to exit? And does the economic use warrant that level of stringent trust minimization? Because a lot of people that are using Aqua are just paying small bills, like $10, $20, $30. Who knows? But it's not like it's the end of the world if if Liquid went down, which it won't. But you should be never keeping that much money in a hot wallet anyway. So amongst all of these wallets, they're all hot wallets. So you should not be keeping a ton of money in your hot wallet, no matter what. So it's really a moot discussion. The key here is really who offers the best user experience. And yeah, we think Aqua Liquid offers the best of every option out there. We're bullish.
Awesome. Heck yeah. Well, I think it's a great thing. I think you guys are. I like the design of the product. I just downloaded it recently, and since I knew we were going to chat, and I was just poking around. I like how it feels, and I think that that's super important. That's something that a lot of the Bitcoin developer crowd doesn't get very well. Is like it needs to feel good, it needs to look beautiful and that sort of thing. And so I could see those design choices in there, and I think that it's banking the unbanked is. I've lived in countries for periods of time where people there all they have is access. They don't really understand all the big crazy geopolitics of what's going on in the world, and they just have their paper currency that they transact with and stick away in a box, and they don't have bank accounts, and they don't realize that they're being stolen from year after year. And so to get people into something where they have optionality, where it's like, okay, here you can use your stable coins, you can use your US dollars, stable coins, you can use, you have the optionality for Bitcoin there and everything. I think, yeah, for the people who have no access to that, it's such a massive step just in giving them the opportunity to play on the same playing field that people in developed countries have. And that will, I really believe that will be a rising tide that is good for everybody. All the boats will be lifted as more and more people get to play a more fair game. So I think that's great. I think what you're doing, go ahead.
I fully agree. Well said.
Yeah. Thanks. I think what you're doing at Jan 3 is great too, because there's that, there's a Trojan horse element of that. I for a while, I mentioned at the beginning of the conversation that, I was doing some political consulting work, and I had that conviction of like, wait, I'm talking to all these people at this high level about Bitcoin, and I want to, it should be plebs first, but also too, I can see what you're saying of like, yeah, this is how we increase the adoption, and there's certainly a Trojan horse element to that, and getting them to stop printing money would be lovely. So, yeah, I think you're on the right track, man. Thanks for the work you do. Yeah, it's great to have this chat. How can people support you? How can they connect with you? Where can they find you? Anything you want to plug?
Sure. We're on X. Jan3com is our X handle, and then Aqua is Aqua Bitcoin, and my handle is Excellion, EXCELLION, and yeah, I'm mostly on X over other platforms.
Awesome. Well, thank you, sir. It was great chatting. Hopefully we'll talk again
Jake.
soon.
Great chat.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets that could pose a threat to Bitcoin.
The quantum concept is, what do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself.
I would say the threat is less imminent than the headlines suggest, and work being done already to address any potential threat in the future is more robust and diversified than people think. And what I mean by that is there's lots of different work already underway that they range from changing the protocol itself or updating the signature scheme to post-quantum proof signature schemes versus, say, having contingencies and plans that would allow somebody, in case in the future they need to move or migrate to that signature scheme, they can. And so there's a lot of work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%. Despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient, and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999 where the world was going to implode. Technology marches forward and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more worried. Quantum will break everything way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin it will adapt to it, already is. The discussions are great around it. And we're going to see many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but there was even just a paper that was released a couple of weeks ago where without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
The European institutional investor base is massive, obviously, but also very fixed income focused. European fixed income, it's very much a fixed income culture. You got all the massive pension funds, all heavily weighted towards fixed income instruments. Kind of hard to get yield right now. I mean, I was in high yield credit for a long time, and high yield credit is basically very low yields these days. So I think that in itself is a big opportunity set.
Think about the scale of AI. How is AI going to use this? People just think that AI is just going to use it to pay. But what is AI? What do robots need? What do people need on a global network, a true extension of the internet? AI wants to use it for validation, authentication, accessing data, and they need to have it happen at the blink of an eye. In other words, money, which is trust, especially for agents and robots, needs to move at the speed of intelligence. You're not going to get that with Visa and MasterCard, but you're going to get that by being able to send, 1/1000th to 1/10,000th of a penny working sats with the blink of an eye to validate. And effectively, the Bitcoin address that they can validate that they have becomes the agent's agentic soul.
But again, Bitcoin can and will only ever be that safe haven in those types of environments if Bitcoin is viewed by the masses, by traders, as a currency. And unfortunately, we've kind of, as Bitcoiners, shot ourselves in the foot a little bit by calling Bitcoin digital gold, a digital store of value, rather than calling it what it truly is, the most perfect form of money that humanity has ever conceived.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
Also seen a lot of news stories coming out from my home country of France of just horrific, what we called wrench attacks, which is really nowadays almost a euphemism for the kind of the physical attacks that we see on people who are public about being Bitcoiners. How do you think about kind of that physical security layer?
Well, the layers that we have hopefully prevent that. So
Yeah.
those have mostly been kind of retail type individuals. And I think what happened there actually was there was some just information identity doxing type of leaks that happened where they didn't
From the tax authorities
Yeah.
and from other sources as well, but
yeah,
so it's troublesome.
Here's your map of these people have lots of Bitcoin, and here's their name of an address. And gosh,
It's because they have a wealth tax, so they itemize kind of all the assets, and that that is a high.
I did not know.
Yeah.
All right.
Yeah.
Yeah. Look, governments do collect information. They ask companies, financial institutions to collect information. That then becomes people in security are like, I don't want this information.
Right.
And sometimes we're regulatorily required to collect it.
Do you think there's a path? I've heard people kind of hypothesize about using zero knowledge proofs, for example, to try to minimize how much data gets stored in all these giant SQL databases while still maintaining kind of the regulatory posture.
Look, I think it's going to help. I think these solutions are coming to market now. I think it'll be good. Certainly can't be worse than where we've been.
Right.
But yeah, the wrench attacks are tough. So look, with the BitGo solution, there's typical things. There's duress capabilities that you can use. I'm not sure that those really work that well if you needed them, but we do have them. But mostly it's the policy. So by the way, something I'd like everybody to know, like you can come and you can get me. I've got access to nothing. All you will do is, cause me, I guess, a lot of pain. It's actually a very important point. Like we made a very, very careful attempt. There's no collection of executives at BitGo that you can come and collect and then somehow steal the money.
Right. Yeah, that's really important. Okay, so to kind of get on some lighter topics, let's talk about kind of the regulatory landscape that's really evolving a lot with regards to banks and financial institutions. So you mentioned market structure that is in the works with the Clarity Act, but the Genius Act was passed that was related to stablecoins. Really curious to hear from your perspective, kind of why should Bitcoiners care about stablecoins, and kind of simultaneously, we also hear people say stablecoins make Bitcoin obsolete. So why should stablecoin enthusiasts care about Bitcoin?
Okay. Well, look, I think they're very different things.
Yeah.
So payments today, if you're here in the U.S., mostly done in U.S. dollars. You probably get your paycheck. You may not, but most people get their paychecks in U.S. dollars. All right. And imagine you walk into McDonald's tomorrow, and you're here in Las Vegas, and they say that'll be 13 euros. And you're like, well, I don't have any euros. And they'd be like, tough luck, you can't buy your burger. It just turns out that like U.S. dollar in the U.S. is going to be a payment system for a long time. You're required to pay your taxes in it, at least for now. It is the payment system that's used. Bitcoin, of course, could become a payment system in the future. I think right now most people agree it's kind of so small and it's volatile. People would rather save it than use it as a payment. This is not a ding on Bitcoin. I think it's the state of where it is kind of in its evolution. So, all right, we're going to have payments. We're going to have store value. Bitcoin can provide one, but not a lot of the other. Stablecoins are better for payments than banks ever were. By the way, we know that banks have let us down on payments because of the existence of all these payment apps, from PayPal to Venmo to Cash App, all of them. And what's happened is there's been a demand for better technology around how you do just basic payments, and the banking system just hasn't done it very well. Look, stable coins are way better. So in addition to being able to be digital and easily added to any of those apps that we just mentioned, they can be a one-to-one backed, so there's no fractional reserve. So most people don't think about how banks work. We know that banks are highly regulated. We've probably heard the term safety and soundness of a bank, which is very important. Basically what happens is you put your money at the bank, and of course we know the bank lends it out. And the safety and soundness is making sure that the bank is doing that in a responsible way with the appropriate backstops and reserve capital, so that if you come and ask for your money right now, you're going to get it. And for the most part, it works. But it is fractional reserve, and from time to time, it doesn't work. By the way, the reason there's so much regulation in the banking industry is because there's been a ton of failures over time. Now, some of those happened 100 years ago or 50 years ago. But all of these rules have been developed to try to make sure that we don't have repeats of it. So look, with stable coins, there's no chance of that. It's one-to-one backed. So it's super easy to put these into a T-bill money market type of thing. It's very easy to audit that, very easy to see in real time. By the way, with our stablecoin, so we have a stablecoin as a service. We don't do our own stablecoin, but we're getting these things audited twice a month.
Yeah.
Show me a bank that gets audited twice a month.
Right.
So, and by the way, one of those at the end of the month. The other one is a random point in time during the month, and they come in at a random point to make sure you're not like moving the money intra-month, things like that. All right, so stablecoins are one-to-one backed. They should be able to give you better yield than you get at your bank. Interestingly, the risk-free rate today is a little under 4%, and yet banks are giving you like 0.2%.
Right.
Think about that.
Yeah.
They didn't have to take any risk. It's called the risk-free rate because it's considered that the T-bill is the lowest risk, right? All they had to do was give you that, and they could give you nearly 4%, and instead they're giving you 0.2% while taking risk. All right, so look, I'm assuming that the reason they don't put it into T-bills is because they're making more somewhere else, but they're sharing none of that back. The stable coins ought to be able to give this all back to you. It should be like an ETF. So like BlackRock offers a Bitcoin ETF. They charge 25 basis points to administer that. What's that administration? Well, it's some regulatory overhead and some operational capabilities and some audits. That's basically what we do with stablecoins. We have some regulatory overhead, we have some operational capabilities, and some audits. So I think 25, 50 basis points seems like a reasonable kind of fee for running that type of service. And then the rest should go back to you. It's your money. You should get, what's it. And all right, so, and then lastly, it's 24/7. Like there's no banking fees, no wire fees. We can build apps on it. It's programmatic money. So this is just a better savings bank than what we've ever had before. So I think that stablecoins and Bitcoin are just, today, two different use cases. And the reason stablecoins are actually great for Bitcoiners is because it brings it into the digital era. So when you look inside of BitGo's code base, you'll basically see a big if statement all over the place. It's like, if US dollar, go over to wire system, with these, Monday through Friday, 9 to 5 and all this crazy stuff. And then you got the digital world. And then that's all the same, whether it's, Bitcoin or stablecoins, et cetera, we have common code there. So we're going to just build much more efficient systems, much better systems. I think it's going to actually accelerate the adoption of Bitcoin that we now have stablecoins. So you take your dollars. It's very easy to get your mental model around it. Oh, okay. My dollars in the bank are 1-to-1 to the stablecoin. I now have the stablecoin, which is digital. I'm now learning about how do I self-custody that? How do I custody that? How do I think about that being a 24/7 thing and what goes with it? And then now I'm going to go into Bitcoin, and it's like just a super easy stepping stone.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
Anytime that you launch a new product into the market is going to stress test you. They're going to see how you respond as a company, as a management team. How does the product respond? And we're in the middle of that right now.
Zach, I want to start with you because, Bitcoin is kind of like dog years, where it's like 10 years pass in like 1 year or whatever. But the ETF is kind of like the first OG wrapper launched in 2024. That was like 2.5 years ago, which is crazy. I think that's crazy. But that really kind of brought Bitcoin into Wall Street light, add a lot of validity to the asset class. Why don't you just kind of take us through where we're at now, how you see us moving forward, and just kind of like some of the history of the ETF wrapper?
Yeah, absolutely. So the first filings for Bitcoin ETFs were in 2013, and they didn't come to market until 2024. So 11 years later, a long battle with regulators. Grayscale took the step during that period to sue the SEC. We won that lawsuit. That's why these products came to market. So as the movie title goes, kind of crypto policy and crypto regulatory topics are one battle after another. So we've been through a lot of those battles, and there are more to come. But fortunately, over the hump on the ETFs. We thought that these products would be extremely popular with investors, and I think that has proven to be the case. And the reason is just they're the easy button for Bitcoin investing. There are lots of ways to buy and hold Bitcoin, and there's no wrong way to do that in my view. But if you buy Bitcoin somewhere else, you need to decide, where am I getting that liquidity and what kind of price am I getting the Bitcoin for? How am I holding that? Is that on an exchange? Is it in self-custody? How am I going to do my taxes? How am I going to do the rights of survival if something happens to me, my family inherits the assets in an effective way? Can I borrow against those assets? in the context of proof of stake networks, how do I stake these assets? So there's lots of things that an investor in digital assets and Bitcoin needs to sort out for themselves. Essentially, the ETFs package all those solutions into a single instrument, and they just make it extremely convenient for investors. Institutional liquidity, custody, and all the normal uses of your brokerage accounts or your tax advantage accounts that you have with other securities, you have this with the ETF. So they're not doing anything complicated. Of course, there's lots of interesting things that Strive and others are doing that go well beyond this concept, but the ETFs are designed just to give you efficient, effective, safe, marginable, et cetera, all these things, Bitcoin exposure. They're a very simple instrument, and they've been very popular for that reason. Bringing us to the present, of course, the Bitcoin ETFs have come a long way. On the Bitcoin side, we've seen an expansion of other types of instruments, things like covered call strategies that build onto this concept. And then, of course, many other altcoins. The SEC now uses something called generic listing standards for crypto ETFs. We don't have to go through the lawsuit and the 11-year process to get other products to market. We have a set of generic standards. And so Grayscale and other issuers are broadening our platform beyond Bitcoin to Ethereum and Solana, et cetera, et cetera, et cetera, long list of other things. So that sort of brings us to the present. I think wildly successful products, a long time coming. I think an excellent way for any investor to build Bitcoin exposure into a portfolio.
Yeah, well, thank you for your service and fighting the good fight on behalf of the community there, suing the feds. Much respect. Yeah, so I mean, it's really interesting, right? So, like you mentioned, the success of that launch, kind of what it did for Bitcoin as an asset class, getting more exposure. People can get more exposure to Bitcoin. Kristen, you guys have a very interesting perspective, and we talked about how some emerging markets are for the first time launching their domestic ETF products. Walk us through kind of what you guys are seeing kind of outside the US, if that's going to maybe kickstart a little price action here, more demand for these kind of products worldwide.
Yeah, I'm really happy to share with you guys that as an index provider, we're working with everyone globally, and we're seeing more demand from emerging markets than we ever have before for simple Bitcoin ETFs. And this is just regulatory, right? They've been all wanting to do what the US has been doing, but now their regulatory regimes are opening up. But one of the things that I think is interesting that we were chatting about when you think about Bitcoin, there's no what is the price of Bitcoin? It's more like, what did you exchange Bitcoin for, or what rate did you get? And as an index provider, I have hundreds of Bitcoin indices already up and running. And you're like, why so many? Isn't there just one? But they, of course, have different closing hours, the model that you use to fix it, the data inputs. So I'm hearing from a lot of these emerging market asset managers that they want a domestic Bitcoin index. And what that means is they only want us to use data inputs from their region. And they only want data pairs that might be like, if it's Japan, it would be Bitcoin Yen, Bitcoin USDC, and Bitcoin USDT, and that's it. They don't want any other currency pairs to go into that aggregated price. So we're very busy doing these indices right now, but I think that's a strong signal that the rest of the market is coming, and we'll see more pressure or demand on Bitcoin in general.
Yeah, and it's super interesting. I think that's very encouraging. So we kind of have like the basic ETF wrappers. I'm a big believer, keep it simple, stupid. Like I'm a big cold storage guy myself, but arguably the most exciting developments in Bitcoin and finance have been the preferreds, and obviously a hot topic of conversation now. And Ben, you guys at Strive are clearly on the forefront of this, and I kind of want you to help us peer into your guys' thought process of the financial engineering that goes on at Strive. And I don't use that in like a negative context, but I think you guys have really elevated the wrapper game. And maybe you can kind of just touch on how Bitcoin supercharges your balance sheet, the capital structure, the flexibility you guys have over traditional balance sheet or capital structures.
Yeah, what an interesting week to be having this conversation, huh? Anytime that you launch a new product into the market, you know that there's going to be a point in time where the market is going to stress test you, right? They're going to test the limits of the product. They're going to test the faith of investors. They're going to see how you respond as a company, as a management team. How does the product respond? And we're in the middle of that right now. So this is a part of this growth process. It's a little interesting because I've never truly considered either of our products through the common equity or through the preferred to be an actual wrapper of Bitcoin. To me, it's a way that we can bring different types of exposures and different type of investment characteristics to investors. So for instance, if you think about the fact that we've got a Bitcoin balance sheet that's got nearly 20,000 Bitcoin on it today, and we've got the amplified exposure, that means that our common equity is going to be highly sensitive to the moves in Bitcoin. So I view it mostly as an enhanced volatility product. That's really attractive to a lot of people that want to take directional bets one way or the other. And what we want is to create the best vehicles for people to express those trades in. So that's what we've done with our common equity. On the other side, there's an acknowledgement that, one, not everybody's found Bitcoin yet. You know, you walk around the streets of New York, you can have the conversation. Most people won't even be able to tell you the issue with the money in their pocket. They've never had the time to stop and think about it. But what we know is that there's always a consistent demand for cash flow. It's a central part of individuals' lives. It's a central part of running a corporation. And so for us to be able to carve off part of the volatility profile of Bitcoin and part of the excess return of Bitcoin and be able to deliver that back to investors in an attractive yield product, you know, I view that as us taking Bitcoin and moving it one step closer to investors where they are today. Right? Instead of waiting for them to come to Bitcoin to find out all of the benefits of an asset that you can self-custody, that you can hold, that you can transact with no intermediary in the process, we all know how powerful that is. Most people haven't started the journey. So if we can bring an attractive product out to the masses that provides them day-to-day utility in their life that's made possible by Bitcoin, to me, that is going to help us bring Bitcoin one step closer to them and help them on that journey, to accelerate that journey, because if the product's good enough for us to issue a product like this into the market, it's probably something that they themselves should want to hold. So that's how we actually see this playing out there in the market, is we have a realization of you have to find the investors where they're at, and that means paying very close attention to what they want. And kind of the trio, if you could really hit the home run in any one of these products, is price stability, right, which is what's being tested right now in the market, high yielding, low volatility, right? Like that's what you're trying to accomplish, and deep liquidity. And when you're trying to do all three, right, that's where the market's got to stress test each one of those. And liquidity right now is the one you're seeing. There's deep liquidity in these products. There has been for a long time. And we think they're just a really unique value proposition that we can make available because we decided to take the step to capitalize our company on Bitcoin, because we can manage the risk as a corporation, right? We can now offer attractive characteristics into the market that it really hasn't seen before.
Well, that's beautifully put. And it's my understanding that, SATA is a daily dividend, first ever daily dividend in U.S. security history. Yeah, well, that's pretty cool. How does that play into like these three legs of the bar stool?
So that was a really big unlock. That's one that we're very proud of. And the reason being, if you think about dividend paying corporations that are out there, only 2% today even pay monthly dividends. You would think in 2026, people would be moving up the frequencies on these because the quarterly dividend really came into play back in 1885. So we still are following a standard practice that was established in the 1800s, which seems crazy. And so being able to unlock daily has a real material impact on how you would expect the security to trade. So if you've got a security that pays one monthly dividend, that means that during that month, there's one date where it's truly economically required to hold the security to get the benefit of the dividend. When we changed over to daily, it means that literally every day that market is open, you've got that day as a record date, that day is a next dividend date, and that date is a payment date. So now it becomes economically beneficial to hold that security every single day and not use it to trade in and out of, right? It could become a landing place for capital. Some people may just find the yields attractive enough that they just want to park, moderate duration capital in there and collect those daily dividends. But you're seeing those dividends hit your account every day, and there's something with investors where that's very comforting, and it's something they've also never seen before. Money markets started getting into that. They had the daily accrual, right? And these are not money market products, but the concept of daily really came out. There was a daily accrual, but it was still paid monthly. And so this is really the first time where you're seeing that benefit in your account every single day. And we think that's a really big unlock. And it's one in capital markets history that was made possible by a Bitcoin company. And I think that's a really cool thing that we can put that feather in our cap, that this is just one more way Bitcoin has changed the financial services industry.
Yeah, no, huge tip of the cap to you and the Strive team. And I did tell you guys pioneers here. So that's amazing. And, Kristen, one of the things I want to really get your perspective on is just, working the indices business. How are you guys thinking about Bitcoin exposure, and what do your clients actually want when push comes to shove?
In terms of how we calculate it, or the wrappers?
Both. So I know we talked about, being wrapper agnostic. So it's like, okay, what do they want to see, and how are you guys helping them see that?
Yeah. Well, I actually just want to say, I think it's funny that someone thought this was a controversial panel, because I think having multiple wrappers for access is so healthy for any ecosystem. I work at FTSE Russell. Today is Russell Recon Day. It's the day we reconstitute the Russell, the whole Russell series. And why that series is so well adopted is because we've got futures, options, a lot of ETFs, mutual funds, like all kinds of wrappers working together. So you have different instruments to hedge with. So I think it's great that we're seeing DATCO companies and ETF companies, perpetuals, futures, all of that on Bitcoin. And then from the indexer's perspective, like I said, it's really interesting that something as simple as Bitcoin, you could be calculating different rates for Bitcoin depending on the wrapper. I'm going to get really technical and boring for 1 second, but for our derivatives clients, they want us to do a time-weighted model. So as you get closer to 4 o'clock or whenever they're rolling, you want the pricing information to mean more. So we do a 15-minute time-weighted look back. For the ETFs, we use a 1-hour simple average look back. So the market makers can make the market between 3 o'clock and 4 o'clock and have a little bit of room to make some money on their own as well. So I just think it's interesting that this one instrument can demand so many different indices or calculations for all the different wrappers, but they work really well in concert together.
Yeah, and it's just a great logical point and explanation, because we're definitely going to get slandered on Twitter because of this title, but it just goes to show, like in real life, people need different sorts of exposure, and that's not a bad thing. And Zach, you kind of alluded this to the beginning, but derivative products, very important, crucial underlying plumbing to financial markets, and we're really kind of seeing a big developments of derivatives within Bitcoin. So you spent the better part of 2 decades in macroeconomics. How are you seeing the derivatives market in Bitcoin developing, and what does that mean in terms of deepening Bitcoin capital markets and maybe some opportunities that's going to unlock in the future?
Yeah, I'll offer a couple things. Maybe I'll just address the thing about the panel or the wrappers being controversial in some ways. I'd just like to remind people that central banks hold physical gold as a kind of national store of value asset for worst case scenarios. And most of those central banks keep it in the basement of the New York Fed in downtown Manhattan. So, the wrapper...
Theoretically.
In theory. I've been down there and looked at it myself. So we know that it is there. So, the institutions like a Grayscale or anybody else is just there to, help people meet their needs. And the wrapper helps people meet their needs, just like the gold in the basement of the New York Fed. And if you want to take your Bitcoin out of the ETF, or take your gold out of the basement of the New York Fed, you're okay to do that, as if the service is not something that you need. The derivatives markets are increasingly very rich. There's been a lot of things going on this front. Of course, I would say the things that are front of mind for me are perpetual futures and the rise of platforms like Hyperliquid, Bitcoin trading on those types of venues, both in perps and spots. All the things that are happening in options market. You have a very kind of strange shape in options market, because so many companies are selling calls, covered calls, and a lot of investors are buying puts for protection. So you have a very skewed options market, but just shows the use of these derivatives for all types of different users. And then maybe I'd add prediction markets, or what Hyperliquid would call outcome markets. I think that these will be very popular for retail speculators, in particular on Bitcoin and other things. So a very rich, to Kristen's point, very rich ecosystem of derivatives. It just speaks to how far Bitcoin has come. And going back to the macroeconomics briefly, I mean, this is why I remain so confident about Bitcoin, even in down markets, even here at 58,000, 59,000. The thing that still goes up and to the right all the time is government debt and deficits, and these are the things that drive demand for these assets in the first place. So I just sort of, whenever we're at a down market, I just remind myself the core reason that we're all here, which is that we're taking huge risks with our fiat currency systems, and we need these other assets like Bitcoin to provide a ballast to portfolios, and whether they're buying in an ETF or through a variable rate preferred or through a derivative product, they're all good ways to get access to Bitcoin.
No, certainly here. And guys, in our last minute here, I just kind of want to do a rapid fire down the line, starting with you, Ben. Share with the audience one future, maybe hole in the market that you've seen, financial product or opportunity you're excited about in Bitcoin land.
What I've actually had a lot of discussion around is real estate developers or real estate investors that are finding a lot of value in Bitcoin. And, it fits a lot of the principles that they have in their portfolios today. And as they're watching the real estate market inflate, they're looking for a new home for that capital if they have to rotate it into something else, right? When you see the price of real estate rising and you see the affordability of it going down, right, there's a fundamental disconnect out there. And so I've had a significant amount of conversations with fairly large real estate investors that are looking for a place to park that capital if they sell out of a real estate investment. And a lot of them are finding Bitcoin is the place that they want to put it. So I find that very encouraging.
That is neat. I've actually had a couple of conversations like that too. That was a good call out. Kristen, how about yourself?
We're also building a lot of indices that are Bitcoin, precious metals, also any of the rare earth commodities all pulled together. So I think that's great because it's saying everyone feels like Bitcoin's a core part of some sort of portfolio. It might be an investment as a store of value, or it might be people are starting to think about it like these other precious metals and rare commodities, and they want it all together. So I think that's also a very positive sign.
Zach?
Maybe I'll close by saying I think truly the institutional adoption of Bitcoin ETFs is only right now getting started. When you think of classic institutional investors, pensions, endowments, insurance, sovereign wealth, there's been a couple that have dipped their toe in, but actually it's a still very narrow list. And we interface with all these types of investors, and those discussions, those allocations are all kind of going through that process now, and they see market prices today as a huge opportunity. These types of allocators, the last thing that they want to do is make a foray into crypto, and then 50% bottom falls out. They see the drawdown, they see the structural adoption trends and the need for these types of assets and portfolios, and so now you're going to see those allocations, I think, over the course of the next 6 to 9 months or so.
Well, thank you guys for sharing your expertise. Let's give them a big round of applause.
Zero is the wrong number in terms of how much Bitcoin you should own.
Now, zooming out on Bitcoin as a whole, were you surprised by the success of the Bitcoin ETFs and Larry Fink going on TV promoting Bitcoin?
I think Bitcoin is becoming more popular. People are becoming more aware of it. I mean, the ETFs are a marketing game. I'm in favor of it because it helps people get exposure and interest in Bitcoin to sort of understand it as an asset class, start to think about it how they include it in their own capital allocation. We have sort of team members that have come up with a phrase which I enjoy is sort of zero is the wrong number in terms of how much Bitcoin you should own. And I think that having more products out there that encourage that adoption and the adding of Bitcoin as an asset class in terms of some shape, form of exposure into your portfolio is great. So you've got ETFs. I think, again, what Strive and Strategy are doing are allowing other ways to get sort of the income, the fixed income side. Exposure to that is great, and then for others, they're going to want to own spot and think about how do they leverage it in, based on that type of ownership.
And then competitively, how do you think about kind of the margin lending against IBIT versus against physical Bitcoin with Bitcoin-backed lending?
So right now, the space is very much we lend against essentially spot, right?
Yeah.
In terms of the actual asset. I think it will be interesting to see how it evolves. For the most part, our decision in terms of what we lend against is against the liquidity of the asset in the market. How easily can it be traded? How fast can we sell it? What is the access to sort of liquidating it, selling it when we need to? And so I think what Michael Saylor shared yesterday in terms of how much strategy and strike, MSTR and strike are being sold in the market from sort of a volume perspective is encouraging. I think you will see people start to think about how they incorporate those type of assets into portfolios, because that's been like the ultra wealthy have been playing this game for centuries, right?
Yeah.
They've accumulated business portfolios, real estate portfolios, and stock portfolios that they've been able to leverage to make additional investments, to live their life in sort of a tax-free way. And I think sort of Bitcoin and these new sort of equity options as well as sort of digital assets are going to provide that opportunity going forward, with really Bitcoin being the predominant one that's leading the way.
And with large borrowers, have you seen them kind of add derivative overlays to manage their risk, or is that kind of more uncommon?
We do know of sort of high net worth and family offices and more sophisticated borrowers. They ask questions. They do have different sort of derivative strategies that they wrap around their borrowing. I do think, again, once the capital has come on board, you will see some more of those structures come into play as sort of the market matures and it grows, right? You have more people into it, you have more money that people are looking to take advantage of, and then they can also diversify how they think about their value building strategies or their capital sort of treasury managed strategies if you're business, or your wealth building strategies if you're an individual.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
Bitcoin will be a core asset. Bitcoin will grow to become one of the largest reserve currencies. These companies will be extremely well capitalized. They'll be able to attract talent. They'll be able to make investments and eventually drive innovation into their respective jurisdictions.
Welcome to the Bitcoin for Corporations show. I'm your host, Pierre Rochard, and today we're joined by Gui Gomes from OranjeBTC in Brazil. Gui, how are you?
Hey, Pierre. Good. It's a pleasure to be here.
Yeah, we're happy to have you. We want to learn all about what you're building in Brazil and kind of what you're thinking about the space is today. But I want to start with your background and how you got orange pilled and went down the rabbit hole.
Sure, let's start there. So, as I mentioned, Gui Gomes, originally from Brazil, born and raised. I moved to the US about 10 years ago, went first to business school. And out of business school, that's where I met Bitcoin for the first time. I had a very good classmate that was deep into the space, was a very big ETH bull, but also had a little bit of Bitcoin. And Bitcoin caught my attention from the get-go, and I started studying and buying and accumulating and got fascinated about the potential of Bitcoin. Read a lot of her content at the time, so this is back in 2016. And out of business school, I joined Bridgewater Associates, which is Ray Dalio's hedge fund. I went to work with Ray. Ray was transitioning from founder, CEO, CIO into more of like a board position. And I joined a group to help him on that process. And Bridgewater has one of the best researchers out there. And at the time I was living in Manhattan and the office was in Connecticut. So I had about 1 hour commute every way. And I went to the office and back home listening to a lot of Bitcoin content. And once I got to the office, there was a lot of traditional macroeconomy, a lot of good research. And Ray has been very loud about the debt cycles and all the problems with the fiat system. He was never a big believer in Bitcoin. He thought that China would take over as the world's reserve currency. And that's where like it clicked for me. Say, hey, I think Ray is spot on with all the problems that we have in the current financial system and how the cycles will continue to play out. But I don't think China will take over as the world's reserve currency. I think there's a new solution, a digital solution, decentralized, that it works much better in this new economy. And that's where, like, essentially I transitioned my entire net worth to Bitcoin. I got, like, driven to join the industry, and eventually I left Bridgewater after 4 years, joined Swan Bitcoin at the time to help to grow the platform, spent about 2.5 years with Swan. And then in 2024, left Swan to build what is now OrangeBTC. I've been a MicroStrategy at the time investor and have been following Saylor for a long time and thought that something similar would make sense in a new jurisdiction, in this case, Brazil.
Yeah, lots of very interesting threads to pull on there. I want to start with one that hasn't really been discussed on the show a lot, which is Ethereum. You mentioned that your friend who introduced you to Bitcoin, he was a big Ethereum bull. What did not draw you to Ethereum, and why was Bitcoin so much more interesting to you?
Yeah, I think that was the main point. I think Bitcoin was, so for those who don't know, Brazil has seen all the issues of that cycle, weak currencies. We've had hyperinflation in the past. When I say hyperinflation, it's like 1,000% level of inflation. So essentially your currency is not worth anything. And I recall my parents getting their paycheck, and not only them, but every single person in Brazil, you would get your paycheck on a Monday, let's say. Same day, you'd go straight to the groceries and buy, to the grocery shop and buy everything. Because 3 days later, you'll buy 10% less. So, and not only that, like the now BRL, the Brazilian currency, is a weak currency, right? Like we depend on the dollar for a lot of it. So I've seen the issues of currency debasement, of weak currencies, of debt, and that's what resonated the most, thinking about how Bitcoin could solve for that, not only at a country macroeconomic level, but also on day-to-day. Like when you live abroad, and that was my case, I was born in Brazil, like you grow up tracking the BRL against the dollar price every single day. So how Bitcoiners do it today, hey, how much the Bitcoin price? You grew up doing the same between your currency and the dollar. So I understood that currencies could come and go, that this is all transitory, and something that is fully digital, that is decentralized, and that was very, very, very early in its journey, had a massive potential. So, and then if it was too complicated, okay, you're talking about different solutions. It's not on, I don't know if you recall at the time, like one was the oil, the other one was gold, and there'll be so much built on Ethereum. And anyway, it was too complicated, and Bitcoin was much simpler, much cleaner. And that's what caught my attention from the get-go.
Yeah, it was interesting to see over the weekend a very long post from Vitalik.
Yep.
It is complicated, and I think it's catching up to them. And we also see it in the price action where Ethereum is really underperforming Bitcoin and attracting lots of competitors that, you know, Ethereum doesn't really have very strong moats against. Whereas Bitcoin, it's got these network effects, these liquidity effects, and so when you went to Bridgewater, kind of what was did you talk with coworkers about Bitcoin? What were their vibes on it?
Oh, yes. We had even a Bitcoin kind of club. It was very early days, but there were like a few folks trying to push internally for, it was very interesting because they're talking now about 2021. So the big bull market. And then Bridgewater not only is an investment manager, right? They invest money on behalf of their clients, but also provide a lot of advice, right? Like the largest investors around the globe are relying on Bridgewater to understand what's going on around the world and like make investment decisions. And the company at the time was getting a lot, and as expected, a lot of inquiries about, okay, what's going on with this new ecosystem, like Bitcoin, Ethereum, like what should we invest or should we invest? So there was kind of external inquiries coming in and a few internal employees kind of pushing internally, say, hey, we should explore, why don't we invest, what's going on? So there was an internal community. It never got a lot of traction. Bitcoin, I think, is even public information. At the time, published a few research papers about what's going on, but much more like macro, just giving kind of a high-level color on the ecosystem. And then Ray has always had his view, and he has shared that openly over the years. But yes, there was a small group of internal folks, and a lot of them left to go build in this ecosystem. So I keep meeting friends, colleagues from my Bridgewater years. They're now across different players in this new industry, which is pretty cool.
Yeah, that is really cool to see the alumni network develop. And so how do you see Bitcoin fitting into Ray Dalio's debt cycle thesis? Setting aside kind of what his predictions are with the Chinese yuan, but if we kind of just look at the fundamentals of the fiat system, and why would Bitcoin be a solution?
I think it goes squarely into it, right? Again, for those who haven't read, and I recommend going and doing your research, but at a high level, there are these short-term and long-term debt cycles. And essentially, the long-term debt cycle is one in which the world's leading economy, leading nation gets to so much debt. And then the parallel here would be the US right now, right, that has almost $40 trillion worth of debt. And it is so high that you'll never be able to pay it back. And if you cannot pay it back because the interest is so high and the debt obligation, the service of that debt is so relevant, the only way for you to pay it back is by debasing the currency. So you essentially print more money, make everyone's dollar or currency worth less to be able to fulfill your service obligations, right? And when they do it, and that has happened time and time again, and then Ray is very brilliant on that aspect because it goes through many cycles and different countries and different currencies to see what plays out. But eventually, the country that used to be the leading nation in terms of education, commerce, army, all of that, it started losing the edge across these different elements because they start printing so much money, and then the currency work less, and the population or other nations start holding their wealth in that specific currency, and then eventually leads to a transition, right? A new power, a new nation emerges as the center of the economy, and their currency usually takes over as the new currency. And we're seeing the cracks on the US economy. We see the levels of that going on. And I think Bitcoin fits squarely into it because, on my perspective, there will be eventually a transition, right? We're going to transition to a new monetary standard. And this new standard will not be based on fiat currency, in which the destiny is always the same. There's a small group of people, politicians, in charge of a country and an economy. They usually think short-term, not long-term. So they make short-term promises with long-term consequences. Eventually, the long-term consequences catch up, and it is too high for you to fulfill the obligations, and then you have to debase the currency. So when you have a small group of people in control of a certain economy, that's why it usually happens time and time again. Politicians think short-term, the consequences come on the long-term, and then a cycle happens. And Bitcoin is beautiful because of that. Because no one's in control, right? Satoshi created, he's longer gone. Even if he were to come back, he would not impact Bitcoin as it is right now. So you have a digital ledger, fully decentralized, that works 24/7, and in my view, will emerge as a solution for the cycles that we've had for many years, as in the past was gold. Right? Before fiat currencies, gold used to play that role. So let me pause here. That was a long answer, but that's how I see Bitcoin fitting into Ray's thinking and this concept of debt cycles.
And where would you say that we are in the debt cycle? Because we've heard a lot about AI data centers issuing lots of debt, but also government deficits around the world. Yields on treasuries are increasing. So what to you, what are the signals you're looking at, and where do you think that puts us in terms of the cycle?
I think my perspective, and I'll argue even Ray agrees with that, we're kind of in the late cycle at this point, right? Debt levels are extremely high. They can always keep climbing, right? We're already at close to $40 trillion. We can keep climbing for sure. And then you start seeing conflict, right? Internally, so if you think about the superpower right now is the US. We have two classes, essentially, the have and the have-nots. Those that have assets have benefited tremendously, especially since 2008. Those that don't have assets, right, are suffering inflation and losing purchasing power and all of that stuff. So you see a lot of internal conflict, and how that manifests. Politics as an example, like we're seeing extremes, like every time you see more and more extreme visions and versions of how the world should run. So you start seeing that those types of conflicts within the country, but you also see that externally, and then you go to geopolitical tension. And that's what kind of we're seeing as well, not only with Russia and Iran, and to some extent China. So you start seeing cracks in the system. You're seeing inflation that tends to be more persistent, right? Central bank mandate would be to keep it close to 2%. It's been now many, many years above that level. And to some extent, we even abandoned that guidance of 2%. So you start seeing those cracks into the economy with the levels of debt, both at the government level, but also private debt, climbing and geopolitical tension. That's kind of what I usually track. And I think it's playing out day by day, as you said, right? I don't know, love to get a perspective here as well, Pierre, but like that feels to me late cycle vibes. And again, we're talking about long cycles. So when we say late cycles, it's not that something will break in the next 3 weeks or 3 months. It could take another 4 or 5 years, but essentially things start to break, and then government prints so much money, a la what happened during COVID, and we eventually move to a new monetary standard.
So yeah, it seems to me that layout is realistic and reflects where we are. To me, the big wild card on the other side is the productivity gains, and what does AI actually unlock? Does it create mass unemployment, or does it create lots of new jobs? Does it, fix the deficit? Everybody gets free healthcare. There's a lot of uncertainty around just how far can LLMs take us to grow our way
by
out of the
itself
debt.
as well, right? Yeah. Such an interesting point in time to be alive, because you're right. Maybe there's a new form of quote unquote workforce, right? Extremely productive, based on agents, and growth is so strong that leads us to actually paying down the debt without debasing the currency. That could happen.
It could, but as Lynn Alden says, nothing stops this train. There's all these demographic forces on the other side. So I think that's maybe. Do you think that's what is causing there to be, let's say, a discount on Bitcoin? Is all of this uncertainty? We're off of the $126,000 high last year. What do you see as the factors that are driving the Bitcoin market in this context?
Yeah, that's, again, price prediction is so hard to do, right? I usually pay more attention to like Bitcoin price appreciation eventually will come from adoption, right? The more people buy and hold and use it for commerce, that's where I believe the appreciation will come. For that, you need new solutions, new ways for people to get exposure, new tools, new integrations, and we've seen a lot of that, and also more education. So that's what I usually track. And from my perspective, we've made a ton of progress. Like when you see the past few months and years, so many new ways for people to buy and hold, and you're talking about from a reserve currency perspective with a lot of new forms from Charles Schwab and of course BlackRock, their ETF, but now Morgan Stanley and others creating solutions, and that's all moving the right direction from my perspective. When Citibank, one of the most traditional banks around the globe, is on a Bitcoin conference announcing that they will be custodying Bitcoin, that has to be an important signal right there. And we're seeing that on the commerce side as well, with more integration and new solutions. So that all looks on the right direction. You see the price action, there's a disconnect, right? Especially when you compare to the stock market, which is hitting all-time high non-stop, and Bitcoin has gone through an important correction from the highs of 126 all the way down to the 60s, and now we're back at around 76, 77, but very far from an all-time high. And it feels, and I think everyone will agree at this point, this is a bear market, right, for Bitcoin. So the disconnect, it could be a little bit of uncertainty around, I think Bitcoin, and there was a correlation over the past few months with software in general, so that might be playing out a little bit. It could be that a lot of capital that was in Bitcoin is transitioning into AI, right? So there is a cycle, there's a lot of excitement, AI is going to the moon, NVIDIA and all these other companies, and there's always usually a cycle, so there's some kind of hype, capital goes into other assets seeking yield, and eventually they come back. So from a fundamental perspective, I think we're in a pretty good spot, and you continue to see adoption and new entrants and new solutions, and that what will eventually drive price action over the long term. On the short term, I agree with you. There seems to be a disconnect, especially when compared to S&P. I think a little bit of that is driven by market uncertainty, but I do believe a lot of the capital that was into Bitcoin went chasing AI narratives, and I believe one day they'll come back.
Yeah, the financial and regulatory infrastructure, the plumbing seems to be in place for a big Bitcoin bull market, where people will be able to use E-Trade or any of these other platforms to get in and out of Bitcoin, and to have it on their screen, right? Before you had to go out of your way to sign up at Coinbase or somewhere else to be able to access it, but this is unprecedented. And I think, though, that these large companies, they're investing in this not because they're late to the party, but really because they see the growth trend at a macro level, that there's kind of a generational question of, as people who grow older and they pass their wealth down, this next generation is going to be far more interested in buying Bitcoin than in buying a lot of these other assets.
Yeah, I think you're spot on. Morgan Stanley launched their ETF, which I think was number 12, maybe 13 in the US, right? Not because they just because they see the potential, and was one of the most successful product launches on their platform, and that's 2 years after BlackRock launched their ETF. So again, I think the infrastructure is still being built, and even when you think about BlackRock ETF is now 2 years and a half old, so it's still very early on its trajectory. It takes time for these products to mature, for liquidity to build up, for asset managers to go through all of their vetting process from a compliance perspective, from a investment committee perspective. So all that takes time. And again, for those who are in the trenches like you and I, it looks like that the Bitcoin ETF was started many years ago, and they should be now at full capacity, but still very, very, very early days. A tiny portion of the US wealth holders actually have exposure to this new solution. There's more being built, and you're spot on. There is a transition that will play out over the next, let's call, 5 to 15 years, which is a new, the population is growing older, right? Wealth will transition into the hands of millennials. They were born in a digital age. They feel much more closer to Bitcoin and all that stuff, and they will feel much more comfortable building a 5, 10, 15% position into Bitcoin than their parents or their grandparents, that if they have some, probably they're around 0.5, 1%. So all of that will play out. It's a matter of time.
Yeah. And then on the supply side, the supply has never been tighter because we're now past the third halving. There'll be another halving in less than 2 years. So that 21 million is going to get divided up.
And we have major buyers right now, right? Like all these treasury companies that you cover here now buying in spades. So like it really changes the market dynamic from my perspective.
So on that topic, let's get into it. Tell us about OranjeBTC and kind of the Brazilian context in which it's operating.
So yeah, let's start with Brazil. For those who don't know Brazil that well, it's a large country, around 215 million people, right? One of the largest economies around the globe, usually around 9 or 10. Very sophisticated capital markets. As I mentioned, Brazil has dealt with inflation in the past, and it made the financial system extremely robust and agile. You cannot wait 2 days to settle a wire. Otherwise, by the time the wire was settled, like the face value was down 15%. So in terms of like market infrastructure, it has really developed. And it's the same with innovation and technology. Not a proud stat, but I think Brazil is the largest consumer of social media around the globe. High penetration on internet and mobile devices, all of that stuff. So pretty interesting country, high adoption of Bitcoin and digital assets. Bitcoin is very large in the country. Of course, stable coins are massive in Brazil as a way to move money around from Brazil to other parts of the world, but also as a way to get exposure to the dollar in a more easy, agile way. So in that context, Brazil was ripe for having a market leader, someone that has done to the US what MicroStrategy has done, right? If you go back to 2020, when Saylor first bought some Bitcoin in their balance sheet, that was essentially the only way for you in capital markets to have exposure to Bitcoin some way. But more than that, he has done a lot of work on educating the market, right? On explaining how it works and talking to other CEOs and all that stuff. And if the BlackRock ETF is in place today, is in grand part because of Saylor has helped to educate Larry Fink. So Brazil, large market, high penetration of Bitcoin and digital assets, but had zero players in the local capital markets. There was not a single company holding Bitcoin on its balance sheet, or more than that, a native player in this ecosystem when we started working on OrangeBTC. So the concept was what Saylor is doing is working well in the US. We're now seeing MetaPlanet in Japan. There's room for a player in the South. Brazil is a major market, and that's exactly how we designed the company. We designed the company with a single mandate to help to drive Bitcoin adoption in Brazil and Latin America. We raised a meaningful Bitcoin treasury. We began with 3,400 BTC, and then we listed the company in October of last year. Interesting piece here, Pierre, Bitcoin hit all-time high on October 6th. We rang the bell on October 7th, so we've seen a bear market playing out since day one. But it was interesting because the strategy is playing out. We had 150 shareholders. We're about to cross 10,000 shareholders. So we're growing the number of local shareholders. We're seeing funds that cannot buy Bitcoin or Bitcoin ETFs building exposure into OrangeBTC. We have been driving adoption with a lot of content. So we're doing events. We have our blog. We have podcasts locally to help to educate the local market. We've been talking to asset allocators essentially every single week since listing, explaining how it works, explaining Bitcoin, explaining treasury companies. We announced 2 weeks back a major transaction with the largest private bank in Latin America, Itaú Bank, almost $300 billion in assets. And we did that deal with Itaú, which is like a 5-year debt instrument that Itaú Asset Management will be holding. So the strategy is playing out. The market has been challenging, as you know well, but the conviction remains the same, and our trajectory is very, very early on driving Bitcoin adoption in this new region.
Yeah, it's really fascinating to hear because this bear market, you know, it's great to launch at the top, but I think that it's good to see that it continues to develop even when the price is going down. And we've seen that with strategy as well, that Saylor has been very active in the capital markets despite the price action being challenging. And, you know, when I worked at Hudson River Trading and I was a fund accountant for our Brazil operations. And
Oh, cool.
yeah, I got to familiarize myself with how advanced capital markets were in Brazil, which is, really honestly surprising for somebody who has never been to Brazil. But once you start talking with them, then you realize we have a lot in common. And there's so I'm curious to hear also the regulatory context here in the U.S. Under the Biden administration, it was very challenging. Gary Gensler tried to stop the ETFs from launching. How would you characterize kind of the relationship with regulators and how they see Bitcoin in Brazil?
So, interesting fact here. Brazil has been, to some extent, quite open to Bitcoin overall. The first Bitcoin ETF, the first or the second, was in Brazil, 2021. So think about that. I think it was October, November 21 when they launched, also at the peak of the last bull, of 2 bulls back, right? But essentially 2 years and change before the US. So a pretty interesting milestone from that perspective. Brazil just, again, the central bank released a few months back, like a set of regulations explaining how companies operating the space should be regulated. Again, regulation is always two-faced, right? On one end, I think Brazil has been quite advanced on releasing new regulation and all that stuff. At some points to a fault, because so much regulation and some restrictions, it actually could slow down innovation. But overall, I think the posture of the local regulators has been positive to the space. Clear example is the Bitcoin ETF in Brazil that was one of the first ones to be launched. Our relationship as a company was pretty benign as well. Again, when you think about it, when we launched, there was no native digital company in the space listed in the local market. I'm talking no exchanges, no miners, no infrastructure provider, no company holding Bitcoin as a core asset and using it as its main reserve, nothing like that. And we had discussions with the regulator, explained our strategy, explained our long-term thinking, and we're able to list the company and have been operating for over 6-7 months now in a pretty positive way. So overall, I think the regulators have been open-minded and advanced in the space. But again, when you think about regulation, have always to be cautious because too much of it can also be detrimental to the space.
Yeah, and then on the banking side, how have banks treated Bitcoin? Has it, how would you characterize that?
Look, kudos to Itaú in this aspect. Again, doing the transaction that we did with them is quite unique for the space. I think banks have been open as well. I would say that every single bank, and now one could argue the same is going on in the US, has built an internal division for Bitcoin and digital assets, exploring what's possible. A few of them offer Bitcoin and other digital assets, so you can actually buy them on your day-to-day bank app. So from that perspective, I think it's ahead of the US. Bradesco, which is one of the largest banks in Brazil, it would be akin to a Citibank in the US, just announced that they will be offering custody for Bitcoin as well. So kind of like Citi, they're big local custodians, they're kind of doing the same. So the banking industry is also making their movements in the local market, which is pretty interesting to see. And again, we're talking about 2 big markets here, the US and Brazil, but what's going on in these 2 economies will eventually play out across every, or has already played out, or will play out in every single other economy over the long term. And again, is more ways to buy Bitcoin, right? When a Brazilian can buy Bitcoin exposure through their day-to-day banking app with Itaú or Nubank or something like that, it makes much easier for you to buy and hold the asset than when you have to go to a specific provider, create a new account to be able to do so.
And with that ease of access, how do you position OrangeBTC as the exposure vehicle that should be interesting to potential shareholders?
Yeah, so there are many layers there. So again, a few types of accounts cannot buy Bitcoin or Bitcoin ETFs, right? It's very similar to the US when you think about retirement accounts, pension funds, insurance companies. None of them can buy exposure to Bitcoin at all. We also have all equity asset managers, right? And right now there's a single solution. If you are investing capital as a money manager into equity in the stock market, in the US, you have probably 30 to 40 options right now across all the treasury companies, the infrastructure players, the exchanges, the miners. In Brazil, there's essentially ourselves with the core mandate of helping to drive Bitcoin adoption. As you know as well, Melius is another company that has Bitcoin on their balance sheet, but essentially that's it. So across the entire local stock market, which is now close to $1.2 trillion, there's only two players that are driving some kind of Bitcoin strategy. So we have all that angle as well. And we have, as you know, the concept growing your Bitcoin per share over time. So that's our key KPI, always looking to drive growth in terms of Bitcoin exposure for the underlying investors. And also, we're going to do more than that. Like, we've seen what has happened in the US, and although Bitcoin has had good adoption in the local market, mainly on the retail side, when you go to the institutional side, we're a few years behind the US, right? What do you have here of different providers for like a Bitcoin-backed loan or custody providers or other like players in this market? We have zero in Brazil. So our goal is not only continue to have the largest Bitcoin treasury in Latin America, but also drive innovation in the local market, bringing a lot of the services and products that are available in the US to a market that is essentially untapped for that perspective, right? When I say banks are offering, they offer some kind of products that give you Bitcoin exposure, but you cannot withdraw the Bitcoin, you cannot take a loan against the Bitcoin, you don't have any other asset management strategy around Bitcoin. So there's a lot to be built, and that's our mandate. Growing Bitcoin per share and driving Bitcoin adoption in this new market.
That's really interesting. So that's kind of the operational component of the company.
Yes.
And then on the financing side, here in the U.S., we've seen Saylor start to buy back or retire his convertible debt to issue more perpetual preferred shares with STRC and other products. Kind of what's your thought process on this emerging digital credit phenomenon?
I think the success speaks for itself, right? Not only Saylor has done extremely well on it, but even Strive and SATA, they have had like great success, especially over the past few weeks and months. So I think the demand is clearly there, right? So it is an innovation that is driving a lot of inflows. That's something that we can explore in the future as well. We're still driving. Again, it's interesting, Pierre, when you go into our local version of Wall Street, which is Faria Lima, most people haven't heard about Saylor or strategy. So for us, who are deep into the space and like know exactly who he is and what he was able to do, when you go outside this echo chamber that we live in, like people don't know. So there's a lot of like educating on the basics of, hey, how it can work and how it grows over time and how can you take different forms of that, long-term debt to be able to accumulate Bitcoin, all that stuff. So there's a lot of educational component to help to drive adoption. But I think it's pretty interesting what they built. It's still very early. So like, let's see over a few cycles how it matures. But early on, the demand is clearly there and has driven a lot of inflows for both companies tapping into the new market.
It kind of speaks to that long-standing criticism of Bitcoin that it's too volatile, and seems like Saylor found a solution for those people. On
that note, just like as a company, OrangeBTC has a somewhat meaningful positioning to stretch. We had we did it in two fronts. We had U.S. cash reserve that we used to pay U.S. obligations, like dollar obligations. So we moved a piece of that into stretch out of a money market that was giving us something like 2-3% to stretch, giving us 11.5%. And also we built a larger position of around $10 million, giving like a credit line that we have that is much lower than that interest rate. So we're doing a little bit of a carry trade there as a way to monetize the company. So we are investors in stretch. We do it with a small portion of our overall treasury. But again, I think the success, as you mentioned, speaks for itself.
Yeah, it's a great bridge for working capital for short-term liquidity, and there's a lot of demand for that, and there's a lot of, as you mentioned, other products like money market funds that aren't yielding as much and aren't really keeping up with inflation either, for that matter.
Yep.
So, big picture, where do you see the Treasury space evolving? Has it reached its final form, or is there going to be continued innovation?
Oh, I think very, very early days. I don't think it's even close to the halftime. I think it will continue to evolve, right? And that's what, going outside a little bit of treasury companies, but going back to Bitcoin overall, that's what makes me the most bullish on Bitcoin, is the quality of the people involved and how driven those folks are to help the Bitcoin to like eventually reach its ultimate goal. And at a microcosmic, like at a tiny aspect of it, is what we're seeing on the treasury component, right? Saylor began buying Bitcoin back in 2020, as he was to say, hey, that first was kind of a defensive move. The company was pretty in a bad shape. He was trying to diversify, and then became opportunistic, and then strategic, and then transformational. So he has been evolving the company and the strategy alongside it. And I think we're going to continue to see continuous innovation in the space. And the past few weeks, we just saw it. Like Saylor created Stretch, which used to pay dividends once a month. Now he's proposing a change to pay twice per month. Strive guys saw it saying, you know what, why don't we pay it on a daily basis? So that's a tiny innovation, but I think it shows how driven the space is and how new forms of solutions and ideas will continue to play out. And my perspective is, over the long term, these companies will be the largest banks in each one of these jurisdictions. Maybe strategy will be the Fed, and then folks will be other banks in the space. But I think that's how it evolves. Like Bitcoin will be a core asset. Bitcoin will grow to become one of the largest reserve currencies. These companies will be extremely well capitalized. They'll be able to attract talent. They'll be able to make investments and eventually drive innovation into their respective jurisdictions.
Now, I like that vision. It's very positive and hopeful. The cynics will say that as the debt cycle turns, governments will look to seize the Bitcoin from companies. What do you think stops that from happening, or how would that evolve?
that's always a risk.
Yeah.
Right? We have to be honest here. If there is a risk there, is that one day governments will try to seize the Bitcoin or take over these companies. As of now, I see that as a small risk, to be honest. There's a lot to play out. And the more adoption we see, from my perspective, the lower the risk, right? So it's not only strategy that has Bitcoin in the US, it's now strategy, SpaceX, Tesla, the banks are coming in. So I think the more, and then the same in Brazil, like it's not only us, like Itaú, the largest bank in the region, they also have a Bitcoin position. And so I think the more penetrated we are, the more people have exposure, the harder it becomes for something like that. Again, I think it is a risk. We have to monitor. I have a perspective on how to handle something like that. I'll not get into it here, but I think it's a risk that at this point is not meaningful enough.
Well, I'll speak to the U.S. experience, which is kind of what I've seen firsthand is that as Bitcoiners get more involved in policymaking, that de-risks and that mitigates the risk. And so that's kind of my answer to those folks is get involved in politics and educate legislators and that will steer the ship in a positive direction rather than just being cynical or nihilistic about it.
I think you're spot on. And we have folks like the Bitcoin Policy Institute in the US. We have similar groups in Brazil doing a great job on getting closer and closer to politics and helping to drive the agenda there.
Most recently, we saw the MSCI, which is not the government, but they are an index provider. They took a view or started taking a view that Treasury companies somehow were not the same as other companies. How do you see that? Is that going to be a continued challenge for the industry, or was that more of an education process that will work itself out?
I think, again, and now talking about is totally a new jurisdiction as Brazil, I think the education remains a big driver here. And again, we just mentioned about the preferreds, and there's a lot of education going on that, right? There's a lot of markets concern. We will be able to pay. And then the more time goes on, the more payments have been done, the larger the conviction. And I think it's the same with these companies, is the longer they're around, the more successful they get, the more innovative they become by bringing new solutions and new products and services. I think it'll clear out that specific risk. Who knows, maybe we'll come back. But I think there'll be other challenges ahead in terms of taxes and treatment and all that stuff. So I think education, what you do here on a daily basis, what we're trying to do in Brazil remains critical for Bitcoin overall, right? If we had succeed, Bitcoin wouldn't be trading at $77,000, it would be much closer to $1 million. So that means that there's a lot of work ahead. And the same is true for companies in the space.
Any parting thoughts or anything we didn't touch on that you wanted to bring up before we close it out?
No, I think that's a little bit what I was planning to cover, explain a little bit our story, how we're driving adoption in a new market, that we are leaders. Again, we're just starting to build out, but there's a lot ahead. So anyone who wants to follow us, learn more about OranjeBTC, our website is orange with J. BTC.com. You can also follow us on social media at OranjeBTC on Twitter or Instagram. Again, we're also have an ADR listed in the US. So for people who want to learn more about us, the ticker is ORJNY. So we can put on the notes here. But that's it. We're building. We're part of the ecosystem. We're driving adoption in a new part of the world, in a different part of the world, which I guess we need to do the work around the globe to get us to where we need to be.
Amazing. Well, thank you for coming on today, Guy. Really appreciate your time, and definitely encourage our audience to maybe you could make a trip to Brazil. It's a beautiful country. So
for those who haven't been there, they should visit. It's a beautiful place to go.
Yeah. Thanks for coming on, and we'll have you back on soon. So excited to see what you continue to build with OranjeBTC.
Great. Thank you so much. Yeah. Talk soon. Bye-bye.
Talk soon. Thank you for joining us today on the Bitcoin for Corporations show. Guy, thank you for coming on. And to our audience, I want to encourage you to like, subscribe, and share this episode with your friends, family, and coworkers. And of course, we'll see you on the next episode.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets that could pose a threat to Bitcoin.
The quantum concept is, what do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself.
I would say the threat is less imminent than the headlines suggest, and work being done already to address any potential threat in the future is more robust and diversified than people think. And what I mean by that is there's lots of different work already underway that they range from changing the protocol itself or updating the signature scheme to post-quantum proof signature schemes versus, say, having contingencies and plans that would allow somebody, in case in the future they need to move or migrate to that signature screen, they can. And so there's a lot of work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%. Despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient, and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999, where the world was going to implode. Technology marches forward, and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more worried. Quantum will break everything way, way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin will adapt to it, already is. The discussions are great around it. And we're going to see many, many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but there was even just a paper that was released a couple of weeks ago where, without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.